the importance that it has to network television.
But last week,
basically, every single NFL game ends up being the top-rated program of the year. Go down the list.
Last week, the issue was, how come there wasn't more staying power to to Netflix's programming? I'm watching these games this weekend. I said, I don't need staying power of Netflix's program. I have this. And now you may say, well, look, it's just only 23 weekends of the year.
Yes, I might.
There's a lot of scarcity.
Because that would be the case.
Right.
Yeah.
Well, I mean, but
fortunately, they're not watching baseball.
Well, that's not our fault.
No, it's not.
Those those leagugues have to start looking at what's going on.
Not watching as much hockey. The NBA is pretty strong.
NBA is very exciting when you get to the playoffs. So you do it in March Madness.
Obviously,
so what I'm
TNT
saying,
plays a role there.
The Masters, which is classic like none other.
Yeah.
So I mean, suddenly you have these events, and you say to yourself, you know what? This cord cutting, it turns out that's a little harder.
Well,
last I looked, you can put a digital antenna up and do pretty well too.
Yeah, get the games for free.
Yeah.
Not every game's going to be that good.
Right. I just am saying that Netflix threw this market into a tizzy. Ukraine, obviously, PAL. And that's created great value. And yet I come in today, and now I've discovered about nuclear winter. And where was I 57% ago for this millennial index? And, I'm selecting the millennial index for a particular reason. Because we're talking about Moderna, Crocs, PennNat, Alphabet, Coinbase, Netflix, PayPal, Zoom Video. I mean, these are real companies. Or they were until this thing started.
Yeah.
Look at Zoom.
Okay, I will. What would you like me to look at it for?
I don't know.
Because
Get in
it's
touch
down
with your relatives.
dramatically?
No, I mean, I'm just saying that we valued this company at X, and now we've taken it all the way down because we think that they didn't use their currency to make the buy.
They tried.
I'm not recommending Zoom.
They tried.
I'm not recommending
Zoom. Tried to buy
Zoom,
5.9. It didn't work for them.
I'm just saying, I'm mentioning that as being a hated company that has come down so much that I have to think, all right, let me open the book on Zoom. Let me see if there isn't something
It is
cooking.
down 62% over the last year.
Right. DocuSign.
High was 451.
How about I had Huntington Bank shares, yields 4%. They're having the best year that they've ever had. They just got the Ohio gift of Gelsinger.
Yeah.
And their numbers are terrific. I guess I got to sell that because of, tell me why. Because I mean, Cincinnati's in the because it's from Columbus. No, I mean, I don't. I need a reason to sell. Is what I'm saying.
Carl,
I need
don't know
a reason.
If people have a reason on Rivian to sell, but I did notice
Well,
that stock, and it is interesting because it is reflective of what Jim is talking about. The speculative nature of the markets last year. Certainly, this was a high-flying IPO. It still created an enormous amount of value for those who owned it when it was a private company, at least the earlier rounds,
Yes.
certainly. But it is below its IPO price, down another 7%. Remember, we got the deliveries for last year. They delivered, 1,015 vehicles, 920 of them to customers in the U.S. by the end of 2021. Obviously, it's about what they're going to be doing this year and the years following. But it is a good proxy to a certain extent for the speculative nature of some of these. It's down 42% this year.
I just find, I want to find a reason why I must at this moment sell American Express ahead of the quarter. And a lot of people say, well, the reason is obviously it's because American Express has got, come on.
You sell because somebody else is going to sell it, as you just said with Halliburton, because it's going to keep going down.
So
because
I want to beat the
Fed's going to keep raising rates, and we're in a different environment right now than we've been in for quite some time. Okay. And the Fed may not finally have your back, even if we're down 20 or 30% in the
Was the
S&P.
whole thing just a giant Fed? That's another thing. Those people have come back and said it just was nothing. And I'm sitting here hoping for the Pfizer pill, just in case my loved ones get this. And in the meantime, people are selling Pfizer. Now, because they're selling Pfizer because it ended, the pandemic ended, well, how about Pfizer now has the ability to be able to go through the patent cliff? I think that Pfizer's interesting. How about for the first time we're going to an Apple quarter where it looks like that things are sold through and the stock's not at its 52-week high? What a gift!
Got a couple reiterations of Apple on Friday from Morgan Stanley. And then today on Microsoft out of Goldman, reiterate buy of 400, Jim. We're going to be reminded of the reasons we bought these names.
Or sold them. Or sold them. I mean, you look at Microsoft and someone could say, I'm not going to pay 30 times earnings. Or you could look at someone who says, the reason why I've been buying this company is it keeps beating earnings. But was that, David, no longer important when the stock's down 60 from its high? Now we've got a new metric, and the metric is I really want to get out ahead of you. I mean, this is like when you go, hey, the Bears chasing me. I don't know
how widely owned Microsoft was, and every hedge fund is in this name. All of them somehow underperforming anyway. But
okay, so again, are you going to get in at 273?
I don't know, Jim. Listen, the performance last year was extraordinary. The top line growth for a company that's been around as long as Microsoft was eye popping when you would look at those releases. I don't know what we're going to get this coming for the last reported quarter when we get it later this week.
I agree.
One would expect it'll be quite strong again. But you tell me. Let's just go back to the fundamentals. I don't know. Where's this thing trading on
30 times earnings?
Okay. Probably deserves that, given if it can maintain that kind of top line growth.
That's the problem. So you take it, again, I'm playing this devil's advocate line because I don't like selling it's for the sake of beating someone else. Okay, so Google, Alphabet, it probably sells it at 20. It's 22 times earnings. Back out the cash. What are you talking about now? 19 times earnings. Now, is that expensive? And the answer is no. But you can then, Carl, say, who cares about whether it's expensive? And the answer is that 3 months from now, you'll be carrying a great deal because you're looking. Money is not going to come out of the market to 1.2% CDs. It's going to look for situations where the momentum has come out and the business is good. Every one of the companies that are up there right now is doing things, spending hundreds of billions, tens of billions of dollars developing new programs. And we sit there and we say, well, these are just sitting ducks. And Carl, like the sitting duck thing, well, those are the SPACs. And those are the companies that came public. Those are sitting ducks. And the fact that no one's come in, say, and bought a Lemonade or bought an Upstart. When I say no one, I mean a company. That tells me, all right, be careful there. But I'm not going to sit here and say, this is the moment to sell AbbVie. Because even though they're doing well, even though they've got a great yield, even though they're going to have a terrific quarter, I'm going to sell it because, well, everyone else is.
Well, there's
That's
a good example.
Reason.
There's a good example on Splunk today. BTIG ups to buy, target 155. Channel checks improving, lead us to believe companies turning a corner. We see a few dynamics that could help the name re-rate later in the year, specifically the accelerated mix shift to cloud.
No, see, now they're not making money. And my problem there is that I had Doug Meredith on multiple times, and Doug Meredith one day disappeared. I don't know the new interim CEO, and that I find to be, because of that, I'm more concerned. I absolutely like the idea of a turn. But here's a good one, ServiceNow. Okay, so ServiceNow, Adobe, a couple of these, but ServiceNow is now down 200 points from its high. Okay, it sells at 85 times earnings, but it could make the number. That means it's good, except for the fact that it's got momentum buyers. But look at the chart. I know, David, you're not a chartist, but you're repealing whole moves.
Yeah.
Does that matter?
I don't know.
Well, the answer is that.
What is the answer, Jim?
The answer is that if you liked it at 700,
you're going to love it at 500.
Yes.
Okay.
Yes. Yes.
Let's take a look at Snap. If you like Snap at 80, are you going to like it at 30? This morning there's a downgrade from Wedbush to neutral. By the way, they've had an outperform on the stock, so take that for what it's worth.
But
I think what's interesting here is
I'm glad you mentioned that.
Is the thesis, which is Snap currently has a strong foothold in the 13 to 34 demo, and it's all about TikTok. The audience is the most similar to Snap's, which means it puts both Snap's engagement and time spent and ad dollars at risk. TikTok is a power. ByteDance, obviously the owner of TikTok, those numbers continue to soar higher. Advertising is such an important growth component of TikTok. Putting Snap at risk. By the way, maybe others too. I mean, there are some who argue short form is really everything that matters for this demographic. They're not even going to be watching television.
No, I watched
in any form.
The Apple ads this weekend seemed like that there were people trying to figure out how to put their TikTok together. I look at Snap and I say the last quarter was terrific. I don't know, maybe it bottoms at 25. Again, I'm stuck with this concept of if you want to buy a stock, you should want to buy it when the stock is not 83, where it was, but 30, where it is. Now, the last hour, that stock could break down to 28, so there's no need to be aggressive. But I'm looking at these stocks down from where they were, and I'm saying, all right, those people who bought it that high, they're wrong. I'm not going to be as wrong as they were. I want to do some buying today. My Charitable Trust is buying today. I'm forcing myself to buy today. We wanted to buy more Friday. We couldn't. Why am I doing it? Because that's what I do. That's my discipline. It's my discipline.
Okay.
It's my 13 seconds, okay?
13
We're going to get some PMI data here in just a bit, so we'll take a break. A reminder, you can get in on the CNBC Investing Club with Jim. Sign up, find out more at cnbc.com/investing club. We didn't quite get to 10% discount from the highs, which would be around 43.16. We're back in a moment.
Welcome back to Squawk on the Street. Rick Santelli here, live at CME HQ with breaking news. Some of the first PMIs of 2022, and they're not pretty. January preliminary market PMI manufacturing 55.0. That's the weakest, going all the way back into October of last year, sequentially following 57.7. On the services side, 50.9, 50.9. That is the weakest since June of last year, and sequentially following 57.6. And finally, the trifecta of weakness, the composite PMI at 50.8, 50.8, the weakest since June of last year, sequentially following 57.0. We see interest rates are slipping a bit. They probably will now slip a bit more. Squawk on the Street will return in 2 minutes.
In the setting of an epidemic right now, you don't want to withdraw the use of masks for schools that have come to rely on them. But when we do start to improve, that should be the first thing that we look at, because we know that they're disruptive to children. We know that they've had a cumulative impact on the socialization of kids in schools. The other thing is the vaccine mandates. You just saw Connecticut announced that they're going to suspend their vaccine mandate for state workers. Why? Because they've achieved most of their goals. They've vaccinated a very high percentage of their state workers, well over 90%. The population has a lot of immunity in it. Cases are declining in Connecticut, and so it doesn't make as much sense to have that mandate in place anymore. And so you have to have a flexible doctrine here.
That's Dr. Gottlieb earlier on Squawk Today with his take on mask mandates and the Omicron spread. Obviously, it's a big story for the UK, where a lot of restrictions are going to roll off in the coming days, including having any test when you arrive.
Look, I follow him, of course, very closely. And to me, what he's saying is if you're Fed chair, you have to say, I don't know, I would listen to Gottlieb, and maybe 4 weeks from now, something will be very different. Let's not be too harsh, because so many of the companies that have reported, the biggest problem is the quarantine. The quarantine has made it so that if someone gets sick, you can't fill the shift. So, David, if Gottlieb's right, and I think we all agree Gottlieb's pretty solid,
yes,
then I think that it says, listen, we're going to make a move, but then we got to wait and see what happens when people come back to work.
Yeah. I continue to be fascinated by what China's doing. We've talked about it a bit in terms of their zero tolerance policy, which continues. They're locking down of cities. They're slowing of certain industries to a certain extent. And what I am hearing now is supply chain issues may be getting a bit better in some areas, but out of Asia, there's concern that they may actually be worsening a bit because of China and other Asian countries' policy, which are very different than ours in terms of continuing to have at least very little tolerance for any cases.
And yet when we hear about reshoring, it still seems to be hit or miss. I mean, people just, they like the China strategy. They like to have a little more here. When you see somebody like an Intel, they don't want to be dependent so much on Taiwan. Remember, the Chinese, sent over more than 30 jets this weekend. So, I mean, geez.
A lot of naval activity on the east coast of Taiwan, that's for sure. So we're down 43.01. That is a full 10% down from the S&P highs. Let's get to Bob Pisani. Hey, Bob.
And that's certainly very significant. We haven't seen that in a long time. And we're getting a 90% downside day, almost 90% of the stocks to the downside. Just take a look. Not a lot of places to hide, not surprisingly. Consumer staples up a little bit earlier on. So you had Kroger and Clorox and Colgate, Procter & Gamble holding up, but not much else. You see even healthcare, defensive group down almost 2%. Energy, which had been the market leader this month, down. Arc Innovation down even more, 5%. So take a look at the tech stocks, and this is typical that we're seeing. Mega cap techs like Apple and Microsoft are down today, but the more speculative stuff, the Shopify and the blocks, they're down about twice as much. This is a very typical pattern. I'll tell you something we haven't seen in a long time. New lows. We have almost 450 new lows on the NYSE. When the last time you saw that? Here's some surprises. PayPal new low. Etsy, Walt Disney, Amazon's at a new low. 2,800 on Amazon. That was 3,200 just about a week ago. So rather surprising group of new lows that we've got here. We've got two big market issues. I wrote about this in Trader Talk over the weekend. Number one, we've got a multiple compression. The PE ratio, which is how much people are willing to pay for $1 of future earnings, has been dropping. It's under 20 right now. It was in the mid-20s, so people are getting a little more cautious and not willing to pay as much for a future stream of earnings that are out there. And then, of course, we've got the earnings headwinds that are there. 2022 earnings are only going to be up 8%, folks. That's closer to the historic average of 6%. It was 47% in 2021. So much more modest earnings gains. And the estimates aren't going up as much, maybe because there's concerns that the Federal Reserve is going to slow down the economy a little bit, maybe a little bit more than people were anticipating. So that's a big, big issue right now. Remember, last year, earnings estimates were going up practically every week throughout all of 2021. That is no longer happening. So you're dealing with a multiple compression and an earnings headwind, and that's an issue. Another problem is the play for January was, let's go buy cyclical and value stocks. Well, energy has done okay, although it's off today. Banks have been a little bit of a disappointment. That's another value group. Industrial is another value group, basically haven't. So this idea, let's go buy small caps, let's go buy cyclical and value, and let's sell technology, hasn't worked that well because the one side of the trade, let's buy the side, the cyclical and value, really hasn't worked that well. And you see technology stocks down about 12%. And if you look at some of the other groups that are out there, value in January, okay, you know, small gains here. Exxon's done well. It's down a little bit today. Deere and Smuckers. But these simply are not enough to overcome the big declines that we have seen throughout the whole month of January in the tech group and the domination of tech stocks that we have seen. So you see something like an NVIDIA and most of the big semiconductor stocks now down 20, 21, 22%. Broadcom down 20%. And even growth names in the consumer sector, for example, Starbucks and Home Depot, these are considered growth names actually now, and they're consumer names. They've also been getting hit, and there you see even a big cap name, Microsoft. So I think the point here, Carl, is this idea of let's go buy value and cyclical is not a bad one. It's just not weighing out against the big declines that we're seeing in tech. A lot depends on what the Fed says this Wednesday. They're in a very difficult position right now. They've got to sound hawkish, but if they sound more hawkish, market's going to drop more. Carl, back to you.
Bob, thanks. Bob Pisani. Let's get to Jim and stop trading.
Yeah, look, one of the things that really shattered people last week was Shopify, where it looks like that Shopify is not doing as much business with certain fulfillment operations. And that made it people say, well, wait a second, maybe I'm in Etsy and that's wrong. And maybe I'm in this whole universe of companies where you buy things online and they're buy now, pay later, and that's wrong. But Shopify had been a leader, and obviously now people are saying, what do I pay for that? And these are the problems, is what do I pay? And I'd rather be in a company where I know what I should pay, which is, say, under 20 times earnings with good growth. And then it's like, wow, that stock went to 1,000, and it was all just raise price target, raise price target. So that's the problem.
Yeah, we did get an upgrade of a firm out of Stevens. They go
Right.
to equal weight. They think that maybe the GMV guidance is good.
I thought that was a great piece because they had to sell. I like that. They go to hold, and they have the opportunity to go high. Max Levchin, as CEO, I think can do a good job. And against that, you have like a Coinbase, where you're now just down, down, down. And if Bitcoin bounces, it's a win.
What's on tonight?
We're going to figure out where the Bitcoin bounces.
Ooh, interesting.
Yeah, it's Ethereum. You know, got a good take. And then this gentleman, Ryan Peterson, he counts the boats. He's the guy, David, to find out whether we've got the end or the beginning of the end.
He's the go-to guy in supply chain stuff.
That's very good. The hedge funds, I think, follow him.
Yeah, yeah. It's an interesting company, too. Still private.
Isn't it?
Yeah.
Thank you.
You're welcome. You're welcome, Jim.
We'll see you tonight, 6 p.m. Mad Money with Jim Cramer. We're going to stay on top of the sell-off. Drawdowns now on the S&P 10, Russell 20, all sectors red, and the VIX at 35. Good Monday morning. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with Morgan Brennan and David Faber. Dow down 600 here to start a busy week of earnings. The Fed meeting, GDP, S&P's now down 10% from the highs. And those PMIs this morning did not help. Awfully close to 18-month lows, Morgan. It is an ugly start to the week. We're 30 minutes into the trading session. Here are three big movers that we're watching this morning. We're going to start with coals. Spiking up more than 30% in today's trade, with takeover interest in the retailer ramping up. It's up 33% right now. We're going to have more on this later in the hour. Plus, Snap shares sliding as the social media name is downgraded to neutral from outperform at Wedbush. Analysts there see various headwinds impacting Snap's revenue growth. Shares are down about 6.5% right now. Finally, we'll end with our own parent company, Comcast, getting an upgrade at RBC Capital from sector perform to outperform, with the firm believing subscriber growth concerns have been overblown, and those shares are up more than 2%. Carl? All right, Morgan, thanks. Let's turn back to the broader markets. As we said, stocks under pressure as we're trying to hold 4,300 on the S&P. You got the VIX, Mike Santoli, closer to 40 than it is to 30.
Yeah, so things are starting to line up. In fact, at Friday's close, things were starting to arrange themselves where you look at the conditions for some kind of tactical relief soon. Now, when I say soon, that usually means in time as opposed to in price. So now you're seeing a little more of an indiscriminate phase of the selling, more than 90% of volume to the downside. NASDAQ more oversold than it's been on a technical basis since March of 2020. So those are just sort of the prerequisites to have some kind of snapback. It doesn't mean that we're back toward the highs. We really have broken trend, obviously below the 200-day average. First 10% correction since before Election Day 2020, and it takes you back 6 months. So I think right now we're in this phase where we're kind of stretching for negative reasons to backfit to the price action, right? So we're talking about Ukraine now. We're talking about a domestic economic slowdown more than we thought. So it all lines us up for the Fed. And I think the key question is, has the market gotten to a point where the hawkish kind of leaning of investors in the market positioning now exceeds the likely hawkishness of what the Fed says on Wednesday? That's, to me, where we are. In the exit from this storm, whenever that does happen, it's going to probably be interesting, finally, for stock pickers, because you do have, almost half of all NASDAQ stocks have been cut in half. A third of S&P stocks are down 20%. So at least you have maybe the hunting ground for folks to look for wreckage out there. And you see the activist today, which is, I think, kind of the early edge of that type of activity.
Definitely got attention over the weekend. Mike, meantime, VIX curve inverts and the bull-bear ratio near some multi-year lows. Some of the desks argue that if earnings come in halfway decent, that those three things set up some opportunities.
Without a doubt. Those are the positioning and fear gauges that are telling you that people have done an awful lot of kind of retreat from risk in a hurry. Now, you have to throw out one caveat, which is, mechanically speaking, this kind of high-stress environment that shows those mechanical breakdowns, that's when you get these big air pockets. Crashes happen from oversold levels, not from overbought levels. Not to say that's what's going on right now, but you have to keep in mind that just because you have that setup, it doesn't mean in a timely way everybody together gets the reward for buying the open, for example.
Mike, I know we talk about this a lot, but just looking at this setup, is it akin to playbooks we've seen in years or decades past? I mean, I've been hearing the increased chatter again about 2000, for example, and the idea of a tech bubble bursting.
Morgan, there's no doubt that there are aspects of what's gone on in tech over the last 11 months, not over the last 4 weeks, that absolutely look a little bit like that, where you had just this tremendous rush of untested companies that swamped the market, the no-profit kind of moonshot stocks that have been dismantled, and now it's reaching the higher levels of the NASDAQ and of growth stocks. Yes, all that stuff fits. I think, though, it's a little bit maybe more prosaic than that right now, which reminds me of 2015. We're going to do the first rate hike after the global financial crisis. The market did have a little bit of an episode down, pulling back 8% or so. There was a Chinese devaluation. It all of a sudden seemed like an inopportune time for the Fed to start raising rates. They squeezed it through in December. Many differences here, including the run rate of growth in the U.S. now versus then, which is better now. But I think a lot of that stuff is sort of textbook. The market is going to tighten before the Fed actually does it. That's what we're seeing.
Mike Santoli, thank you. Let's bring in Charles Schwab, Chief Global Investment Strategist Jeffrey Kleintop, and Allspring Global Investments Head of Active Equity, Ann Maletti. guys, good morning to you both. I mean, we have major averages all down significantly again this morning. The S&P down another 2%. 42.95 is the level there. Jeffrey, I'll start with you. Is there more pain to come? And I ask that knowing that this is a week with a trifecta of news potentially between earnings, the Fed, and also all the geopolitical risk that's simmering as well. I mean, are there certain signals that you're watching for to know that we are hitting a potential bottom in this correction right now, or what would you be looking for?
I think earnings are really important, but we're also going to be getting economic data here for the month of January starting to roll in, like the PMIs this morning, that are showing that Omicron is having an impact, negative impact on services. We've seen that in the numbers here. We know that in like open table reservation data. We're really seeing services really pull back very sharply. Of course, we know about the potential invasion of Ukraine by Russia and the looming start of a Fed tightening cycle. But I think if investors begin to shift their focus out a little bit, and they may this week and next week, given the earnings releases, they ought to look to a brighter Q2. The rebound from Omicron in Europe, given pent-up savings and fiscal stimulus and inventory restocking. I'd note that Russian conflicts in Europe have not led to sustained stock market sell-offs in the past. And I think that there's reason for investors to consider buying the dip here. They may want to favor, however, buying European and value stocks that have led when interest rates were headed higher in the past.
Interesting. I definitely want to dig into that a little bit more. But first, Anne, I'll put the same question to you, especially this idea of, quote unquote, normalization and normalized growth, since investors do seem to be trying to wrap their arms around what that's going to look like in a post-pandemic world right now and how that's playing out in the market.
Yeah, certainly our investment teams are assessing that. And as you look at Q4 earnings, they're going to be looking at that. Last week when we saw earnings surprises on the downside from certain companies, we saw those companies be punished more. But as Mike alluded to earlier, the contagion is spreading pretty wide in this first phase of the sell-off. And I think some areas have been hit harder than others. And, you know, it is a time for stock pickers who are willing to look at company fundamentals to go out and start looking now and putting together your buy list. Certain segments of the market have great opportunity.
So, Jeffrey, I mean, the situation with Ukraine and Russia right now, which certainly seems to be a risk that is mounting, and there are many question marks around. I realize in general, geopolitics is something, at least from an equity market standpoint, that tends to be shrugged off by investors, but it's certainly adding to the maelstrom, if you will, this morning of negative sentiment in general. And there are areas where this could potentially have a bigger impact. I think about oil and commodities, for example, at a time where we are talking about inflation and we are talking about the Fed. Are there certain areas to just steer clear if you are concerned as an investor about the potential with geopolitics?
You know, historically, we really haven't seen a big impact. Obviously, on the upside, we're seeing some impact to oil prices and natural gas in Europe, maybe lithium, other commodities that are impacted by this. But on the downside, not that much. I mean, Russian stocks have completely disconnected from oil prices. Usually, the Russian stock market and oil prices are the exact same chart, but we've really seen a big disconnect there with Russian stock prices falling dramatically. But they only represent 3% of the emerging markets index, so it's really not having a huge impact there. I think if you look back to 2014's Russia's invasion of Ukraine, less than a 1% drop in the S&P 500, less than a 1% drop in the EM index, and they all rebounded within a week or two. So I think historically, while we can't measure the human toll, the market toll tends to be very minor from these types of events. And I quickly add that Russia is currently waiting for a written response from the U.S. on security concerns, and that won't be until, I think, the 30th. So probably nothing to happen this week militarily in Russia.
It is remarkable, though, Ann, to watch energy trade lower in a day where the tape is full of geopolitical warnings. I wonder, you know, we got these PMIs getting awfully close to 50 once again. It's certainly going to feed, if not recessionary talk, talk of a slowdown, and people will start to discuss how the Fed manages to hike 3 or 4 times in the face of slowing growth.
It certainly will. And I think that's kind of the greatest fear is how the Fed reacts and keeps this balancing act. Will they react slowly to inflation? Some say they've acted too slow, but will they watch the data and see what happens to growth? And if we do start to get more normalized growth, I mean, I think it's all fair to say we cannot sustain the type of growth we've seen over the past 12 to 18 months. If we start to see a slowdown, will that impact their change? or their actions. Sorry, I do think it probably will, but there's going to be a lot of turbulence as we march through these next couple of months. But turbulence can bring opportunity for investors.
So, Anne, just to get a little more specific on that, where do you see opportunity?
Well, there more specifically, it is from the bottom up, right? Looking at very specific stocks. But there's a segment of the market that was sold off very, very hard. If you look at small cap growth stocks referenced by the Russell 2000 growth, if you take into account all of 2021 and just what's happened this year, that segment of the market is down 13%, yet earnings have been up 32%. That's in comparison to the Russell 1000 growth, which is up 11.5% for the same time period, and earnings growth has only been 4%. That means we've seen a lot more multiple compression in that small cap growth space. Now, wouldn't buy the index. I would definitely pick just certain stocks.
Okay. Jeffrey, given the fact that we do have the Fed meeting tomorrow and Wednesday, I'm just looking at one of your notes. And one of the things you talk about is the correlation, both positive and negative, throughout really the last, I'd say, 50, 60 years between the bond market and the equity market. Are we poised, given the fact that the Fed could potentially hike the most aggressively we've seen in a number of decades, are we poised to see that correlation shift again?
Morgan, that's a really important question, and thanks for asking that. We have seen periods like from the 70s, 80s into the 90s where when interest rates went up, stocks went down. I mean, we're so used to this current environment where they move in sync with each other. But I think we're likely to continue to see this movement in sync, meaning as rates go up, stocks in general move up as well. And the reason for that is we've moved from a period where when rising interest rates, when rates went up, leading economic indicators went down in the 70s and 80s. And that created a negative correlation between rising rates and a falling stock market. We're not in that environment anymore. Generally, when we're seeing rates move higher, it's because of stronger real growth, and that pulls stocks higher on the outlook for stronger earnings growth. So no, I still think we're generally in an environment where rates are likely to move higher this year, even as inflation slows, but accompanying that is better stock market performance.
Just to take a break here and show where we are, Dow down almost 750. We have lost 4,300 on the S&P. In fact, it's the worst day for the S&P 500 since October of 2020. VIX at a 15-month high as we're getting close to above 37. And I guess, as we wait for the earnings prints this week and the guidance for quarters to come, what is the incentive for companies to do anything but underpromise, given the likelihood that they're not going to get rewarded for it on the tape?
Look, I think most management teams just want to be honest with investors and tell them what they're seeing. And for them, the water's murky as well, right? They can't predict what the Fed is going to do. The outlook for growth for most of these companies is pretty clear in the short term, but it's murky in the longer term. So I think they're going to be completely honest. And it's all about what is in the investors' expectations and what's in the models of the street, both buy side and sell side. And so that's where, really knowing the companies you're invested in will matter.
So finally, I guess just to wrap all of this up, Jeffrey, I mean, on another day that is very ugly, with lots of broad-based selling across all the different averages, all the different sectors right now, your words of wisdom to investors who might be looking at this and saying, oh my gosh, should I put cash on the sidelines right now? Should I be buying gold? Should I be getting out of the equity market? What do I do right now, given how much red we're seeing on the screen? What do you say?
Yeah, great question. The markets are going to be more volatile this year. We widely expect that. I think you want to do three things. One, invest internationally. Rising rates typically accompany outperformance by European stocks compared to the U.S. And within Europe, value stocks over growth. The other thing you want to do is buy buybacks. Firm share buyback announcements were particularly good for share prices in 2021. I think that's probably going to be the case again this year. So look for those companies making buyback announcements. And finally, guard against gluts. This theme of supply shortages in 2021 turning into gluts in 2022, as we're kind of seeing with Peloton, could continue to unfold. So watch out for those companies that are seeing inventory begin to really surge. That could begin to weigh on their prices.
A pendulum swinging. Guys, thanks for starting the hour with us, Jeffrey and Ann.
Thanks.
Thank you.
Well, it's not just stocks that are under pressure. Crypto also, Bitcoin is now down sharply as well. And you can see, about 50% from its all-time high. Kate Rooney has more on what's going on in that sector for us. Kate.
Hey, David, good morning. Yeah, cryptocurrencies have been battered right alongside tech and growth stocks. Bitcoin now trading under 34,000 this morning. You've got Ether, the second largest cryptocurrency, hitting its lowest level since July as well. And this is partially a result of cryptocurrencies becoming more mainstream. That was seen as a bullish sign that the asset class was maturing over the past couple of years, but it's really been a catch-22 lately as macro funds have adopted Bitcoin over the past 2 years. They are now turning to crypto as one of the first places they're looking to sell and get liquidity. As a result, Bitcoin has been trading right in line with equity markets. You've got Bitcoin and stocks hitting their tightest level of correlation since 2020. Analysts are also pointing to retail investors losing conviction lately. Glassnode analysts this morning saying that the lion's share of losses are coming from newer buyers or short-term holders who, quote, appear to be taking any opportunity to get their money back. Right now, only 32% of Bitcoin's market cap right now is held at an unrealized profit. So a lot of people underwater there. Low profitability and sustained investor losses have usually been a sign of early to mid stages of a bear market in crypto. And these periods are also marked by low investor sentiment. One way to look at that is called the Fear and Greed Index. Right now, that's at a 13 out of 100. Last month, it was around a 39, to put it in perspective. Some bulls, though, are holding out for a relief bounce in crypto, but the next key level of support to watch, or at least the Fundstrat is watching this week, is 29,000. Guys, back to you.
Just going to ask you that question, Kate, about some of the technicals and the key support levels here. I mean, one of the other things you've reported so expansively on in recent times has been the level of leverage and the role that that plays in the cryptocurrency market, and then how that trickles over into other markets like equities as well. I guess key data that you're seeing right now around how that is adding to this risk reversal and this drawdown we're seeing in the price of things like Bitcoin.
Yeah, that's right. That has been one of the key factors that have added to these sort of forced liquidations. And when it does hit a certain level, you see stop losses and people needing to sell automatically. You've seen some automatic selling. It now does seem to be a little bit more even. A couple of weeks ago, we were really reporting that it was some of the bears really leading the leverage in sort of the options market in crypto. It does seem to be evening out this week. So it's a little bit less of a factor. That's not a real factor that analysts this week are pointing to as sort of a warning sign in the markets. So it's definitely still a sign, but it's sort of reducing. We're not seeing it this week as really one of the big factors to watch, but is still sort of a new phenomenon going on in crypto. A lot of people taking more risk and betting on the direction of crypto prices versus wanting to hold the asset as a long-term stable investment.
I mean, is it broad-based across the entire asset class? Or, I mean, we talk so much about Bitcoin and Ether, for example, but there have been all of these other types of coins, whether they're stable coins or whether they're some of the so-called meme coins as well. Has it been painful across the board, or are there certain outliers in this discussion?
Outperformers. Yeah, it has been across the board. You see some, they call them altcoins, some of the smaller cryptocurrencies. It really does tend to be this indiscriminate selling. Bitcoin is sort of the leader. It's actually outperforming some of the smaller coins. And then you see a lot of the crypto-related stocks, names like Block. You've got a lot of companies now holding Bitcoin on their balance sheet, including Tesla. You've got MicroStrategy. So it does affect some companies in terms of corporate balance sheets, and then even people taking their salary in Bitcoin. So you may end up seeing sort of the knock-on effects in earnings even, that they may have to report losses because they now hold Bitcoin on their balance sheets.
Kate, thanks for that. We'll keep a close eye on that. Meantime, let's bring in blockchain and crypto investor William Quigley, co-founder of Tether and Worldwide Asset Exchange. William, it's good to have you back. How important do you see this level here, the 50% drawdown from the highs?
Well, I'd say a few things about that. First, if you look at the halvening, the Bitcoin halvening, which began in May 2020, and frankly, typically the upswing in those happens for about 18 months, which would have been November 2021, right around where we peaked at about 65,000. We've come back from there to roughly 33,000 today. That is not unusual for Bitcoin to retreat after an 18-month period of going up post-halvening, but it should have stabilized somewhere between high 40,000s and maybe 50,000s, except for a couple of both geopolitical and governmental impacts that have hit in the past, let's say, 30 days. Those drew it down from roughly 50,000 to where it is now.
Right. Your point about large drawdowns not being new is a good one, and one that we keep in mind when we think about wicked price action. But the backdrop of reduced liquidity, certainly policy, less stimulus, rates going higher, not being near zero, that is a change from those prior drawdowns. Does that not mean that this time may be different, that stabilization may be tougher to find?
Well, first I'd say since 2016, we always forget this because Bitcoin moves so fast up and down, but since 2016, Bitcoin in any given rolling 90-day period has dropped 50% or more 14 times. So it's not unusual. There's always different factors that drive it. I do believe, though, what you're saying, there is something to it. In the most recent bull run, let's say from 2020 mid to now, Wall Street and a lot of other institutional investors got into cryptocurrencies, particularly Bitcoin. And I think what we've seen happen is they looked at Bitcoin very much as the way they would look at, let's say, a IPO, a recent IPO of a tech company that was still unprofitable, high risk, a lot of growth potential, but also a lot of potential for downside. And so when the Fed started tightening its monetary policy as a result of wanting to control inflation, and they de-risked, I think Bitcoin was one of the assets that in their models was classified as a tradable asset they would also like to de-risk. So that is new. Historically, for people who were in Bitcoin and other cryptocurrencies, it was looked at as an alternative or a hedge against these types of movements. But with a lot of Wall Street money in crypto now, it's behaving the way a lot of other assets that normally behave when the Fed tightens monetary policy.
William, I mean, it's such a key point in this discussion around the price action we've seen. And I wonder, given the fact that this is an asset class that has seen deep and dramatic drawdowns at times in the past, whether those past playbooks are going to apply now, if there's key factors or key things that could signal that you're seeing an actual bottoming out in the selling in something like Bitcoin.
Yeah, I'd say, it's really hard to predict where Bitcoin goes because so many things impact it, but it does follow a lot of patterns. It goes up and down frequently, far more frequently than any other globally traded asset. So that explains a lot of why we see even now when the stock market starts to have negativity in it, Bitcoin has it as well. But I'd say if you look at where Bitcoin and other cryptocurrencies have come since even the last 2 years, it's extraordinarily more useful. Look at NFTs. NFTs are the way Bitcoin and other cryptos have started to become mass market phenomenon. And if you look at NFTs, by the way, that's been decoupled from the other impacts, negative impacts on cryptos. In fact, in the last 7 days, while Bitcoin has dropped from roughly 43,000 to 33,000, NFT volume has actually gone up by about 60%. Roughly 5 billion in incremental volume. So we can't just look at cryptocurrencies as like a homogeneous asset class at this point. And of course, you have Ethereum, about half the value of Bitcoin, still very strong. A very big event in Ethereum is supposed to happen this year, where it shifts from its old model of proof of work to proof of stake. And that should make it more energy efficient and less costly to use. Also, of course, you have the metaverse. You have a lot more applications being done in a decentralized way. So there's a lot more activity being done now than there was, let's say, a year or two ago. But yeah, it still reacts to global events. On Thursday, you had the U.S. Federal Reserve issue a white paper, long awaited, about the stable coins and whether or not the U.S. government should issue one. And that dropped That dropped the price of Bitcoin because people were worried. And then now you have the White House signaling it's going to issue an executive order that I think brings it much more involved into managing the regulation of crypto. And I think that's what happened more in the last, let's say, over the week, in the last few days. We saw a lot of concern there.
Yeah, not to mention some headlines regarding MicroStrategy's Bitcoin accounting from the SEC on Friday. I do wonder, where do we think right now, what supply of crypto is underwater, meaning less than people paid for it? And what does that do to the erosion of the so-called entertainment value of trading it, which has obviously been a factor in the price action for at least the past year?
Well, people are in cryptocurrencies because they want to either use it for various decentralized applications, which are becoming increasingly popular. They're also in it as a tradable asset where they can get some appreciation. It moves so much that for most people, they don't have a lot of exposure to it. I would say most traditional investors have generally less than 5%. So it's not something that's going to ruin them if it goes down. And as far as how many people are underwater, I have not looked at the recent data, but there are a massive amount, far greater than 60% of people who are long-term holders, let's say more than 18 months. So the drop more recently, I don't think should be worried about too much. Also consider that the ups and downs of Bitcoin have started to be compressed. The last two times Bitcoin dropped 50% or greater, it took 95 days from peak to trough. And then the prior time, it was maybe 73 days from peak to trough. And then the upside was also decompressing. So it took far shorter period of time to go back up. So probably, I think the medium time for Bitcoin to recover from where it was before has been about 5 months. That's not that long. So if we think let's say $50,000, roughly $50,000 is about where it should wind up, then I'd say sometime before July of this year, we'd probably see it go back up there. Unless, of course, as I mentioned, the White House executive order brought a lot more fear around what they're intending to do. What I hope it's just is just trying to assign which federal agency actually is going to manage it. Because right now, that is not being done. There are multiple federal agencies.
Yes, can't separate the policy risk from the price, at least not right now. William, thanks for that. William Quigley talking about the decline in pretty much the overall market cap, David, of crypto, gone from 3 trillion to maybe 1.5 or so.
Yeah, well, talking about a decline in market cap, you can take a look there at the broader averages, of course. The S&P off its lows. The NASDAQ also had been down as much as 3% just a few moments ago. So not to call it a bounce, but not down quite as much as it had been. But we are seeing, many of the names, of course, that performed so well last year, going up significant heights in terms of multiples, even if they had earnings, retreating quite a bit. I mentioned Rivian in the last hour. We're taking a look again at that EV maker. It's getting some of its autos on the road, although not too many of them at this point. Remember, it had been a $100 billion market value, I think, briefly. It is down 44% this year. So that is just with obviously a few more trading days to go in the month. Rivian shares down another 10%, well below the IPO price. And remember, there were quite a few investors who invested in the private markets who were able to mark this up towards the end of last year as a result of that IPO. Wow, the performance that they were able to get as a result of that company coming public was quite significant, but it is down sharply. Remember Ford, we were talking about its significant stake. They're still up enormously, by the way, on that. But would they have been able to sell it earlier, they probably would have benefited a great deal. Tesla shares, Phil LeBeau has pointed that out as well. Morgan on Twitter, down about 17%, below a $900 billion market value. And then we get to Netflix, which reported very disappointing guidance last week. Netflix is off 40% now, or let's call it 39.2% for the year with that 8% decline you're looking at right there. So many of the names that we watched, although Netflix, by the way, had a decent year, but not the greatest performer, but many of the big high flyers, whether they be NVIDIA or AMD or the aforementioned Rivian towards the end of the year or Tesla, certainly backing off dramatically with this sell-off of late.
Yeah, I mean, Netflix down another 8% today. It's just very indicative of the broader, to your point, to the broader action we're seeing in the market right now, and the fact that you do have some of these high-flying or previously high-flying pandemic beneficiaries, so-called stay-at-home stocks that have sold off just so aggressively in recent weeks, and potentially could be a canary in the coal mine in terms of this idea of normalization and what that looks like in the equity markets in the midst of a Fed tightening cycle that could be potentially aggressive, slower economic growth, both here domestically and globally this year, and the like. So Netflix has definitely been considered an example of that. Also, your names like Zoom, like Peloton, which we've talked so much about and have sold off so aggressively. It's going to be interesting to see what earnings this week brings. We get more of the big mega cap tech names reporting results, but also companies from across industries, across sectors. Something like half of the Dow components, the blue chip stocks, will be putting out their numbers this week as well. I would also just note that the Russell 2000, those small caps, which we started the hour talking about, have now fallen more than 20% from the all-time closing high on November 8th for that index as well. So you could say there's a bear market playing out, at least in some corners of equities where the smaller stocks are concerned. And we'll see how it goes. Geopolitics are involved, the Fed's involved, earnings are involved, and then, of course, macro data, which has been mixed or disappointing, to say the least, Carl.
Yeah, PMIs today, not so good, although in Europe this morning, 59 on manufacturing was a little bit better than expected for the EU. We were looking for 57.5, but clearly our own were not quite as good. Markets are plunging an hour here into trade. Dow's off of the lows of about 750 to the downside, currently down 572, and we're right above 4,300. Joining us on the Newsline today, Art Cashin, UBS Director of Floor Operations. Art, good morning. It's a good morning to have you. To what degree is this a washout, if it is at all?
Well, it got awfully close. As you know, Carl, because you see my morning comments every day, about 2 weeks ago, I thought we were going to go into some seasonal selling, hopefully to bottom on the 24th, which would be today. And they came in. I have looked weaker on the opening, but then they began to pick up. They're trying to rally here, which classically time frame is pretty good between about 10:15 and noon is often a good time for these washout. You get a lot of them near the end of the month, and so that's why I was looking for the bottom, possibly on the 24th. If they sell them again and get down around between 800 and 1,000 in the Dow, I think that may qualify for that washout. I certainly like the spike in the VIX. That gives you a sense of a little bit of a washout selling, but I'd like to see a little bit more of throwing the baby out with the bathwater.
Right. Yeah, VIX above 30, raised some eyebrows down here. And then, 9-to-1 downside volume, Art, has historically been a decent signal. But is that valid today?
Yeah, no, I think we're reasonably close, Carl. I think there's a couple of things going. What he's talking about, Russia and Ukraine, I think that's a dangerous spot, but not an immediate one. Putin had to send troops down to Kazakhstan to protect the government down there, and the troops he had to send were among his most experienced. So that's left the guys up around the Ukraine, more the draftees, the conscripts. So I think I don't see a nearby overt move by the Russians. What you might see is a move, since you have the draftees up there. And China, I don't think, is going to make any overt move there. They want to get into the Olympics. It's his global show. He wants things going. You got the Lunar New Year coming up. So, yeah, we have those geopolitical dangers, but I don't know how immediate they are.
Hey, Art, days like this, after days like this for a few times over, people start to say, when's the Fed going to have our back again? Are they going to back off because of the market dislocation? You have any thoughts on that?
Yeah, I think it won't be immediate, but I think now that Powell has been reconfirmed, so we find out his his role at the Fed is not transitory. So that's going to give him a little latitude. I think the Fed and Powell are nervous. Obviously the selling has started before them, and clearly the selling is not directly related to them if you look at the bond yields, et cetera. But the Fed is very nervous about these things. So it might give them a reason to slow their step a little bit. I don't think they, too, want to be too overt about it. But believe me, I think they will have the markets back if things turn worse, if we don't bottom here and turn around, and they keep selling into late spring, early summer. I think you'll see a little bit of a difference.
You do. It's interesting. I mean, you could argue the opposite, though, that Powell feels emboldened to finally take the market on, couldn't you, and say, I'm going to do what I need to do. And, yeah, you guys can lose some money for a change.
I think, Carl, what he's doing now is playing for the history books. I don't think he wants to be the Fed chair who gets blamed for, even though he might not be the cause, for causing things. So I think he will remain cautious. Yeah, he's got latitude here, but I think he's playing for the history books.
Art, it's Morgan. I mean, you could say that there's kind of been three things that have been driving the market up until recently, and it's been copious amounts of monetary stimulus and liquidity injected into the markets by the Fed, which is now going away. Generous handouts from the federal government also going away. And then, of course, booming corporate earnings. Now, we've had a lot of folks come on our air and say they expect the S&P, for example, to finish this year higher, in large part because earnings will continue to be strong and margins will hold up. But if you take those other two pieces of the puzzle away, I mean, just how much is actually hinging on earnings here?
I think that's a very bright observation. I think the fact that you're going to begin pulling back, and it looks like the president and the fiscal stimulus will not be there as readily. So I think that's what the market's seeing. I think that's why you're seeing the market go down without yields going up. Everybody talks about they're afraid of the Fed and whatnot. Yields are not going up. I think they're looking at a stagnating economy, and some of it for the very reasons you just mentioned.
When you say stagnating, do you actually mean stagnation here, Art, or is reaching the point of demand destruction and finally getting some relief on inflation something the market will applaud at all?
Well, I don't know that it will be applause directly. I think what will happen is, and I do believe that inflation will begin to decrease. I think the supply chains will begin to work out here, particularly after Lunar New Year. I think those events in Asia will be critical, and the economy will have a different look after it. I think at first the market will look at it and say, oh, my goodness, is the economy really slowing? Only much later, when they see that it has not slowed greatly, but inflation is coming in, and then there might be a bit of a cheer.
Finally, we've been talking about crypto in the lens of risk assets overall, Art, but I wondered, does this change the structural narrative about blockchain overall, given how much institutional money has come in? And as Lloyd Blankfein argued on our air earlier this morning, use cases validated by people who have very large assets to deploy?
I think there's been a good deal of that. I mean, you can see on a separate note the non-fungible tokens. People were dabbling. There was, back to Morgan's point, that there's some excess liquidity around, and it's being eaten up. But I think the Bitcoin and what we're seeing here, this is a liquidation of risk going on, Carl. And, there's an old street when they've got to sell to meet margin calls and whatever. And when you get a market like this, you don't sell what you want to sell. You sell whatever you can sell. And sometimes that's your grandmother's necklace. So that's what we're seeing here. People are being forced to sell things they might not have wanted to sell just to make sure they stay liquid enough. So let's see if this rally at temp rolls over. This could be a very, very interesting day.
It's been a while, Art, since you've rolled out that line. Certainly applies today, though. Thanks so much. Good to talk to you. Art Cashin.
Thanks a lot. Bye.
Well, we're off the lows of the morning, which is really saying something when the Dow is still down nearly 500 points, or 1.4%, and the S&P is down 1.9% to 4313, the level there. And, of course, the Nasdaq still down more than 2% right now. But we're going to turn to defense stocks specifically. Some of the biggest names all reporting this week as risks of a Russia-Ukraine conflict continue to soar. So take a look at the iShares Aerospace and Defense ETF. This is ticker ITA. It, too, is under pressure today, down about 1.5%. It's lagged the broader market over the past 12 months, but with geopolitics in focus, it has actually outperformed. It's still down 2% now with today's sell-off year to date, but it has still relatively outperformed the S&P. Two reasons for this, as I mentioned, geopolitics, also the fact that you have seen this rotation into some of these beaten down so-called value stocks. So this week, we're going to be getting earnings from the prime contractors, Lockheed Martin and Raytheon Technologies. That happens tomorrow, followed by General Dynamics and Boeing on Wednesday, and then Northrop Grumman on Thursday. You can see it's a mixed picture for trading for these names this morning. While the conflict between Russia and the Ukraine could translate into more demand for more weapon systems in the near term, not just in terms of U.S. defense spending, but also foreign military sales, analysts are largely cautious on pure play defense names coming into the tape, many preferring aerospace names with commercial aviation exposure and the recovery play that could be happening there. So expect supply chain issues, possible labor headwinds amid the Omicron surge to be in focus when we get these results again. Also, DC's continuing resolution, which expires mid-February. Now, that has frozen funding for new programs. It's chipped away at the Pentagon's budget as, guess what? Higher inflation has meant unexpected billions more spent on rising costs. We talk about it in corporate America. It's playing out in defense or in government agencies such as the Defense Department as well. Guys, there's going to be some key factors to watch as 2022 unfolds, but it does go back into this broader market discussion and negative sentiment and selling that we're seeing in the market overall today.
It's going to be fascinating, not to mention all the other sectors that are going to report. We are going to get a healthy dose of FANG out of Apple and Microsoft today. By the way, David Goldman today says, look, we've done a look at Microsoft, and at least as the quarter goes, reiterate buy, target of 400, but a lot of it's going to depend on their view of how the enterprise and the consumer is going to hold up in the face of some of these pressures.
Yeah. Well, speaking of the overall market sell-off, again, which Morgan pointed out, we are off the lows, so to speak. The broader market, though, still deeply in the red. And, of course, those once high-flying stay-at-home names continue to tumble. Shares of Zoom, for example, are down 63% over the last year. You can see it right there, down another 4.5% today. Kathy Wood, though, well, she says it's not over.
The fear with Zoom is, okay, going back to work, this story is over. Well, it's not over. If their guidance is correct, and they issued it pretty close to the end of the quarter, so I think it's close, their revenue growth in the fourth quarter will be in the 19 to 20% range. We think their revenue growth rate will accelerate. That is when I think a lot of investors will get an aha moment. Wait a minute, what is going on here?
Joining us now is Wolfe Research's Alex Zukin. Alex, is there going to be an aha moment coming for some investors in Zoom?
David, thanks for having me on. So far be it for me to disagree with Kathy Wood here, but we don't think that revenue is going to accelerate. We think that we're actually forecasting revenue growth to continue to decelerate. We've got, close to a 15% growth rate next year and a 13% growth rate the following year. But something very important is happening at Zoom, and it's that margin story is starting to come out. And we do think that from a margin perspective, free cash flow margins are you're looking at almost $2 billion in our model in free cash flow in 2024. That's a 38% free cash flow margin. It's one of the highest in our space. And we think that's an area that investors are going to have an aha moment with the stock now trading below 20 times free cash flow. It's not going to be a 40-50% grower in our opinion, but can it be a 15 to 20% grower in a bull case scenario longer term? If they start cross-selling other products like phones and events and webinars and rooms, we think that's absolutely possible.
All right. So, all right, we're again, $2 billion, you said free cash flow 24. So not that far away. And we got a $42 billion market value. We're actually below that now with this bit of a decline, as you said, 20 times. So I guess you're saying buy it here.
Look, we're saying that if people can get, we don't think that Zoom is going away. It's one of the best brands in the world, in our opinion. We think they've got great products and they've got big markets. Clearly, the pandemic was a massive moment, a massive brand awareness and just connectivity episode for the company. We're saying that if you step back and you're an investor with duration over the next 3 to 5 years, companies that have the best margin profiles in the business, those are the companies that are going to continue to do really well. They're the companies that have outperformed significantly. We did a screen within our names. Companies with 20% or more free cash flow margin since November 9th have almost, outperformed the companies that have no margin by 3x. And that's a really powerful statement. And Zoom is participating to some extent we think on the upside, or they can participate when investors return to the segment.
So, Alex, we just talked about Zoom. How about some of the other names that you cover, since you do cover so many software and cloud names that were once high-flying and for which we've seen pretty stark sell-offs in general in recent months?
Yeah, look, we're of the opinion that this sell-off has nothing to do with software fundamentals, that we're in a macro-driven sell-off. And we actually went on record saying we didn't necessarily think that earnings was going to be a catalyst for our space, because the confirmation that fundamentals are solid doesn't really change the current reason for the sell-off. Having said that, where we think the fundamentals are the best is in cybersecurity. We think cybersecurity, names like CrowdStrike, names like KnowBe4, where you can get the fundamentals and you can get the margins. That's an area where we're really pushing investors. And then in enterprise software, similarly, names like Salesforce, names like ZoomInfo, names like Informatica, even Adobe and Workday, names where you can really start to get comfortable with free cash flow multiples, free cash flow margins, and still leading growth rates on an overall sector basis. That's where we're really pushing investors to. I think we got to get through earnings, but I don't necessarily know that's going to be the catalyst for the space.
I'm going to ask you a really basic question tied to those fundamentals, in part because they didn't seem to, until more recently, totally matter, because people were so busy chasing growth in a low interest rate environment. And that is how much onus to put on the tech companies that are actually profitable and generating cash flow right now.
I think you're seeing it in the returns. They're outperforming. Now, again, that means they're down less than. But we think that, again, free cash flow multiples form floors typically for companies, and revenue multiples form ceilings. We don't think there's anything wrong with these growth stories, but the ones that have demonstrated the ability to generate profitability, that's where we are focusing investor attention.
Hey, finally, Alex, I think it was on Friday, Citi directed its workers back to the office beginning February 7th. I wonder, does the return to office impact the trajectory of overall IT spending and the reinvention of IT, corporate IT, as they work through a hybrid model?
I think we're in a new world, and I think the hybrid one is the one that's going to prevail. And whether it's a 3-day in office, 2-day at home, or some variant or version of that, there's just a significant cost benefit for hybrid. Even for, you talk about the great resignations, the amount of CEOs that tell me that this has enabled them remote to hire in places that they were never able to access talent pools before. It's a huge positive, and it's a step change function. That's one of the reasons why we think the future of work and a lot of these collaboration names, it's not over. It's just a net new starting point that they're going to build from. So again, the first place we think this is going to matter on the return to work is cybersecurity, where we think that this new vulnerability, Log4j, it's digital code, that it's everywhere, and we're going to continue to see the threat vector increase, and therefore the cybersecurity budgets follow suit pretty meaningfully.
The metaverse may also present an opportunity for the enterprise in terms of remote work, but it would seem that perhaps some of the names like Microsoft and the bigger players may have a much more significant market share than a Zoom. Is that a threat to them?
Look, I think actually for the metaverse, clearly Microsoft with the recent acquisition is thinking heavily, but don't sleep on Adobe. Adobe has a position, we think, in the metaverse and in NFTs that isn't really well understood, but all the digital content that's created for the metaverse or for these immersive video experiences, that's going to have to be created on a platform like Adobe, we believe. So in terms of whether that's a headwind or a tailwind for Zoom, I'm not yet sure that collaboration has in the enterprise has entered the metaverse or will for a long period of time. But I do think that at some point they will need some vector of attack there.
Interesting. Alex, thanks for your time.
Thank you, guys.
Well, it's been a busy morning for the markets, of course, with the S&P down 2.3%, the Nasdaq down 2.8%, but also a busy morning for activism, something we haven't talked about that often. Two big names in focus this morning. Let's start with Kohl's, because that stock is up over 33%. It started as a potential activist play late last week. There's been activity in that name for quite some time, but it has now turned into potential offers for this company. Both from Acacia, which is associated with Starboard, the big activist fund, and then as well the private equity firm Sycamore. Our Leslie Picker confirming, I believe, has made a bid as much as $65 a share. For its part, Kohl's said it has received expressions of interest, and that's all it's going to be telling us at this point. Starboard's interest seem to be based not as much perhaps on changing management's approach completely as simply the idea that this thing looked cheap, and they seem to have followed through on that belief, of course, and their belief that perhaps brick-and-mortar retail's future is better than some would believe, certainly based on the future cash flows that they saw coming from Kohl's. By the way, I think you got, what, a 675 is the number I think I saw for consensus estimates for next year. It gives you a sense as to sort of where multiples are. Yeah, 675 for fiscal year 22. So that puts some perspective in terms of how cheaply the stock had been trading, even with now this significant move up. The other name, Unilever, let's take a look at that over the weekend, the FT, and then the Journal reporting the presence of Trian, one of the biggest activist funds out there, of course. My reporting on this indicates there have been no conversations that have taken place between Unilever's management and Trian, at least about Trian's potential stake in the company. No comment at all from Trian. So unclear at this point what they're looking for, whether they would try to follow the same playbook that they used to such great effect at Procter & Gamble. The only meeting that I'm aware of that took place between Nelson Peltz at Trian and the CEO of Unilever was last September in London, and it had nothing to do with any potential stake in Unilever by Trian. It actually was specific to that boycott that Ben & Jerry's currently has in terms of selling its ice cream. Remember, it's owned by Unilever in the West Bank and in East Jerusalem. That remains in place. My understanding is Mr. Peltz was meeting at the behest of the Israeli government to a certain extent with management to try to get them to change their approach there. But again, that was the only meeting that took place. So we'll see what develops here, Carl.
The activist conversation, we mentioned Unilever and Kohl's, didn't talk much about Peloton.
No.
And Blackswell, but Peloton is up almost 2% in a pretty rough tape here, David.
Yeah, this is not an activist that I'm familiar with. Obviously, Peloton's market value is far smaller than it was even not long ago. So a smaller activist, Morgan, can take what might be a sizable position, although it is said to be less than 5%.
Yeah, and of course, Peloton has that dual class voting share structure, which means that any kind of activist investor pressure in that stock may be limited. So we'll have to see how that plays out. Let's get to Dom Chu with a sector sort. He's looking at utilities. Dom.
Defense. Everyone's playing defense these days. Stocks in sell-off mode again today with the S&P at 1 point, trading more than 10% below its recent record highs. And so that so-called correction state. While every sector you can see behind me is trading in negative territory, we are seeing that relative outperformance in those defensive parts of the market that tend to hold up maybe a little bit better, relatively speaking, during bouts of volatility. And as you can see right back there, consumer staples and utilities, the two best performing sectors. That includes, of course, names like Duke Energy, also Eversource and American Electric Power, hovering between positive and negative territory. So watch those utility names They have been relative outperformers. We'll see, Carl, if that continues in today's trade with those dividend payers and less economically sensitive stocks doing some of the relative outperformance. Carl, back over to you guys.
All right, Don, thanks very much. By the way, VIX, which was close to 38, settled back a bit, back below 34. Let's get to Bob Pisani once again. Hey, Bob.
And that VIX over 35 or so, that's a 2 standard deviation point move, so that's a big move there. There's a real battle going on. 42.73 was the low for the S&P. We bounced off that. We regained almost a third of the losses and now slipping back again a little bit. So it's not clear where this is going to play out right now. Let's just take a look at the major sectors here. Early on, consumer staples, modest gains here, the usual defensive moves. Kroger, Clorox doing a little bit better. Healthcare holding up better, but energy slipped significantly today. And of course, ARC Innovation, compared to everything else, down rather notably. Just show the tech stocks here. And again, the same bifurcation where mega cap tech down 1% to 2%, but more speculative tech like Shopify and Block down about twice as much. That's a very typical pattern that we've seen many times here. What's surprising is the number of new lows, 450 at the New York Stock Exchange. We have not seen this in a long time here. Number of big tech names at 52-week lows. On top of that, Amazon, for example, PayPal, Skyworks, and even Twitter sitting 52-week low. I pointed out Amazon this morning, $3,200 just about a week ago. Now $2,800. Some big consumer names at new lows. You might be surprised, too. Not just Etsy. We've been knowing that for a while, but Walt Disney and Best Buy, Ross Stores, and even Starbucks, which is a pretty big growth name in the consumer sector, also sitting at a 52-week low. Starbucks been essentially straight down for a number of weeks. So the minute we hit 10% down, everybody messaged me and said, my heavens, this hasn't happened in a long time. And that's true. What's unusual that what's happened here is we haven't seen a 10% correction. They have fairly common, actually. I'm just putting up something that'll show you since World War II. Declines of 5 to 10% are very, very common. It's happened 84 times since World War II, and the average recovery time to get back to where you were has averaged about 1 month. So we're right in a very normal pattern. What's not normal is that we haven't had a 10% decline in so long. That's why people are sort of shocked. 10 to 20% declines are far less common, but even that's not uncommon. It happened almost 30 times, essentially, since World War II, and the average recovery there has been 4 months. So I guess the point here is that we have seen these many, many times before. The market has dealt with them. We're in some very unusual situations here right now with the Federal Reserve. Essentially, there's a lot of debate in the markets of whether this is some kind of rather cyclical move in the markets that we're seeing, or whether this is a secular shift, a longer-term shift that the Federal Reserve is instituting, very much like they did, guys, back in 2009. That ocean of liquidity going in was definitely a factor in why we had such outsized returns in the last 12 or 13 years. And a lot of people are saying now, if they withdraw the liquidity, it would be reasonable to assume we might have some periods where we'll be underperforming. Instead of 10% gains, we've seen 15%. Now perhaps we'll see less than 10% gains. This is where the market's debating right now. Guys, back to you.
Some crucial historical context that you just folded in there in this discussion, Bob. The other piece of the puzzle, the IPO pipeline, something I know you watch so closely. We've seen a number of companies that were looking to go public since the start of the year who have pulled those plans as well. Is the expectation that that's going to continue to happen amid all the market tumult, too?
The primary determinant of IPOs, how well they price, and indeed whether they go at all, is the state of the market. Nobody wants to go in a down market. So right now, this is going to be a very difficult moment for IPOs to happen. But given what's been going on in the SPAC market, you might start seeing in the middle of the year, and I think we'll get a more normal market in a couple of months when the Fed gets a little clearer in its intentions, I think you'll see actually a lot more interest in IPOs this year. And I think some of those companies that were considering SPACs might, in fact, turn to IPOs. I'm a little more optimistic on that front than some people.
Bob, thanks.
Okay.
Yeah, Bob Pisani, of course, keeping an eye on all things market-related for us. Speaking of which, you know, we're still down 2.3% on the NASDAQ. That's kind of been the key component that at least I'm watching. Questions, of course, Morgan, about, you know, how far the selling will go. I know plenty of hedge funds who've already had what would constitute a bad year, perhaps taking risk off at this point and just saying, I can't risk anymore, and not short enough to have benefited from this. So we'll watch that. Netflix shares, pointed this out earlier, but worth pointing out again, down almost 40% so far this month. $160 billion is the current market value. Of course, the guidance was pulled in dramatically by the company last week. You can see, though, those shares down along with so many of the other laggards there. Moderna, of course, a very volatile stock. NVIDIA, which hit over 800 billion in market value not that long ago, is now down below 600 billion. But Netflix also, by the way, taking Disney down, remember, because again, many investors paying or willing to pay a fairly high multiple for the prospect of direct-to-consumer, of the continued growth there and what that meant for these companies. Some of that put into question by Netflix dramatically lower guidance in terms of its own subscription additions in the coming year.
Yeah, to your point, some of the biggest losses that we're seeing playing out on a day like today are in some of the names that were among the highest flyers last year, or at least until later last year. Energy, by the way, the only sector now in the green to start the year. Everything else has turned negative amid this broader S&P correction. That's going to do it for Squawk on the Street. Tech Check starts now.
Good Monday morning. Welcome to Tech Check. I'm Carl Quintanilla with John Fort and Deirdre Bosa. Today, watch out below. The tech sell-off continues. Nasdaq's down another full 2% today, and leading the declines, ARK funds, Tesla, Netflix down another 7%. We're going to hit the next catalyst that might turn things around or send stocks lower again. The crypto crash, Bitcoin and Ether down by double digits over the past week after Friday saw 137 billion wiped out from crypto markets, Bitcoin below 34K, and social stocks losing some clout. The bears come after Snap ahead of earnings, D.
Yeah, Carl, we are going to start with that sell-off. Tech sinking yet again. The Nasdaq was down as much as 3.3%. It is now down more than 16% below its record close. And an ongoing debate here. How much of the sell-off has been rate-focused? How much is business fundamentals? Remember that late last year, guys, we got bad misses from the likes of Snap, Roku, Pinterest, Adobe, Salesforce. That all hit those stocks very hard and had nothing to do with the Fed or a shift to value stocks. Last week, though, it was Netflix and Peloton, both sinking on soft demand and weak user growth. This week will be a big one indeed. We will see who gets punished if they miss or even if they just don't beat by enough. Perhaps some upside surprises, too. We've got IBM earnings today, Microsoft tomorrow, Tesla, Intel Wednesday, Apple Thursdays. John, it is still early in the earnings season, but what we've seen so far, especially NASDAQ, the question of did it freak out the markets or is it a sign of more to come? I think that's what everyone's going to be looking for in this busy week.
Yeah, I think perspective is important here. I don't think we saw anything close to a bad miss from Adobe, for example. But, these stocks have been running pretty strong, some of them, based on arguably more than just their fundamentals. And you look at some of these stocks, we've known that they've been in a good spot for a while. I mentioned Adobe. AMD is another one. I could throw out Shopify. Those are companies that have positioned themselves very well over the past year plus, multiple years, in seeing how these digital markets are going to open up. But, Carl, they've been on a fantastic run, and I think now there's a question on whether there's an overall valuation reset happening here versus something else.
Meanwhile, guys, the market not getting a lot of comfort from lower rates. Got the 2-year back below 1, a theme that our Mike Santoli is looking into this morning. Hey, Mike.
Yeah, Carl. I mean, at this point, this latter phase of this sell-off really does not have a lot to do with day-to-day movements in yield. Now, I've been skeptical of this whole relationship. I think people just made too much of it being directly about yields on the way up and the way down. And if you take a look here, this is just a very crude way of looking at it, which is long-term Treasury prices have pretty much diverged in the last couple of weeks from what the NASDAQ 100 is doing. So this is the long-term Treasury price. Obviously, yields are kind of sideways over that period of time, and you still had this ongoing liquidation in the lower reaches of the NASDAQ as well, of course, as the big guys do. The way I guess I would frame it is you need to believe in a lot of things to pay 10, 15, 20 times sales for any company. You need to believe they have a great franchise, huge addressable market. They're going to get a big piece of it. The earnings are going to flow through. And maybe for a lot of people, you have to believe that the Fed keeping rates near zero is a big part of that. So I think it goes into the psychology as well as to some degree the valuation math. Now take a look here at a couple of big secular growth winners that were beneficiaries really in the last lunge higher in the NASDAQ. That would be NVIDIA and Tesla relative to really just the typical tech stock right here over the last several months. So, you know, we were already struggling in terms of the cloud stocks were selling off all the way before this, but you did see these big ramps. Retail investor favorites driven by stampedes of option buying, they finally are coming down. So to me, it didn't really have a lot to do with yields on the way up or the way down, or really what the Fed was going to do. There was just a collective enthusiasm that has now been pierced to a significant degree. I think the big question now is, where's the washout level? I really would have thought we might have seen indications we were there right now, but you're seeing stocks that made new lows last week that are actually still underperforming today. So we await that moment, guys.
Yeah, we certainly do, Mike. We're going to dig more into this and bring in Satori Fund founder Dan Niles. When he joined CNBC in late December, he said to expect a 20% correction in 2022. Dan, we are not there yet, but your call is looking fairly precedent. As you know, Mike was just saying that some of these names that have already sold off, they continue to fall further today.
Yeah, I mean, I think, unfortunately, the big difference, and we've been talking about this, obviously, since last year, is you have inflation really high, and people just forget how much of the market is just driven by liquidity, which some people take, you know, those stimulus checks and the Fed expanding their balance sheet, and some people buy crypto, others buy meme stocks, other people buy houses, boats, you know, and stocks. And so when that money starts to go away, you end up with this starting to happen. And the one metric that nobody really talks about is valuations. And we've been mentioning this for a while, but at the peak of the tech bubble, you take the market cap of the entire stock market, you divide it by GDP. That was at 1.4. That got up to 2 times at one point. It's down to about 1.8, 1.7. But, you know, the average for 50 years is 0.8. So if you've got a Fed that's very aggressive, you've got growth slowing down, you have inflation pretty high, and we've talked about why we think it'll stay high, you know, ultimately, I think the market's down 20%. I do believe with today's move, you know, we have a bunch of technical indicators we look at. We wrote about this over the weekend, but, you know, over 50% of them were signaling oversold. So as much as I'm going to hate to do this, I'll probably be buying some stocks today because, you know, human beings are horrible investors. You know, you're buying at the top because crypto is going to go to 100,000, and then you're selling at the bottom and freaking out because now you've got all this pain and you're trying to deal with it. So, you know, for us, we have over 30% of the portfolio in cash. We said it was our favorite investment coming into the year. And so we're going to put some more of that cash to work, and we'll see what happens.
Dan, how much of it? I'm looking around. GameStop is still above 90 a share. AMC still above 15. Bitcoin at the moment still a hair above 34,000. These aren't exactly like, I don't know, bargain basement prices by historical standards. So at what stage of this, if it is a valuation reset, at what stage would this be?
There's no chance I'm buying those. So what I'm talking about is real companies. So it's names like, you know, Facebook or Google, guys that make lots of money, lots of profits, that are market share leaders, that are profitable today, not 10 years from now, and not based off of some theme that, you know, you think crypto is going to take over the world. So for us, this is looking for real companies and more skewed towards services versus products. Because remember, in 2020, we had, you know, people were sitting on their Peloton bikes, watching Netflix, ordering groceries off of Amazon, and signing their documents with DocuSign. You know, hopefully by this time next year, I'm going to be sitting on a beach in Hawaii, on a surfboard, in a hotel, on a flight I just took. So what you're spending money on as this pandemic turns into an endemic, and we sort of learn to live with it, like the flu that kills 30 to 40,000 people a year, that's going to change what you're spending money on. And that's what you're really seeing. Don't forget, Netflix missed 2 quarters last year. Amazon missed 2 quarters last year. This is not new. The big new is the Fed's going to be very aggressive, easy money's going away, and the economy's slowing down from pandemic-driven stimulus. So, you know, yeah, I wouldn't touch GameStop or crypto, but the real companies, that's where we're putting our money to work in.
It kind of reminds me, Dan, of your famous call about Disney when the pandemic initially hit. I see it at 1:30 today. I wonder if that's going to be a name that you're going to take a look at. And also, more broadly, how you view like classical cyclical trades when clearly there are some hints, at least, PMI, retail sales, revolving credit, that households are under pressure, that growth is slowing.
Yeah, and you're absolutely right, Carl. I mean, Disney is it hasn't gotten to the level where I want to necessarily step in yet, but I was definitely looking at it last week, and we'll see. Because it's a reopening play, too, in the sense that, people aren't traveling to go to Disneyland because you're afraid of what's going to happen with Omicron. But I think, a year from now, we're going to get there. And you're right, the economy is slowing down, and it makes sense that it should, because you had $5.5 trillion in stimulus from government, measures over this pandemic. You had the Fed expand their balance sheet by $4.5 trillion in a very short period of time. All of that stuff is backing off. So I think you have to be incredibly selective. Valuations for the first time, arguably in a very long time, are now starting to matter, and cash flows matter because I think Mike Santoli talked about this. I mean, IPOs, et cetera, it's all shut down. So access to free money to fund money-losing businesses is gone.
He called it valuation math, I think, Dan. Is it possible, though, with the declines that we're seeing, especially in the markets today, that this could change the Fed's calculus, that perhaps some of the wealth coming out of the markets here could prevent the Fed, could actually have an effect on inflation, too, and prevent the Fed from raising rates as many times as the market is baking in right now?
Yeah, unfortunately, I don't think so. I think this is the 1980s when Volcker was forced into raising rates, even when the economy was slowing down, because inflation was really high. Because, I mean, the people watching your show, they obviously own stocks, but 45% of the U.S. population doesn't own stocks. So for them, their food bills going up, their rent's going up, the cost to put gasoline in their cars going up, and they're not benefiting from the inflation in stock prices, home prices, et cetera. So, we've talked about this on danniles.com, but you've got 3 million more jobs openings than you have people unemployed. That's going to keep pressure on wages. You've got, the amount of unsold homes out there at about 2.5 months. The normal is 4 to 5 months. So that's going to keep pressure on rents. So all of these things will keep inflation hot, which will make the Fed, which made a policy mistake last year by not raising rates, have to move more aggressively this year. And that's why we're still playing for the down 20% over the long term, even though I think the next 3 to 5% is up in the market.
And as you said, holding on to some cash. Dan Niles, thank you so much for joining us. We'll talk to you again soon. We should also note, John, that the NASDAQ is down more than 3% again, heading closer to the session lows.
It is indeed. And that's not all. Bitcoin losing nearly half its value since its record high in November. Kate Rooney is here with the latest on this crypto crash. Hey, Kate.
Hey, John. Yeah, cryptocurrencies have been slammed right alongside tech and growth stocks, like you guys have been mentioning. Bitcoin trading under 34,000 this morning. You've got Ether, the second largest cryptocurrency, seeing even bigger losses. Both of those, though, hitting their lowest levels since July. And a couple of factors here. It's partially a result of cryptocurrencies just becoming more mainstream. That was seen as a bullish sign as the asset class matured over the past couple of years. But it is a catch-22 as macro funds adopted Bitcoin. They're now turning to crypto as one of the first places they're looking to sell and get liquidity. And some of these guys, of course, are taking risk off the table lately. Bitcoin has been trading right in line with equity markets as well. Crypto and stocks hitting their tightest level of correlation since 2020. And analysts are also pointing to retail investors losing conviction lately. Glassnode this morning saying that the lion's share of losses are coming from newer buyers. They call those short-term holders who appear to be taking any opportunity, as they put it, to get their money back. Right now, only 32% of Bitcoin's market cap is held at an unrealized profit. So a lot of investors right now are underwater. That low profitability, sustained investor losses, as well as low investor sentiment tend to be the real signs of a bear market in crypto. And one way to measure sentiment is called the Fear and Greed Index. That right now, guys, is at a 13 out of 100. Last month, for example, it was around a 39. Leverage, another big theme we've talked about in recent weeks, is also climbing, and we've seen some changes lately. Noel Atchison of Genesis telling me this morning that there's been a spike in bearish sentiment in the options market. That's based on the options skew dipping and funding rates going negative. There's also been a lot of liquidations in the past 24 hours. More than 400 million in leverage positions have been unwound over the past 24 hours. Some bulls, though, holding out for a relief bounce in crypto, but the next key support level that FundStrat at least is watching, 29,000. Guys, back to you.
That level, Kate, keeps heading lower and lower. You know, the crypto bulls are such a vocal group, and it feels like they can kind of justify any sell-off. And I just wonder, Kate, what are some of kind of the most prolific names in the space saying? How do they judge this? I mean, we've heard for a long time that Bitcoin isn't a currency, it's a store of value, but now it's acting kind of like a high-growth tech stock. What are they saying it goes from here, the next catalyst?
Yeah, well, no, you're right about the moving target there in terms of sort of the next leg lower. But some of the biggest, most prolific names, and it's now a lot of mainstream sort of software CEOs that have gotten in early, would say, you know, we've seen this before, that there's been a crypto winter, and it's taken sometimes more than a year for crypto to recover to some of the other highs. But those who have been in the market for a long time recognize the volatility as a feature, not a bug. They say this is the way that it goes if you invest in cryptocurrencies. So these guys are long-term holders, long-term bulls, and are trying to sort of rally the troops you see on Twitter. And I think there's a lot of people who even recently in the past year or so started either taking their salary in Bitcoin, put some of their company's money into Bitcoin, and now it's sitting on their balance sheet. So it is sort of a different dynamic that we've seen. You know, there has been volatility before, but it's gotten a lot more popular. As I mentioned, macro funds are now involved, but there's no capitulation on Twitter by some of these big CEOs. They're sort of saying, you know, hold on, hodl is the term that they might use, but still bullishness on Twitter. And I think at this point, if they've committed so much of their career and reputation to Bitcoin, you know, nobody's saying at this point sell. So it's just a lot of bullishness out there, and you know, long-term investors. So we'll see how it works out, though.
Kate, thanks for that. Kate Rooney watching Crypto for us today. Meanwhile, as far as stocks go, was Netflix a canary in the coal mine for technology? Down 10% today, wiping out nearly all of its COVID-era gains. Joining us this morning to talk about that and the broader sell-off, longtime TMT investor Morris Mark of Mark Asset Management. Morris, it is great to have you back.
Thank you,
a lot of discussion today about how much larger, how much more engaged Netflix's audience is than it was before COVID began. Does it deserve the same share price?
Well, I'm going to put it this way. Netflix is not the first thing on my mind right now. We had a medium-sized position. We now have a token position. Maybe I didn't answer some of your question. I think it's a really good company run by really smart people. When they reported the quarter, they sent a message, and the message was, hey, we're going to have to spend more money, and we're going to have to defer the timing of the improvement of profit margins. So I think right now my concern is obviously much broader. We've cut exposure dramatically in my hedge fund so that our net investment position is modest, though we can be very flexible on that. And there's a message there. And we built a lot of cash in my equity fund. We're keeping the quality. We think the quality will perform well. I think the parallel might be 2008. 2008, they cut everything apart. 2009, anything that was really good came back better. I'm not saying that's what this year is going to be like, but what I am saying is that tactically, I think that's the way you have to approach things.
Morris, how are you defining quality in this market? How are you valuing companies? I mean, there's talk about fundamentals returning. What are the important fundamentals? Can you not invest in any company that's not profitable right now, even if its top line growth is exceptional?
Yes, you don't. You just don't. I think there are a couple of lessons here. Number one, you want financial staying power, okay? And I think that the first thing that happened, and this started in the fourth quarter, is that the market started to suffer indigestion. I think Jim Cramer put it very well this morning. It had 600 names. 600 names were issued in the last 12 months. A lot of them is SPACs, which is even worse, but a lot of names, a lot of paper came out. Now, in that paper, there's some really good businesses, but my criterion is really simple. If it ain't making money, if it ain't generating free cash flow, we'll pass. We'll watch it. We'll follow it. We'll see what happens.
Morrison, okay, am I hearing you right? So nothing that isn't making a profit. How do you make outsized gains then? You would have missed out on an Amazon, Tesla, countless others. You're looking for quality, but you could sacrifice some of those bigger gains that we've seen from remarkable companies over the last decades.
I think it involves hard work and research. We started buying Apple in 2006 and again in 2008, and we still own it. We have some Alphabet that goes back to the original IPO that we really came back into it in 2010 and 2011. So I think the criteria is a lot of this is in your gut too. You sort of know when you see something really special about a business. Right now, what's really special is companies that are generating tons of free cash flow, that have powerful franchises, and that are still growing very rapidly. Alphabet is still growing very rapidly. And remember, it operates throughout the world, except for China, okay? I can keep saying that about a lot of names. So that its opportunity is still open-ended, and there's a secular trend benefiting it. Because we're in an omni-channel world, which means people buy both online and offline, a lot more marketing, a lot more selling is done online, even though you end up in the store. And we like shopping in stores. Usually now when I go in a store, I know what I want. I know the style, but I just may want to try it on, for example. So I think you can buy some terrific businesses today, and we're not yet doing much buying. We've got it down to a level where we're going to keep what we like. We're definitely invested in our equity fund because that's what it's for. We're definitely invested in our hedge fund, but we've reduced exposure dramatically. And one of the things I think you got to realize now is because we can do it, everybody can do it. And the market's going to move fast both ways. And you got to figure out when it's real, when it's really going to get better. Okay? Because everybody's using the same way of hedging. And you've got to be aware of that.
Yeah. Finally, Morris, we should point out there's a few media names doing well. Fox up on this upgrade saying that they're well positioned to benefit from sports betting. Our parent Comcast and Charter saying the view on broadband slowdowns too draconian, and they get upgraded at RBC. Are you seeing things like that in your universe?
Yeah, look, first of all, I don't disagree with anything you just said. Fox is intriguing. We're not there, but we're looking at it. But we've been buying Disney, and it's a position we've had over the last couple of days. Now, we haven't taken a major addition. We're just not doing any major additions right now. But it's our way of remembering that Disney is a very cheap stock. Cheap. It's trading well below its strategic value. That's one of my criteria now in terms of looking at something. And I think the thing you got to remember about Disney, Carl, is that they own some of the world's most valuable real estate on a scale that's unprecedented. They've got 32,000 acres of property in the middle of the second fastest growing state in the country, where they represent the fulcrum of tourist destinations. And I'm going to agree with one of your previous guests. The pent-up demand for travel is enormous. Every time we go out or we talk to a friend, all they want to do is plan a trip. And I think that includes Disney World. So when you look at Disney's numbers, I'm just amazed, frankly. Maybe I'm not amazed because Brian Roberts is a lot older than the last time he tried this. He tried to take over the company, I guess it was about 10 or 15 years ago, and almost pulled it off. I mean, if I were him now, and I'm not telling Brian what to do, he's a lot smarter than I am. I called Blackstone and financed the real estate. Disney is unbelievably valuable.
Morris, it's always good to get your view, especially on a day like this. Thanks so much. We'll talk to you soon again.
You too, Carl. Thanks.
How's that for a gutsy piece of advice? Well, also, social stocks selling off today. Snap getting a downgrade this morning. Twitter and Pinterest with price cuts as well. Our Julia Borston checking in on the bears. Julia.
Well, John, social media stocks are plummeting right now on some downgrades. Snap under pressure, dropping about 10% this morning after Wedbush downgraded the stock to neutral, saying, quote, "We see risk to Snap's revenue growth targets stemming from IDFA headwinds." Those are Apple's ad targeting limits. They also see difficult comps from stellar growth in 2020 and 2021, increasing competition from TikTok in particular. Canaccord also lowering its price target for Snap today, citing the same issues with Wedbush and stressing the risks around those tougher comparisons. Goldman also cutting its price target on Friday. And Twitter, those shares are down about 5.5% after both Canaccord and Goldman cut their price targets on the stock. Goldman also cut its price target for Pinterest. That stock is down about 4% as well. Now, of all of these social media players, Meta is down the least, though it is still down about 3%. You see nearly 3%. Goldman did reiterate its buy and price target on the stock on Friday. Now, speaking of competition for all of those players with TikTok, just this morning, CNBC's parent company, NBC Universal, announced a deal with TikTok for the Olympics, giving it more valuable content to compete with the likes of Meta. Guys?
Julia, I want to go back to Snap because, yeah, I understand all the analysts are getting, religion about how they need to cut their targets and everything. But it was just back in late September that this thing was trading above $80 a share. And the story was that it was different from, your Twitters and even Facebook with the regulatory and data headwinds and problems that it faces. Snap has gone from 83 or so down to now below 30. Have the fundamentals of that company outside of IDFA and the iOS stuff that we've known about, has something fundamentally changed?
Well, certainly the fundamentals have changed. The question is, are Snap's strengths as strong as analysts thought they were back then? We will hear a lot more when we hear from Snap's earnings, which I believe are at the end of next week. But I think there's this question, John, is Snap really different? Can it be more resilient to the IDFA, those Apple ad targeting issues? Can its user growth remain strong as people get out into the real world more? Can Snap be the kind of app that is both useful for close ties and for friends when people are isolated, and also as people use the Snap map as they go out and about? And I also think as we talk about Meta, of course, formerly Facebook, Snap has been investing in augmented reality for a very long time now. Do those investments pay off in terms of targeted advertising, interactive advertising, using those lenses and other augmented reality features? So I think Snap has a lot of things that make it different from the other players. The question is, do they make it different enough? And what happens with TikTok? I mean, we can't underestimate the massive growth and draw of that platform. And we'll see if people are spending more time on Snap or on TikTok when we get those numbers next week.
Yeah, got you. It's lost almost 2/3 of its market cap in less than 6 months. So I wonder, off about 10% today. I wonder what's there. We'll see. Julia, thanks. Meanwhile, the payments space, another sector taking a hit in the broader sell-off. Our next guest sees opportunity there, but says investors need to be patient. That operating environment change is near and will benefit the stock. Some of his top picks are PayPal, Visa, MasterCard, and Affirm. Joining us now, Morgan Stanley analyst James Fawcett. James, welcome. Who's suffering the most unjustly here in the payment space, would you say?
Wow, that's a big question. Look, I think that probably the most controversy is around Affirm right now. Consumer credit business, you're seeing not only a normalization of credit behavior, but a rise in interest rates that's putting a lot of pressure there. We still have a lot of confidence that numbers can go up this year, but at the same time, we have to recognize there is a changing environment near term. But in the long run, there's still a lot of opportunity for them to grow their customer base and deliver financial services. But all the payments companies across the board, whether we're overweight or equal weight or not on any of them, are really getting hit and have been for the last 6 to 8 months.
Yeah, and James, you say that you're waiting for M&A. I wonder what you think has changed or hasn't changed in the last year or so. Certainly some of the valuations of the high flyers have come down. But, I recall when Visa was trying to buy Plaid and they came under regulatory scrutiny. Do you think that there's less of that in the current environment?
Yeah, well, when we look at Visa and MasterCard specifically, they're always looking for new technology acquisitions. We don't think it's as important for them, but if we look at the rest of the payments ecosystem, we do think that given the high levels of capital investment, et cetera, that acquiring these new technology companies that are entering into the payment space ends up being important ways to to improve the technology capabilities and the long-term opportunity sets for most of the companies. I think most managements have been reluctant to pay up for valuations, especially over the last year. As we've seen valuations come down, well, that may change, but we do think that that's an important way to create value over the long run for a lot of the incumbent players.
If not Visa and MasterCard, two of the biggest players in this space, then who, James? Who else has sort of the positioning and capital to do so?
Yeah, so we've seen PayPal, Square, obviously, with its acquisition of Afterpay. Some of the least expensive names in the payment space where we're equal weight, like FIS, Fiserv, Global Payments. These are all companies that we think could and probably should be doing acquisitions right now, but they've been reluctant because of prevailing valuations.
Hey, James, some of your peers on the street today on Affirm say that there could be some upside guidance on GMV, even though longer-term risks with credit checks and so forth. Are there names where you think maybe short-term there could be some relief based on fundamental elements of the print?
Yeah, I think Affirm, we would be in that same camp. Affirm's probably one of the names where we have the highest conviction that there could be a better outlook than what is built into estimates today. Remember, they started accepting Amazon, or Amazon, better said, started accepting Affirm late in the December quarter. Our sense is that could be tracking a bit better than had been anticipated originally. They also have a very nice relationship and partnership with Shopify, and we think that's starting to ramp. And just the overall demographics, it really favor their go-to-market. So I would tend to agree that Affirm, among the companies that we cover, probably has the best opportunity for near-term estimate revision.
Oh, interesting. We'll be watching that in the weeks to come. James, thanks so much. I appreciate that. A lot of attention on the payment space in the past few weeks. Take a reset here in just the past half hour. Dow continues to do a reset of its own, down about 670. We're just south of 4,300, about basically south of a 10% correction off of the all-time high on the S&P, and the VIX still elevated near 35. Let us sneak in a quick news update with Rahel Solomon. Hi, Rahel.
Hi, Carl. Try to make this very quick for you here. Today's sell-off getting added fuel from a report that U.S. business activity barely grew in January. IHS Markit's PMI index fell to its lowest level in 18 months. The group says that Omicron has hit output far more than demand. Oil prices also sinking on the report, crude dropping as much as 3.5% before rebounding. Oil prices are also being pressured by a stronger dollar. Energy stocks, some of the biggest losers today. All S&P 500 energy stocks are down. Even Halliburton, which beat earnings estimates and doubled year-ago profits with help from rising oil prices. Halliburton also hiked its dividend by more than 160%. One of the only big winners today is Kohl's. The retailer surging more than 30% after getting new buyout interest. PE firm Sycamore Partners reportedly offering $9 billion for the company. That is slightly more than a bid from Acacia Research made last week. You're now up to date. John, I will send it back to you. Hopefully that was quick.
Very quick and very valuable. Thank you, Rahel. The Nasdaq, meanwhile, down more than 3%, back near the lows of the day. Meme stocks and ARK funds both falling hard today and in the past few weeks. What a difference a year makes. Dom Chu, what's with this move?
It wasn't even a year, right? I mean, you take a look at where the highs were in many of these meme stocks and many of the stocks tied to the ARK Tech Innovation ETF and that particular ecosystem, the components there. We've seen a sharp move. If you take a look overall at what is driving some of the downside today, specifically within the NASDAQ overall, that pretty much sets the theme for many of these meme stocks and certainly with the ARK funds involved as well. Look at Netflix, Airbnb, CrowdStrike, Tesla, NVIDIA, some of the biggest names out there with regard to technology, media, that next generation of companies in the new economy. Netflix down 10%, Airbnb down 10% as well, CrowdStrike, Tesla, NVIDIA. You can see really what's driving a lot of the action to the downside. Now, if you take a look at how that's playing out with the ARK funds in particular, specifically the ARK Tech Innovation ETF, ticker ARKK, if you look over the course of the last couple of years, and this is a chart that's been making the rounds a lot over the course of the last 24 hours or so, this notion that Berkshire Hathaway, when it comes to a company overall, an industrial conglomerate, one that has a lot of financial interest in stock holdings, Warren Buffett, versus the ARK Innovation ETF, you can see, though, the early part of 2021, we saw the biggest gap in performance between the two of them. And all of a sudden now they've converged, meaning that in this tortoise and hare type situation, you can see that the ARK Tech Innovation ETF has now faltered so much so that, again, it's caught up to now where Berkshire is trading over the course of the last couple of years. That's something to keep an eye on just from an investment standpoint. It also kind of is indicative of that growth versus value trade. If you take a look at some of the stuff that's been really driving the action to the downside for that ARK Tech Innovation ETF and many of the portfolio holdings there, take a look at stocks like Robinhood Markets, DraftKings, Block Inc. over the course of the last few months. You can see the downtrend very much in place for many of these. Robinhood Markets down 70%, bigger than 50 to 60% declines for Block and DraftKings. So some of these holdings have really taken it on the chin. And if you look at the biggest names out there, remember, when we talk about these ARK Tech Innovation ETFs and the funds there, oftentimes the names that we talk about the most are names like Tesla, DocuSign, those other ones, Teladoc, because they tended to be some of the bigger weighted holdings in that portfolio. Take a look at Tesla, Teladoc, Zoom Video, Roku, Coinbase Global, all down anywhere from about 4 to 12% for Coinbase. A lot of the Bitcoin and cryptocurrency downside driving that downside move here. But that's the reason why you're seeing a little bit more of that kind of feel, that sentiment driving this tech and growth trade, and it's become indicative of what's happening with the ARK funds. In one way or the other, you're going to see a lot of those funds and those particular indices continue to suffer if these types of names continue to do that, guys.
Dom, do you have any thoughts on the nature of the volatility? We've been talking for a few months now about the number of retail investors getting involved in options, perhaps trading on margin. And there can be this mindset, as you know as well as anybody, that in a bull market, every gain is deserved and every drop in a stock is a theft. But what does the volatility, the nature of the volatility, tell us about how this is the same or different from what we've seen in the past?
So there are similarities. I mean, there's no doubt about it. The valuation side of things, the idea that there could be a certain sense of euphoria in certain key parts of the market that might be indicative of bubbles or that kind of behavior. It happened back in 1997 through 99, and in certain parts it's happening right now. But the one thing that we didn't see as much in 1999, as much as retail traders were a part of that particular move, we didn't see as much of the tools that were available to some of those traders to be able to take the kinds of fees that they have. We have seen it a lot more because of the advent of many of these trading platforms like Robinhood, like many of the traditional online brokers who have now offered commission-free trading. The interesting part about the moves that we are seeing right now, it's very severe. There's no doubt about it. It's a sharp pullback. But it hasn't come with any kind of real rigorous amount of volatility, right? The VIX is still, yes, 30 to 35, but it's nowhere near the kind of levels that we've seen during panic moves, especially during the pandemic lows. So you could make the argument that there's an orderly, so to speak, component to this relative to some other of the kinds of behaviors that we've seen tied to volatility. I guess it's going to be interesting to see whether or not you do see more volatile downside moves. Even in today's session, we've drifted lower, found some bids, drifted lower again. Whether it stays that way into the last hour of trading, that's going to be a key to watch.
Yeah, and Dom, we do see the NASDAQ comp now down 3.2%. That's a perfect lead-in because we're going to stay with some of the stocks that Dom mentioned. They are among the hardest hit today. Robinhood, he mentioned, meme stocks as a whole. Our next guest sees a trend among nearly every company that went through Robinhood's IPO access program that launched last year, reporting that those stocks are now down around 60% from their highs as a whole. Robinhood itself, IPO price was $38. It is now below $12 a share. And they're not IPOs, but AMC and GameStop, they're worth mentioning. They have both cratered and they're down double digits today. Joining us now, Ranjan Roy from Margins. Ranjan, you looked at the role of Robinhood and FOMO, how that played into the markets over the last few years. Easy when there was a lot of enthusiasm and exuberance, but some of those retail investors that got in are learning the hard way what some of those leverage and those names getting in early or at the peak leaves you with.
Yep, back in March 2021, Robinhood announced a new program that was going to give the everyday retail investor access into buying into IPOs in the name of democratizing finance, and it sounded great. But I went through the 20 IPOs that were marketed through this program, the IPO Access Program. They're down 40% from their first day of trading. And more importantly, they're down 61% as of this morning on average from their highs. Because what happened in every single situation, there was a pop. There was either first day of trading or within the first few days, and then a gradual and sometimes brutal decline, which makes sense. It introduced 22 million new users into the IPO process, millions of new buyers, and still a finite amount of shares being offered. Of course, you're going to see that kind of price action. And I think it's a really important thing to remember that as all these new tools were introduced, it completely changed the way a lot of these companies moved, whether it was like Brazilian fintechs like Nubank or Fancy Salad like Sweetgreen, and everything saw that same pattern.
Right. Ranjan, though, to be fair, it wasn't just Robinhood. SoFi introduced this as well. And I should also mention that the NASDAQ is now down nearly 3.5%. We've really seen the selling sort of accelerate in the last few moments.
Yep. So first of all, SoFi has a very similar program to Robinhood. Robinhood kind of came out big with the democratizing finance thing, but I agree. It's introducing this thing that seemed to be this kind of air of exclusivity in the past to an entire new generation of investors. And don't get me wrong, I was here in back December saying that the era of the story stock is over and the crash has already begun. But in 2021, IPOs in aggregate were down 14% 6 months out from when they started trading. That was across all 400 traditional IPOs. Again, Robinhood was down 40% from their first day of trading. So even on a relative basis, they performed a lot worse. But again, it makes sense given the specific mechanics of the program. And today's brutal. It could continue to be brutal. But we have to look at which are the stocks that are more vulnerable to these moves, given the types of money that had rushed into them.
Ranjan, when you look at the damage that has been done, really going back months, and I'm talking about a lot of the losers for 21 on the NAS, the Pelotons, the Chegs, the T-Docs, the Zooms, how much of that is at this point constructive, given that these names are not necessarily going to go to zero?
Yeah, I genuinely believe these moves are constructive in the sense that they're just, in some ways, a reversion to the traditional financial metric means. These are real companies that have real businesses, many of them, and they should be in a good position. But the question is, like in 2021, hodling, buying the dip, these were the terms that kept running through every single segment. But I think capitulation is the word that we have to keep an eye on, because who's going to give, when are they going to give, and how violently are they going to sell? We're seeing it today. We saw it last Friday. As you have the Fed coming in for liftoff and quantitative tightening, it's completely going to change the risk profile of everyone, whether you're sitting at home or you're some big pension fund, and who is going to be buying these stocks and at what level do they come in? Because again, Peloton's still trading at 4.5 times sales, and it's a decelerating business. That's not cheap yet.
Yeah, Ranjan, we always talked about these investors, right? And that it was a good thing that at least they're going into the markets because they're learning. And yes, in this moment in time, it feels like a very harsh lesson if you had bought some of these names at the top. But do you think that some of the newer retail investors will start to look at different valuation metrics, maybe go from price to sales to price to earnings, and perhaps exclude a lot of the companies that don't have any earnings that they have liked?
Yeah, I am a big believer, and I do think investing has fundamentally changed, that people aren't going to completely exit the markets. But again, in the future, what is a traditional software PE ratio, and is this Snowflake way above it, or is it, what companies are actually good value, I think will be the things people talk about rather than who has the most short interest and let's try to squeeze them. I do think investing is going to get better once people take the lessons that they're learning right now. But again, the only question is this just a reversion to the mean and that the froth gets shaken out, or could something worse happen? I think that's what we're all going to be watching, especially with the Fed this week and corporate earnings this week from the big guys. I think that's what we need to keep an eye on.
Yeah, well, something worse can usually happen. Ranjan, thank you. We will check in on more companies reporting earnings this week. Verizon and AT&T, those stocks have severely underperformed, but is now their time. Don't go anywhere. We'll be right back.
Severe sell-off on this Monday morning. Dow is down more than 800 points, almost down 850 a couple of moments ago. There are some pockets of strength. Let's bring in our Julia Borston to talk about, although the Disneys and the Netflixes and the Snaps, Julia, are getting hurt, there are some legacy media names that are fighting this tape.
Yeah, that's absolutely right. Comcast is a rare stock in the green. It's up about 0.5% right now, and that's on an RBC upgrade to outperform. RBC saying that they believe that concerns about subscriber growth are overblown and that there is more potential there. Now, and just looking at Comcast and putting it in perspective, Comcast, which is, of course, CNBC's parent company, that stock is up about 2.5% over the past 12 months, but outperforming a lot of the others in the media space, such as Disney, as well as others in the connectivity space, because, of course, this week we're going to hear from Verizon, AT&T, and then Comcast. And then next week, we will be hearing from T-Mobile. And I want to point out that T-Mobile is up 2% right now. And that's on a report that was just out today saying that T-Mobile has made gains, increased its lead over its rivals in terms of 5G speeds and availability. T-Mobile also has the advantage of not being part of that whole issue with the FAA delaying the deployment of 5G around those airports. So we do see T-Mobile shares up today, but just looking at the past year, T-Mobile shares are down 20% over the past year, and it has really been a rough year for the telcos as we go into those AT&T and Verizon earnings. AT&T down 10% over the past 12 months, Verizon down about 8%. And now the focus for those two in particular is really going to shift to what happens now that they've gotten rid of all those media assets. We expect that Warner Discovery deal to close relatively soon, in the next 6 months. So if that happens, what's next in terms of 5G, in terms of mobile subscriber growth? And it is an increasingly competitive space, guys.
Julia, it's interesting when I think about connectivity and the impact on these names. Overall, at least at this point in the economy, demand from consumers seems to be steady, and we know that there's been a shift toward digital consumption of all kinds of things. Omnichannel sort of necessitates some kind of connection, whether it be wired or wireless. So is that part of why analysts are perhaps warming in some cases to some of these names?
Yeah, I mean, you're right that everyone needs broadband, everyone needs mobile service for so many different reasons, and that has become even more evident than ever during the pandemic. I do think for some of these companies, there was this question of whether there was going to be a pull forward of growth during the early part of the pandemic, but we did get early announcements of those actual subscriber numbers from both T-Mobile and from Verizon. I'm sorry, from T-Mobile and AT&T. So we haven't yet gotten those numbers from Verizon, but because we've already gotten a sense of this user growth that's either in line or slightly better than expected, it's really about guidance right now. And I know we've been saying this for a lot of the companies. It certainly was true for Netflix, but what do they expect to come next? There has been so much competition. They've been investing so much in 5G. What's the next thing in terms of enabling them to gain share and also making sure that subscribers upgrade to these next generation services?
Julia, thanks for breaking it down on us. Let's get a gut check now on Google parent Alphabet. The stock is in the red this morning like much else. It is lower by about 3% at the moment. Google is facing more regulatory scrutiny, and this time it is all about location tracking. Attorneys general from D.C., Texas, Indiana, and Washington filing separate lawsuits against the tech giant, claiming it secretly tracked the location of users. Even after users turned off location tracking, Google continued to collect the data according to the suits. Now, of course, this stock was the big FANG winner in 2021, closing the year up 65%. It is now taking a hit in the sell-off, citing 12% since the start of the year, Carl.
Meantime, Shopify falling 27% just in the past week as it signals it may be increasing its logistics spending, down about 10% today. We're going to hit some of the e-commerce names after this break as we take a look at the market. Dow down 950 points. Meantime, SoFi, another name that got a burst of good news last week with the banking license, down 15%. That's about a one-year low. We're back in a moment.
Welcome back. Just a couple minutes ago, the NASDAQ touched session lows. It was down more than 4%. It's now up a little bit from that level, but that's more than 500 points on the NASDAQ. Those are numbers we're used to talking about with the Dow. The S&P off about 3.25. The Dow off the least, a little more than 2.5, but that's nearly 900 points. And checking in on Shopify, the stock falling about 25% in 1 week after a plunge on Friday. The Canadian e-commerce giant confirming reports that it terminated contracts with several warehouse and fulfillment partners, having its capacity for e-commerce orders as it shifts its strategy as it takes on Amazon. The stock at its lowest price since June 2020. Shopify is still strong here. A lot of analysts supposing that what's happening here is Shopify preparing for its own fulfillment service to take on more of these costs itself versus farming them out. Now, if you believe in the company's potential, and if you remember Amazon's playbook, long-term, that might not be such a bad thing, but short-term, especially based on the market action we're seeing these days, investors not taking it so well.
Yeah, and 25% in a week, actually, in this current market environment is about steady. I mean, you're seeing the sell-off just affect so many of these high-growth names. Of course, Shopify being sort of the poster child. But yeah, Carl, you're going to hear lots of calls for comparisons to Amazon. Shopify, of course, is the one that we talk about the most. But other companies that aren't profitable, that are going to point to say, you got to be patient in these markets, and that this kind of a sell-off, you got to remember that Amazon at one point was worth less than $2. So the kind of carnage that we are seeing. I'm also looking at Netflix down, wow, 40% just year to date. And it goes back to the conversation we had at the beginning of the show. What has really changed fundamentally? Could it be this much?
You mentioned Amazon down 3%, back to 2,700, guys. That's going to take you all the way back to June of 2020. Meantime, IBM earnings in just a few hours. I'm reminded, John, about that cut to sell over at UBS a couple of weeks ago. While some expansion was to be expected post-spin, the long-term average is better looking optically because of the spin, but still a lot of concern about the margin profile. I think UBS put a target of 124 on it. It'll be a good lens into what enterprise is looking like in the coming quarters.
Yeah, I think this is one of those earnings reports that's going to be important because if you're interested in cash flow, IBM over the past several years has been really focused on managing for profitability, right? So how does a stock like that get treated in an environment like this where top line growth, is not as exciting to investors and maybe a little bit more safety? Cash flow profits are. If you've got more of the safety and profits, but little to no top line growth, consistently, how does the market treat that based on what gets said? I don't know.
Yeah, I mean, it's been one of these stocks, right? The classic tech value legacy play hasn't really gone anywhere over the last 10 years, but it's times like these when the markets get kind of scared off of high growth that they look to an IBM. This Kyndryl spinoff will be interesting, guys, because it's going to make it difficult to really see what's underlying this growth at the new IBM and the results of those the cloud initiatives they've gone so hard on, Carl.
Yeah, and as far as we've mentioned this call a couple of times today, but there was one reiteration of a buy on Microsoft over at Goldman today. They keep their target at 400. We expect another strong quarter in fiscal 2Q as our conversations point to a healthy demand environment, including sustained momentum in public cloud adoption. That's going to be key, is getting at least some signal from mega cap tech that there is stability in demand in some of these high growth areas. And we're going to see how far that goes in reassuring some of the bulls.
Yeah, that's going to be a critical one, and that's coming up this week. One more thing, guys, before we go. After a 24% drop on Thursday, Peloton is reportedly attracting an activist investor, Blackwell's Capital, which has a stake of less than 5%, calling for CEO John Foley to step aside and for the company to explore a sale. On Friday, guys, we talked about Apple as a possible buyer with shares now below the September 2019 IPO price of $29. This all comes as Peloton hires McKinsey to help cut costs. CNBC reporting of production halts, and now the bike making an appearance in the season 6 premiere of Billions. Spoiler alert here, a major character having a heart attack after a ride. That is a spoiler. I want to know who that is now, guys. Peloton saying they didn't give permission for Billions to use its IP and add cardiovascular exercise helps people lead long, happy lives. Going back to the activist side of this, guys, remember, this is a tech company, what it calls itself a tech company going public. So, John, they do have those dual class shares. It would be very difficult to replace fully or push him out given the way that it listed.
Right.
And those shares are structured.
I mean, shouldn't Peloton worry less about fictional storylines about people having heart attacks on their bikes? At least they're riding the bikes, and worry more about investors having, heart attacks about the movements in the stock price based on their handling of the supply chain and their plans. Carl, I mean, I know perhaps not every piece of publicity is good publicity, but I mean, people, in fictional shows have heart attacks running in Nike shoes. You don't see Nike getting worked up about it. Our shoes are great. People don't have heart attacks in them. I mean, I don't know.
I think the more interesting comment about it, guys, is the idea that a lot of these stay-at-home names, people sort of anticipated that they would have a come-to-Jesus moment, but that would be because the pandemic was largely behind us, and that would lead to this environment of better spending, of more optimism about the future. But it's a difficult call when the Fed is just such a powerful dynamic. Yeah. Add on to that today the geopolitics, and it does sort of erase that reopening trade that so many of the bulls had hoped on.
Yeah, we talked so often over the last few years about the pull forward and these names, their valuations maybe growing too large, but I'm not sure anyone saw this kind of a hit this quickly. Should also note, too, the ARK funds, right? They are getting hit perhaps harder than anything else out there as sort of an indication, Carl, of that stay-at-home trade.
Yeah. The 4% decline, by the way, on the Nas, it is the worst day now since September of 2020, and it does take you back to levels we last saw in May. Let's get to the judge.
I appreciate it very much, Carl. Thank you. We do begin with breaking news. Welcome to the Halftime Report. I'm Scott Wapner. Take a look at the major sell-off underway on Wall Street at this hour. The Dow Jones Industrial Average now down by 800 points, slightly off the lowest levels of the session. But elsewhere, there is carnage all over the place. Take a look. The S&P 500 down 3%. It's the NASDAQ down nearly 3.5% as a significant amount of selling continues to take place within tech. It certainly feels like an all-hands-on-deck kind of day. Luckily, we do have the committee with us today, along with some special guests. Let's talk about who's joining us today for the hour. Bryn Talkington is here, along with Rob Sechin, Steve Weiss, Joe Terranova, and John Najarian is the co-founder of MarketRebellion.com. Our senior economics reporter, Steve Leisman, is here as well on the eve of the critical Fed meeting. Ed Yardeni of Yardeni Research joining in a moment. Tom Lee joining us just a little bit later on. But there is your up-to-the-minute market picture. Rob Sechin, I go to you first. As I said, there's carnage all over the place. You have technical damage. You have the VIX at 35. You have Bitcoin at 34. What are you telling your clients at this moment?
We came into the end of the year thinking the markets would sell off, Scott, and holding some extra cash. And while we don't think the worst is behind us, we definitely think there's stocks to buy today, and we'd spend about a quarter to a third of that cash today. As global growth and negative rates will eventually carry the day, and we also think that Powell threads the needle controlling inflation and not doing too much damage to growth, and markets are doing some of that for him already.
Steve Weiss, I got 78% of the S&P down 10% or more from 52-week highs. I've got the ARK complex down today by some 8%. Kramer at 10:34 this morning, so about an hour and a half ago, says 9-1 down. And maybe it's a little bit to Rob's point. Must buy, even if you hate it, hate in all caps. How do you see the market here, Steve?
You know what? I hate losing money worse than I hate missing a stock that may rally 5% from here. I'm still negative. I sold a little bit more this morning. I came in, with a boatload of cash and being short the indices, which I mentioned on Friday, and some other names, high-price names like Roblox. I don't think we're done yet. And what's most troubling is now we're seeing numbers come in, economic numbers like the PMI that came in a little light today. We're seeing that in Europe as well. So we're not there. You can have the worst of both situations here, which the Fed has to control inflation, has to raise rates. Yet the market, if you take a look at the bond market, it's telling you the economy's slowing. So you get rates going up while the economy is going down. That's not a great combination. So I prefer to stay in the sidelines, and I'd like to see the market consolidate before I start putting cash to work. I'm in no hurry.
Bryn, how much more pain do you think we have to endure before you feel comfortable buying some stocks? If not, now being the time?
I mean, I think that, well, first of all, the market is doing the Fed's bidding. And so, you know, the irony is the Fed is still buying bonds and quantitative easing, but the market is priced in not only 4 rate hikes, but I feel the market's priced in a really hawkish quantitative tightening. I think that what's not priced in, and, you know, Steve talked a bit about it and so did Rob, is that ultimately growth could slow this year, which with the market already bursting this bubble in high growth names or calling it a crash in these high growth names, what have you. I think that at these levels in the high growth names, if you're not looking at these high growth names, the real ones that are going to be sustainable, I think you're going to miss out on a big opportunity. And so, you know, we obviously own ARC. We have a position in there. We're looking at that technically to see a good entry point. But I do think that when no one wants to touch these, when no one wants to own them, there are some really good companies that are not only going to survive this, but thrive. But it doesn't feel good today. And this is typically these kind of markets where you have to kind of close your eyes, plug your nose, and do a little buying.
But to be clear, has the time to buy some of those ARC names come yet? It sounds to me like you're suggesting not necessarily, even though you're a holder of these and you've been riding them down and they've been punished so severely.
Yeah, well, I mean, I bought a little bit of Zoom last week. And so, as you know, I've been looking at these names, obviously listen to a lot of what Kathy says around those names, and then obviously doing our own research. I think a name like Zoom, which is down, 65%, you know, Zoom's revenue, Zoom is a profitable, cash flowing earnings company. Zoom's is not a DraftKings. Zoom's is not a pets.com. Zoom is not a Peloton. It is a real cloud platform. And so I think there's going to be some names here, like a Zoom, that I started nibbling on last week. I mean, I bought it, I think, at 156. I don't know, where is it in the 130s? But as these stocks go down 60, 70, 80%, that's when you start looking to buy them. And, you know, we own ARC. We'll see when we buy some more, when we across our book of business. But for last week, I started buying a little bit of Zoom.
Okay. So, Joe Terranova, I see you today as a buyer and a seller. And you can tell me what that says about your broader view, if anything, or if it's just a specific stock-related thing. You bought CVS and you bought Northrop Grumman. We could talk about the stocks you sold because there's some name brands in there, but tell me why you decided to buy those 2 stocks. And you can start with CVS first. I think there are people trying to pick through the carnage, as Kramer was suggesting. You know, when you get 9-1 down, sometimes you just have to buy. I mean, that's what history has suggested. So take me through it if you could.
Okay, so if you look over my left shoulder on my whiteboard, I have 3 letters, V, U, and L. And that's basically what I see when this process right now, where investors are focused on equity risk and they're de-risking currently, they're now going to suggest, okay, where am I going in a recovery? And CVS falls clearly in the V-shaped potential recovery. There's other names in there, Berkshire Hathaway, Merck, I already own it, Bank of America's in there, Honeywell, UNH, and then another name that I bought today was Northrop Grumman. The other 2 letters, unfortunately, Scott, investors have not grown accustomed to this in the last 10 years. And that's the U-shaped recovery, that's your non-profitable tech, that's your consumer discretionary, and then the L is your pandemic-specific beneficiaries. And you don't want the U, you don't want the L names. The market characteristic has changed so dramatically. There's this paradigm shift. You want to focus on names that you potentially can see a V-shaped recovery, and those are not the names that markets have rewarded the last couple of years.
I'm looking at some of the things you sold, though, and they don't suggest to me that they would fall within the L. Chipotle, you sold. Regions Financial, you sold. Waste Management and TJX. Why those names?
Yeah. Scott, those names I've sold. I haven't seen you since last Wednesday. All 4 of those names are stop outs. All 4 of those names are cutting losses. Just as last time I saw you, I said you could buy the Qs and Adobe and CrowdStrike with tight stops. I bought all of them. I got stopped out of all of them. I'm trying to keep the losses very, very small right now. But for the viewers who are focusing rightly on taking advantage with a long-term view of the dramatic decline you're seeing right now. I think creating these baskets and understanding what potential recovery shape it's going to look like is going to benefit you. And in the V shape, it's got to be a company that's got a low beta, high margin profitability, and a much cheaper valuation than markets historically rewarded.
So, Dr. J, you're like my sideline reporter on a day like this, right? You're down on the field, you see the action almost tick by tick, and you trade it that way, rather than some of the others who are, maybe looking at, the longer term, the next game, what the next couple of games look like. So I got the VIX, I said, at 34, 35. I mean, it's obviously spiking. What are you watching most specifically? And perhaps even more importantly than what you're watching, what are you actually doing down on the field today?
Well, and thank you for that, Scott. The VIX overall, it hit nearly 38 today. That's the highest level since January 27th, a year ago. So we're only 3 days off of a year in the rearview mirror when we were last at this level. Now, I thought this was interesting. There were a lot of folks that probably have some sort of a mandate, Scott, when they're managing institutional money to have some sort of protection. And those were some of the folks that were buying upside calls in the VIX. Somebody bought 69,000 of the February 110 calls and in the February contract, the future for February, because each one of these, of course, is a different future. But that future was trading at about 31 at the time. And they're buying the 110s. That's somebody that just needs to have that conversation that said, hey, I had some protection on, it didn't work. Because that one, I don't know how the heck that one's going to work for them, Scott. There were others that were very aggressively providing some sort of protection to the downside. You've heard me talk about the IWM puts that people have been buying for weeks, starting at 224 in the IWM. Today it hit 191, I think, Scott, a little bit ago. I have taken off half that position, rolled the rest down to the 190 strike. The SPY, SPY, similar thing, a lot of puts in that one, but we're not really seeing the sort of thing that you would see 2 hours from now, Scott, which is, as we will all discuss, I'm sure, margin selling. Because a lot of the liquidations that we're seeing right now, whether it's in Bitcoin and the cryptos, or whether it's right here in the stock market, a lot of these liquidations are by people pointing and clicking and or trading institutionally. And going through some institutional broker. The stuff that'll start hitting in that final hour of trade, I'll be really interested to see what that is, Scott. I gotta believe that they're clearing the field for that right now with the trades that you've already described with the Dow down 800 points.
We've gotten a lot of commentary, obviously, throughout this day and the prior days on how bad is the selling going to be? Is this the big correction? Are you going to get an even deeper flush? And at moments today, it certainly has had that kind of feel to it, and maybe that's what you're on the cusp of as we see the markets deteriorate as our show begins today. One of the voices that was on the network today was Professor Jeremy Siegel of the Wharton School, who tried to answer the question of how much more selling do we need to endure. Let's listen.
I certainly wouldn't be surprised NASDAQ to go into bear market territory, and the S&P, because it is top heavy with tech, probably go into deep correction territory. As you know, I've been saying that inflation is much worse than the Fed admits. Even now that they're way behind the curve, they've got to catch up.
I mean, Bryn, you've suggested that the market is doing the Fed's bidding in some sense, but the professor, and look, we're down about 17% from the highs on the NASDAQ. So, bear market, okay, so do we have a few more percentage points to go? Oftentimes, as all of you know, as well as everybody else, you have a tendency to overcorrect to the downside, right? I mean, the elevator down is a lot faster than it is on the way up. Is that the kind of environment we're in? Is the professor right? And he's been pretty much beating that drum that the Fed is going to have to be much more aggressive than people think because inflation is much worse than the Fed believes.
Yeah, well, two things, Scott. As we all know, markets ride up an escalator but come down, to your point, on an elevator. a lot of these high growth names probably don't get out of that elevator and flatline, but there will be definitely some ones that come out like it did in the tech bubble bursting. I will say on inflation, I think it's really important. CPI measures rate of change. And so if energy was 60 last year and energy is 80 this year, that's a 25% rate of change that goes into the CPI number. But as energy, just to stick with that, goes from 80 to 80, that delta isn't there anymore. And so I think that the rate of change of inflation will actually start to come down. But the absolute level of inflation, if you raise someone wage, if Starbucks went from $15 to $20 an hour, that's not coming down, right? And so I think that we will see CPI, that rate of change, come down, but the absolute level will stay higher. So I agree with Professor Siegel, but I don't think the market's really realizing that rate of change should come down in the second half of the year, which I think should help the Fed not be so hawkish that the market's pricing in today that they will be.
We'll see. I mean, on that note, Steve Leisman, we're on the eve of this critical Fed meeting. I'm wondering, as we slide even further in the stock market as we head into the meeting, how that may impact how the Fed is thinking. And you can make a case, I think, that the market has beaten the Fed to the punch, so to speak, in terms of tightening financial conditions. A further slide is the Dow Jones Industrial Average, Steve, is now down by more than 1,000 points. NASDAQ's down 4.5%. That's a loss of some 600 points. That if you are having a market event at the same time where you have a slowing economy, as all of the PMIs today would suggest, you could say that the market has beaten the Feds to its punch. The Fed's waited such a long time. How does it view all of that?
I mean, I think the Fed views that the market is doing what it needs to do for the Fed policy to be effective. This is what happens pretty often, Scott, is that the Fed signals it's going to do something. It essentially jawbones out there. You could actually make an argument what's taken so long. The chair pivoted on 11:30. That was November 30th. You had those hawkish Fed minutes on 12:15. The meeting on 12:15 and the hawkish Fed minutes, and the market has gradually come to this understanding that the Fed will do, considerably more to fight inflation. If you look at our, I'll give you a little preview of our CNBC Fed survey for tomorrow. You look at where rates are 1% for next year, for this year, and 1 3/8 or 1.38 for next year. On the way to 240 by 2024. If you look at those three data points, there you go. No, that's the Fed probabilities. Well, there's 4. So that's a half a point, Scott, more than had been out there. Is that there's the chart I'm looking for right there. And it's a half a point higher than had previously been expected. Not crazy tight, but the market is gradually coming to the conclusion that the Fed is going to be tightening by both raising rates and running off its balance sheet, and that market valuations need to adjust to a different kind of Federal Reserve. And you just ask yourself the question, was I better sitting all this out? No, because you started the NASDAQ on March 20th at 7,000. Now you're still, more about double 13,000, just not at 15,000.
The problem, though, Steve, is that it seems to me that the Fed has made already such a serious blunder, if in nothing else, its ability to estimate where inflation truly was. Remember, we had a walk-up to the announcement on the taper, which at the time we had said was the most telegraphed taper, perhaps, of all time. And then in such a quick period of time, it seems like we've gone from tapering to tightening, raising rates 4 times, and rolling off the balance sheet so you get QT. It seems like, and I've said this before, that we went from 0 to 800 miles an hour seemingly overnight, and the market has not been able to adjust to that, and it doesn't understand what to make of whether it can trust the Fed to actually get it right rather than make a tremendous policy error at this moment, Steve.
I think that's right, Scott. I think that, Powell did very well at fighting the last war. What was the last war? The taper tantrum. So the Fed telegraph went very gradual at the idea of telegraphing that it was going to be tapering and then maybe down the road not thinking about hiking interest rates. Meanwhile, the new war was raging right before the Fed, which was the inflation that came in part from its policies, in part from supply chain problems, in part from the fiscal stimulus that was out there. And I think Powell didn't really take account of that. I asked him at the last press conference, hey, how is it that you're fighting inflation but still adding to the balance sheet? And he said basically because of the market. It is kind of interesting, Scott. In that regard, you can say that what Powell did at that time was open the door, show you that the door was open, shine a light on the door, and give those little lights, LED lights that lead up to the door to the market. I'm not sure the market heard precisely what Fed Chair Powell was saying at that time, but you are right. It was late, and this is one of the more dramatic turns from policy, from not tightening to tightening that I've ever seen.
I've obviously been trying to speak to Steve and hearing from people within my Rolodex, one of whom has texted me, and I want to get your opinion on this. I'm not going to mention the name of the person, of course, but they say, I now feel like we are beginning to discount too much risk. It would be a massive blunder by the Fed to over-rotate on inflation. I think there's a real fear, Steve, as though the Fed is going to do that and make a policy error and not only crash the stock market, but the economy in kind.
Well, I will tell you this, Scott. At the moment, the Fed survey we're going to show tomorrow, tell you what I know now, which is that inflation is going to be higher, the Fed is going to do more, the stock market is going to be lower, but the economy so far looks like it's in there. And there's a lot of things, Scott, that are going to happen to this economy that are not going to be really contingent, I think, upon what the Fed does. And I'll tell you why. Look at what's happening with the automobile sector right now. It's at 12 or 13 million annual units. Why? Because of a chip shortage. That chip shortage goes away, you're going to run up to 14, 15, maybe 16 million units eventually, regardless of what happens to financing. Housing will be hurt by this. Consumers have low unemployment. They've had decent wage gains. I also think there's the possibility that the Federal Reserve doesn't do quite as much as out there. Goldman Sachs went a little far, I thought, in saying it could happen every meeting. There is the possibility, of course, that the inflation does trail off. One of your other speakers was talking about that later this year. And in that case, the Fed won't do as much. Right now, what you have is the best forecast out there, and all you can do is trade it.
We may go unabated to the end today, Steve. I just don't know. Just stay with me. I'm just reading on Twitter as well from our own Jim Lebenthal, of course, Farmer Jim. He's tweeting, today is capitulation. This is exactly what it looks like. I've started nibbling, but will do most of my buying in the last hour. Let me ask the folks in the control room if you can get Jim Lebenthal on the phone for us. I want to find out exactly what he's nibbling on. In the meantime, let's bring in Ed Yardeni. He's the president of Yardeni Research. Ed, it's good to have you back, especially in these turbulent times on the street. What are you thinking today?
Well, I think you got it right. The January 5th minutes, that was the December 15th minutes that came out on January 5. They were a shock to investors, and I think what really shocked everybody was QT. I mean, we all knew that, and they had prepared us for reducing their bond purchases and down to zero by March, and they also prepared us for at least 3, maybe 4 rate hikes over the year. But what came really out of the blue in the minutes, or at least the market took it that way, was that they were actually going to let their balance sheet run down. Now, think about it. They used to buy $120 billion per month last year in the bond market, and now they're talking about not doing that anymore. And on top of all that, I estimate an average over the next year, reducing their balance sheet by $95 billion. And the markets are really worried about whether the Treasury market can absorb that.
Is it well-found worry, or are we overdoing it, Ed?
Well, I think it's definitely a taper tantrum. It's pretty nasty. I mean, we've had nasty taper tantrums before. We've had 3 altogether, and the nastiest one so far was the one back in 2018. But this one is probably going to be as bad, if not worse. Yeah. Somebody asked me
I just want to point out, this is nothing like a taper tantrum. You have a 10-year hanging in there at 173. This is the market reacting, but the thing the Fed ultimately cared about with the taper tantrum was the bond market liquidity drying up. That was a dangerous set of situations, but I just think it's a little bit off base to compare this to a taper tantrum, at least in the bond market, which, as Rick Santelli points out, is behaving very well despite what's going on in stocks.
I didn't finish my thought on this taper tantrum. I think the big difference between this taper tantrum, if you'll allow me to call it that, and the previous three is that this one, there's no backing off on. I mean, the inflation problem is a problem. I mean, they can't do what they did in May of 2013, early 2016 and 2018 and say, okay, we're going to talk more dovish now. This time around, they have to continue to talk hawkish. But with what the market's doing, I think they're going to have to take it a little bit easier on the hawkish talk, especially since the market definitely freaked out over QT. And I think clearly in the press conference, you're going to be asking, and the other reporters are going to be asking, what is the deal with QT? Aren't you concerned that you've overdone it, that you're about to make a policy mistake, that's what the markets are saying?
You know, Joe Terranova, I'm looking at a headline today from Morgan Stanley's Mike Wilson, who says of what we're witnessing here in the market is winter, that winter is finally here. Remember, he has been calling for a fire or ice or both for many months, and he may be a little bit late in his ability to forecast exactly what's going to happen, but it does appear to be heavy snow now falling on the street. He says investor attention should now turn away from the Fed and to the ice part of our narrative, slowing growth. We've been monitoring PMIs and earnings revisions, breadth for signs the slowdown is bottoming, but it has quite a bit further to go in our view, and equity markets are not yet priced for it. How do you view that statement? You can take it a couple of ways. Okay, yes, the PMIs today across the board, all three reads were disappointing. But again, I just find it hard to believe that we're still going to be talking about a slowing economy in a month or two, despite the Fed. When we get on the other side of on the other side of Omicron, and you get into the spring and the summer, people are going to be traveling. They're going to be spending money. I mean, unless there's a massive market dislocation or something dramatic happens to the economy and households start feeling that much, worse. I just wonder whether this is a growth scare or a real, legitimate beginning of a slowdown.
So my response to that would be what we're doing right now is we're challenging the resiliency of the consumer and its spending and also profitability. And that's really going to ultimately provide the roadmap for whether this is going to be a double-digit correction or if this is going to be the onset of a longer duration bear market, which I don't suspect it will be. But we're not focusing enough on profitability and the forward guidance. Profit margins at all-time highs right now, Scott. Just think back to last week, Netflix's guidance was awful. If we're now going to go through a process where companies are going to be disappointing in terms of what the guidance is, well, that's another condition, a negative one, that markets are ultimately going to have to digest. So I go back to where I began the show. I just think this is not so much the stock market. This is more a market of stocks, and there's a little basket of stocks that you can begin, to Jim Lebenthal's point, to begin to buy those stocks. And then there's other stocks. I think it's like 2000. I wouldn't touch them.
Let's take a look at the major averages as we speak, which are continuing their sell-off. The Dow is just down 1,100 points. It's come a touch off of that, but nonetheless, you're looking at declines across the board today of at least 3%. And in the Nasdaq's case, you're near a 5% decline, what we've been calling the epicenter of the sell-off. What's unique today is that you're not getting it with accompanying rising yields. The 10-year note yield is at 172, but you still have a significant upset within the Nasdaq. What Jim Lebenthal has tweeted moments ago suggesting that today is capitulation, that this is what it looks like, and that he himself has at least started nibbling within the market. He's on the phone as we speak. Jim Lebenthal, I appreciate you calling in. I noticed your tweet. I want to know exactly what you're nibbling on. What are you telling our viewers to do?
Yeah, well, first off, I'm telling our viewers to buy, and I'll let them decide what to buy. Right now, I'm stepping in on Greenbrier, which is an old friend. Okay, this is a rail car manufacturer. It's a small cap stock. It's as cyclical a company as you can find. Also stepping in on Twilio just a little bit. Maybe that's my nod to Cathie Wood, but that's as far as I'm going I'm not doing any other stocks in her universe. Also buying Wynn Resorts. You know, it was 2 weeks ago that the news came out that Macau looks a heck of a lot better in terms of license renewal than it did just a little while ago. And then another small cap company in the aerospace sector called Ducommun. So what you're hearing from me, Scott, is this looks like capitulation to me. And, you know, when you have a correction, you have to have this washout capitulation day in order to bottom. And I think this is it. Now, John was saying something. Dr. J was saying that he thinks they're loading up at the end of the day. I agree. That's how it usually works. So I'm saying plenty of dry powder for the end of the day. But my punchline, Scott, this is a correction, not a true growth slowdown. You got jobs plentiful. You got infrastructure spending. You got Intel spending $20 billion on a new plant. There's just too many good things going on for this to be more than a correction. And I'll pause there because I don't want to keep droning on.
Just hard to really know what a fair value on the market is, Jim, in a new environment in which we find ourselves, and that is what may end up being a significant policy change from the Fed, the likes of which we haven't witnessed in a minimum of a couple of years. It's hard to know what the right numbers are.
You make a fabulous point. And I would say two things in response to it. You're right. We never know what the valuation is. I'm not trying to be David Tepper on on Christmas Eve 2018. But I will say that the market right now, based on reasonable estimates for this year, is trading at 18.5 times this year's earnings. It's not cheap, but my goodness, it's not expensive like it was when it was 21, 22 times. And something that's been going around for a while on the show, and I hear it talked about today, is the market's doing the Fed's dirty work for it. You know, this keeps up, and the Fed will back off. I mean, Jay Powell remembers the fourth quarter of 2018. How could he not?
Unless, Steve Leisman, he can't. Because inflation is ruling the day, not the market itself. Steve?
Yeah, I mean, I'm not sure why the Powell would back off here because of what the market is doing. I hear a little bit of conflating in this on this conversation, Scott, and I don't think it's totally wrong, but I think it's overdone, the conflating of the stock market with the economy. You have the stock market, in my opinion, going through a reevaluation because of a changed outlook for the Fed. But I don't think that creates a need to completely reevaluate what looks to be at least the forecast now for something around 4% growth this year, which would be about double the potential. I still think you're going to do
Steve,
well.
You make a great
I think
point.
it was Joe said who. Yeah. Just real quick, I was going to say, Joe pointed out earlier, profit margins are at all-time highs. You could have some decline in that and still have a very profitable stock market, but not profitable companies, but not necessarily stocks at current levels. You can adjust here without having a panic at the Federal Reserve or a need to back off where he's at right now, I don't think.
Unless, the problem is, and it goes back to what I asked you, Jim Lebenthal, to what degree does the Fed tightening impact the economy, the stock market, the wealth effect, and all other things, and ultimately the multiple on the market? It's a difficult question to ask, as we've been talking about this valuation reset now, seemingly for weeks, and certainly by the day. It continues to occur, particularly within the tech stratosphere. Just don't know what an appropriate valuation is for some of those stocks that got way ahead of themselves on the upside, just as they have on the downside.
Scott, regarding the Fed, this is one of those moments. It reminds me from the scene from Something About Mary, where the guy says, "I've got a great business proposal. Remember 10-minute abs? How about 9-minute abs?" What I mean by that is this is a time frame, and we've seen it before, Steve. You've certainly seen it before, Scott. You have, where everybody just falls all over each other to make more and more provocative prognostications about what the Fed will do. You go back a month, 6 weeks ago, we weren't talking about quantitative tightening. We weren't talking about 4 rate hikes. We weren't talking about 50 basis points. Now it's every week, right? 2 weeks ago, Goldman Sachs was content with 4 rate hikes. I think this weekend they went to 5. It's kind of like, you know what, give me a break. I don't need to go to 8-minute abs. Inflation shows signs of rolling over right now, both in goods and in wages. And sure, the Fed's going to raise rates, but the idea that right now we're locked into 4 or 5, I think, is folly. Now, that's my personal opinion, and I'm acting on it with my money. If I'm wrong, We'll find out, but I hope I'm being clear in my opinion.
I appreciate you sharing your opinion, Jim, with our viewers today. We'll talk to you soon for sure. In the meantime, I want everybody to stay with me. Sit tight if you can. Steve Leisman, you included. Ed Yardeni, please stand by if you don't mind. Let's welcome in another one of our headliners today. We do have the Kinnikos founder, Jim Chanos, with us today. He's with our Leslie Picker. It is a CNBC exclusive interview. This is taking place at a conference, I believe, down in Miami. Leslie, are you with me? And Jim, are you there as well?
I am. Thank you, Scott. And thank you, Jim, joining us from the MFA event in Miami today. An important day to have you here and get your perspective. I'm curious just to kind of kick things off. Obviously, the market declining at a voracious pace here. Do you believe this to be short-term capitulation, or do you think there's a deeper decline in store for us here?
Well, thanks for having me, Leslie and Scott. I have obviously no idea. The excesses we've seen in 2020 and 2021 are in the process of being wrung out, and I don't know that you've been talking about the Fed for the last, I guess, half hour. And what it might do, but I would just point out that the Fed, as Steve Leisman said, is concerned about the real economy and may not be as concerned about the stock market. We had a Fed that was easing throughout 07 and 08. We had a Fed that probably more important for this discussion was easing from the second half of 2000 into 02, 03. And yet the S&P went down 40% and NASDAQ went down 80% after the dot-com blow-up. The economy had a mild slowdown. That was it. So there's no preordained route here connecting necessarily Fed policy with how you're doing, in your mutual funds. They may diverge, they may not. At my firm, we're comfortable being long the indices and being short, a lot of kind of the craziness. I think that's still going to be kind of the way you want to be. I think you want to avoid a lot of the stuff that's still trading. I mentioned earlier this morning at 50 times 2022 or 2023 earnings. There's a lot of those, and they're not necessarily in tech stocks. There's a lot of sort of mundane businesses that have, after 10, 12 years of a bull market, are trading at just really, really expensive levels for what they are. And I think you got to go through your portfolio and just sort of say what really is cheap and what's necessarily just down. They might not be the same thing.
So what are you doing with your portfolio today? Are you covering any shorts on these declines? Are you adding to certain short positions? How are you trading today's market action?
Well, as you see, I'm not in front of a screen. I've been at the MFA conference this morning, but my traders, we have price targets, and if something is hitting our price targets, we would be covering it on the short side. We'd be adjusting our hedges. I think we've been slightly net long for most of 2022, about 10% net long, but that's sort of 70% short, 60% long. So we run, in our hedge fund, as Scott knows, just a more traditional hedged book. And that was very, very painful in 2020 and early 2021. But it's been a lot less painful, obviously, since mid-year last year, as a lot of sort of craziness has begun to be wrung out of this market. I would note also we're at the one-year anniversary of the meme stock craziness. And those have round-tripped, which is sort of the unspoken part of the whole meme stock saga, is just how much the wrong lessons were learned from that. A lot of hedge funds that are in this room, basically shied away from idiosyncratic shorts and just hedged their exposure using indices. And I think actually the meme stock insanity of the first half of 2021 was kind of the top in those types of stories. And those are the kinds of companies that are been under pressure since really the summer of last year.
Yeah, just to follow up on that, does that indicate that you're not concerned about the potential for short squeezes at this level? I know, to your point, short interest has declined to near record low levels given some of the activities that we saw a year ago this week. People were concerned that they would be in single stock idiosyncratic situations that, despite fundamentals, soared beyond their controls. Do you think that's no longer an issue at these levels?
So I've been doing this for a few years, Leslie, about 40. And one of the interesting things, one of the things we built our business on is the fact that actually stocks with high short interest, where fundamental short sellers have come in and looked at the business and said, this is silly. This stock is trading at 10x where it should be, or 5x where it should be. Those stocks historically have underperformed the market dramatically, except in early 2021, late 2020 and early 2021, where owning those stocks was the right thing to do. That you wanted to own the worst companies, the worse the fundamentals, the more that factor affected performance on the upside. And as I said, I think that was sort of the end of that happening, not the beginning of it happening. In that those types of companies over longer cycles, not month to month, week to week, have dramatically underperformed the market. And so I think that for people to have rushed into those the way they did was really a sign of speculative excess, not just in those names, but maybe in the market and in the highest valued part of the market itself. And I think that that is being unwound now in a major way.
Yeah, and clearly certain investors are probably kicking themselves for not having more short exposure to start this year. Scott, I want to bring you into the conversation.
Les, I appreciate it. Jim, it's so good to have you back on our program. I'll ask you, I guess, to take your short seller hat off for a moment. And I know at least at one point, and forgive me, I don't know if you're still on the board of the New York Fed. Are you worried, just as a statesman of the market, if you will? As you said, you've been doing this for 40 years. You've seen a lot of cycles. You've had a lot of conversations with a lot of people, policymakers and otherwise over the years. Do you worry today about the Fed making a policy error?
Let me correct you. I was not on the board of the New York Fed. I was on the investor committee for about 10 years, and I'm no longer on it. But
gotcha. My bad.
Look,
okay. I appreciate you clarifying that.
No worries. But look, like anybody, we watch Fed policy. I think the Fed made a big error in 2018 when it blinked because the stock market was down. If you go back and actually look, real GDP was roughly 2% in the fourth quarter of 2018 and 3% in the first quarter of 2019. The economy really didn't slow, despite the fact that they had begun tightening. But the stock market went down, and the junk bond market went down, and the Fed blinked. And so that was a preview for what it was going to do, obviously, in 2020, correctly, in response to the pandemic. But hitching yourself, as Steve Leisman kind of talked about a little earlier when I overheard the conversation, to the stock market is a very dangerous thing to do. Sometimes it sends the right signals, sometimes it doesn't. And I think that the idea of a Fed put, and the Fed is going to always be there to bail out my bad investment decisions, is really not a cogent investment policy to hold on to for a long time, because it may happen and it may not. And I think that at the end of the day, we all obsess about the Fed and what the Fed's doing, but the fact that it will bail out the stock market at some predetermined level of losses, I think is a very dangerous idea to uphold.
Leisman, you want to just opine on that since Jim mentioned you specifically, and that seems to be the conversation of the moment in the midst of what is a sharp sell-off in stocks, and what implication that might have on Fed policy, if any, Steve?
Well, when Chano says nice things about you, all you really want to do is take a victory lap. So I'll just let it sit there for a minute. But really, the story I think this time is the Fed needs the market to do its bidding. And the more the market does its bidding, the less the Fed has to do. I do think this time around, the put strike price, which, of course, we could have an argument as to whether it even exists, which is at what level the Fed would come in. I think it's a little lower this time for the stock market, in part because the bond market has been quite so well behaved, and other parts of the economy are marching to a pandemic tune more than they are to an interest rate tune. We've talked a bit about that, Scott, how so much of the economy is really on a pandemic schedule. And you talked about it earlier, like what's going to happen on the other side of this Omicron wave? You're going to have people going out again doing services. So you're going to have this continued acceleration in parts of the economy, regardless of what happens with interest rates. So I think the Fed is going to be less sensitive this time around than it would be. Yes, there are levels that do bring the Federal Reserve in for two reasons. We've talked about these a lot. The first is the systemic risk issue, and the second is the issue of the blowback of lower stock prices on economic growth if it gets too bad. I just think the Fed's tolerance this time around may be higher for lower stock prices.
Ed Yardeni, do you agree with that?
Well, I do. I think, as I said, in this situation, the Fed really is not in a position to back off the way it was in previous taper tantrums. And I think the Fed can tolerate a weaker market here. They're not going to come in and say, okay, we're backing off. They can't back off. And I think what the market is concerned about has been, I think you said and others have said, is that the Fed really has already made its big mistake, and now it's going to have to try to figure out how to work it out without doing more damage. And its big mistake was just being overly easy last year for too long and not recognizing that inflation was more of a problem, or at least not marketing it as a transitory phenomenon. They didn't know that, and they shouldn't have said that. They should have said, you know, we've got a problem with inflation. We're not sure whether it's going to be. We're not sure how long it's going to last, and we have to start talking sooner rather than later about moving towards a more hawkish stance. So, I'm in sync with both what Steve's saying and what you said before.
And Jim Chanos, you know, Leslie really hit on what I think is the most interesting point as it relates to you. Now I'll ask you to put your short seller hat back on. When she asked you, you know, as a short seller, I'd love to get a psychology lesson on this. When you've been short a bunch of names and they have such a severe dislocation, many of them, as we are witnessing now, is the tendency to step on the short even more, or to take your foot off the gas and cover? And you may not get the bottom tick that you once had in mind, but in such a severe and quick, and this has really been quick, downturn, particularly in NASDAQ and some of those technology names, are you covering more than you're pressing?
Well, it depends. As I said, Scott, we're stock pickers, as you know, so it depends on the name. And if something has collapsed, we will be covering it. We're buyers on weakness and sellers on strength. And so, but what I will tell you is there are just an awful lot of names in our universe, both in the U.S. and globally, that are, you know, only slightly off their highs. And we're all looking at the damage that's occurring in the NASDAQ and some of the growth names, justifiably so in many cases. But there are an awful lot of companies, as I said, that whether they're reopening plays, whatever they might be, that the market has run into that are probably dramatically overvalued here. And so I think that you have to look at it, as Jim Lebenthal said earlier, on a stock-by-stock basis. In our hedge fund, we are still slightly net long, but I think the beta of our shorts is higher than certainly our index long. So we're pretty hedged. But I don't mind being long the market at 18 times earnings and short our stuff.
Sure. John Najarian?
Yeah, I just want to, number one, agree with Chanos and Yardeni, Scott, about what they see as far as, you know, the Fed waited way too long. But I don't think it means that the Fed has to stop what they're doing. I think they could just kind of give us an indication that the people that are calling for 5 rate hikes this year and an accelerated QE are probably not going to get what they want. The Fed will do what they have to do. They did wait too long. But I'd love to hear either Ed or Jim speak to the idea that the Fed can do a number of things without ceasing on that move against inflation. They could not eliminate QE, and they could more or less indicate that 2 rather than 5 are what we should be looking for. I think the markets and the economy would be better off with that outlook, Scott.
Yeah. Ed Yardeni, I'm going to let you run as we wind down. We've got about a little more than 10 minutes to go in our program. I do want to touch the market picture once again. And Ed, I so much appreciate you being with us today and sharing your perspective with the investment committee and certainly our viewers. Let's take a look at the major averages one more time this moment. Down 918, 921 or so on the Dow. 33.3 is where the Dow Jones Industrial Average currently is. The S&P 42.57, that's 4,257. That's a loss of a little more than 3%. NASDAQ has come off of its worst levels. Remember, at one point today, it was approaching a 5% decline. It was pretty ugly in the NASDAQ. It still is by all accounts, obviously, down 525 points, 13,243. And we do watch yields on this eve of what is a pivotal Fed meeting. The 10-year note yield is at 172. Steve Weiss, you have something for Jim Chanos before we let him go as well?
I do. I'm actually surprised, Jim, that you said you're comfortable buying with the market PE at 18 times when we really haven't overshot yet, to your point, and the valuation umbrella that we benefited from with those high PE stocks made normal stocks have a high PE as well. It seems sane. So why wouldn't you wait, given what the Fed's going to do, and I think we both agree on that, until the market comes down a bit lower? It's not very comfortable. It's still at a premium to what historically trades at 18.
Well, Steve, you forgot the other part of the balance sheet. I'm selling stuff at 50, 60, and 70 times.
I guess so. I guess so. But I'd wait in that long side also, Jim.
Yeah. Hey, Leslie, do you have one last thing for Jim? Again, and I so much appreciate you bringing this interview for us as well. Why don't you wrap it up for us?
Thank you, Scott. No, I appreciate you allowing this interview to take place as well. Jim, just one more question, kind of going back to what we were discussing about the retail investor margin debt levels going into this recent sell-off at or near record highs. What do you think is going to be the broader impact with regard to kind of the retail investing community after these losses, after we kind of sift through the damage? Do you think that they'll still continue to be active participants here?
I'm worried about that, Leslie. It's a good question. In fact, I've talked about it a little bit in my talk here at MFA. I mean, if you go into Wall Street Twitter and you look, given the fact that, as I mentioned, the meme stocks have pretty much round-tripped, the amount of cognitive dissonance that I see in the retail investment community, and I know it's only somewhat representative, but it's pretty broad. And the amount of just anger that these retail investors have toward the SEC, toward hedge funds, to whatever, after having made just awful investment decisions, quite frankly. And I'm going to be very frank about that. I mean, people buying AMC at $72 or buying GameStop at $400 and openly crowing that they don't care about fundamentals, and then completely, wanting to blame others when they lose money in these trades. It's a little bit frightening. And I think it might be a good case study in behavioral finance going forward. But I do think that a lot of the advent of retail trading in vehicles like Robinhood or whatever that made it very easy to buy stocks or buy options, we're going to see the flip side of that coin going forward. I think a lot of people have lost a lot of money, and that's before we even get into crypto. And I think that is going to be, and it is very reminiscent of what I saw in '99 and 2000 with the advent of day trading and the first time we saw online brokerage. And those investors, by and large, never came back. And I know Gary Gensler at the SEC is warned about this, and others have warned about this, but I still worry we're going to learn the wrong lessons from it.
Yeah, I think the plight of the retail investor is something we'll be paying a lot of attention to in the weeks and months ahead. Jim Chanos, thank you so much for joining us from Miami. We really appreciate it.
My pleasure. Thanks for having me.
Scott?
All right, Les, thank you so much. Jim Chanos, of course, our thanks to you as well. Steve Leisman, my thanks to you. You'll be a busy man over the next 48 hours. I'm sure we'll see you again on the halftime report over that period of time. We are going to take a quick break. I still have unusual activity from Dr. J I need to get to. I have a couple more trades that you need to know about. We've got finals, all of it on the other side of this break. We're off the lows. It is still a very rough day on the street. There's red all over the place. We're back on the halftime report in 2 minutes. All right, it's unusual activity time. Dr. J, tell us quickly what you see today.
All right, Scott, a whole bunch of speculation in the airline stocks, just out of the blue. United, Delta, American. So I'm going to cite United because March 46 calls, bought, with that right about $40 a share. Second one, Scott, here's a little hope for people. Last Thursday, the VXX, that ETN, was trading about 19. Today it spiked over 25. They're buying puts in the VXX, thinking it comes back down by February, Scott. So I'm in those as well.
Okay. I appreciate that, Dr. J. Noting as well as we continue to discuss the markets in the few minutes that we have left, Joe Terranova, I'm noticing here Bitcoin is now turning green. Interesting there. It's been, correlated to risk assets for such, it seems, a long period of time. So Bitcoin looks like it's gone green. Keep our eyes on other parts of the market, too. What are you going to be watching over these final few hours, Joe?
Well, I think as John spoke about before, the last hour has been very important. That's where it seems to be there's a lot of inventory for sale. And I think it's important to understand volatility is here to stay, Scott. I think this is going to be a year right into the midterm elections where we see above average volatility.
Yeah, I should also let you know, I promised you a Tom Lee interview today as well. We've been trying to connect with him. Technology, unfortunately, is not cooperating with us today. So if we can't do it today, hopefully we'll hear from him in the next day or so. Just wanted to give you an update there as we see the VIX at 36. Bryn, again, same question to you. Over these last few hours, is there something specific that you're going to be watching for?
Well, I think John and Joe, hit on it. Is you want to see if all of a sudden everyone's going to pile on and the hedge funds and the CTAs are going to sell the close. But ultimately, this is starting to get, I do agree with Jim, starting feeling like capitulation. People are really uncomfortable, and especially in the high growth names, just like last year in early 2021 and late 2020, people said energy was uninvestable for a bunch of different reasons. Fast forward almost 2 years, it's been the best performing asset class. Today, people are saying high growth tech is uninvestable. Let's see how long that stays. But for today, I want to see what kind of capitulation or lack of we have going into the close today.
Yeah, it's certainly, Joe, it's interesting to think about all of this. You know what, Joe, I'll get you in a second. I want to hear from Rob Sechan. Forgive me, Joe, I haven't heard from Rob in a while. And Rob, I apologize for that, but I'd love for you to opine, too, in the few minutes that we have left on what you're going to be looking for over these final few hours of this at least day.
Yeah, I think, last week markets behaved terribly, selling off at the end of each day. That's not a great sign. I was like Jim, hoping to see a capitulation day like this. I think it came really early. I would have liked it to have happened a little later because I still think there is more time that we need to digest the pivot in the Fed's stance. And remember, markets desensitize the news that's out there for a long time. And I think the Fed has done a good job in putting this out there, and markets will eventually desensitize to it and repivot and focus on the growth that we think we're going to see. And that growth is going to be global. And hopefully, inflation is outweighed by a global growth and negative real rates.
Hey, this is what I was wondering, whether, you guys were going to have a look at certain things in the market that had just overdone it in your estimations. And Steve Weiss, they just told me, our producer, Patty Martell, just told me that you just bought Facebook.
Yeah, I didn't just buy it. I bought it a little while ago. It struck me that the stock was down, I don't know what the lows, didn't get the lows, but down 13, down 12 when I bought it. Just seemed ridiculous. It's a great trading stock. If the market doesn't rally, and I'm still negative, I'm not getting positive, then what's my downside? Another couple of bucks, but if it rallies, then I pick up a quick $10, maybe $8. So that's why I did Facebook.
Just meaning in the last several minutes, but thank you for correcting me nonetheless, Steve Weiss, since you have to be so exact. Yeah. Dr. J, final trades. Why don't you start us off?
Marvell, Scott, bought it during the show.
Okay, Joe?
Amgen.
Okay, Bryn?
Viper Energy, it's come off a couple bucks.
Okay, Rob?
JP Morgan, got hit lately. We still like it a lot.
All right, Steve?
Facebook, just way too cheap.
All right, guys, I appreciate it. Dow's down 832 or thereabouts, as I see. That does it for us. I'll send it to the exchange.
Thank you very much, Scott. Hi, everybody. This historic sell-off continues. January is on pace to be the 10th worst month ever for the NASDAQ. We're down 15% and in total down about 17% from those November highs. The Dow was down more than 1,000 points at the lows in the last hour. It's in the red for what could be the 7th straight day. We'll unpack all of these moves. We'll also talk about some of the global pressures contributing to the sell-off. And Peloton has in many ways been the poster child of the sell-off, though it's had plenty of its own problems to deal with. Now an activist firm wants to oust the CEO. We'll have the latest. And the other corporate targets, you can see them behind me there, that are under pressure. Peloton, by the way, has been also a bit of a tell for the market today, and it is back in positive territory. It's up 2.5%, Dom, so we've got that.
That activist story, Kelly, as you mentioned, is probably one of the few places that you're going to find some green at all in this market right now. Just a few moments ago, before I came on set here, I was looking at the S&P 500. There were roughly only about 16 or 17 stocks in the green in the entire index. The S&P 500, roughly 20 stocks in the green right now. Gives you an idea of how broad-based the sell-off is. Again, the NASDAQ composite has been arguably the epicenter of this, right? The growth trade, technology trade. As you can see here at the lows of the session, the NASDAQ composite is down 476 right now. That's 3.5%. It was down around 670 points at the lows at one point today. So again, off the lows of the session, but even then, we're still down 3.5%. And by the way, if you look at this sector heat map behind me, check that out, because technology, communication services, and discretionary are pretty decently, by far, the worst performing sectors out there. If you want to take a look at some of the stocks at the center of the sell-off so far today, the worst performers have been high growth oriented ones. Take a look over here. Moderna, the worst performing stock in the S&P, a COVID vaccine maker, but one that had run up a lot during the course of the last couple of years. Netflix, continued weakness there. Subscriber growth, a real concern there. Nvidia down about 8% right now. Meanwhile, what's working? Consumer staples companies like grocery store chain Kroger and then Dollar Tree and the dollar stores up about 2% right now. And we cannot forget what's happening with this kind of risk aversion trade and what's happening with the cryptocurrency side of things. Because if you look at Bitcoin and Ethereum, yes, Ethereum Ether has had a bigger run over the course of the last year, but the orange line and the white line respectively, Bitcoin in the white and Ether in the orange, are now down roughly 50% from their recent record highs. And just to give you an idea of the one-day action in the last 24 hours, the estimates, Kelly, are that roughly $130 billion of market cap has been wiped out of the entire crypto space. So watch those and, of course, all the associated stocks that go along with them. I'm talking Coinbase, I'm talking Robinhood, MicroStrategy, Block, PayPal, and others. So certainly ones to watch there. Cal, back over to you.
All right, Dom, thank you. My next guest says the sell-off is revealing some pockets of value. Joining me is David Bahnsen. He's the Chief Investment Officer at the Bahnsen Group. David, welcome. What do you buy today?
Well, it's getting to a point where there's quite a bit that one could buy. It's not so sector selective. We'll see if that full capitulation comes. It's interesting to me, Kelly, that energy is still up on the year, even with these last 5 or 6 days. And it's further interesting that bond yields are dropping and, in fact, have dropped about 13 basis points in the 10-year over the last 5 days. So this whole narrative that equities are dropping because the Fed's raising rates and the bond yields going higher is completely inaccurate. The stocks are dropping because certain parts of the market got way overpriced.
So, but would you agree that the catalyst for the correction is the normalization and the Fed's tightening?
No, I would not. I think that the fact that the Fed was going to be raising rates this year was known a month ago, 3 months ago, 6 months ago, and not just known, really known. Smart money, dumb money, retail, and everybody knew there was going to be some form of tightening, some form of normalization. I actually don't even really agree with the word normalization, although I definitely know what you mean by it, and I agree with that. They're headed towards a place of a more normal path. But I think normalization would have a Fed funds rate much more than where they're going to go, and a normalization of the balance sheet would get us back to $4 trillion. They're not even going to get close to that. So they're going to be tightening on the margins. But no, I think the catalyst here is that valuations got stretched, and valuations always have to adjust. It's just we never know when.
So what are your conclusions about the Fed from all of that? It sounds like you want them to be more aggressive than what the market is currently even talking about.
That's a fair way to put it, but I don't think it's that I want them to be, because all I can do with client capital is invest around what I believe will be. And I do not believe the Fed is going to be more aggressive than they're saying. And in fact, I don't believe they're even going to get to 4 rate hikes this year. I think they'll end up chickening out at around 3. But look, the high yield bond spreads as of this morning were only about 290 basis points. Credit is not yet reacting to this sell-off. I assume things have widened a bit in the last few hours, but not by much. 2018 was sort of the level where you saw what happens. Credit spreads blowing out and the Fed responding. We're not even close to that yet. So I think the Fed will do a marginal reduction of balance sheet through roll-off, and I think they'll get about 3 rate hikes done this year.
You also sort of describe this, it sounds to me, as a healthy, maybe a needed correction, certainly in some parts of the market that had, run too far. So you said you like energy here. It's still green on the year. What else is interesting to you? Where should people go as this kind of recalibration continues?
Well, it's tough for me to answer because I really believe people should go now where they should always be, which is in higher quality. We're not big speculators. And I do think, Kelly, most of what we're seeing right now is speculation getting hammered. And so what we call at our firm shiny object investing. You see crypto down 50% from a very recent high. This is not the stuff stability is made of. So we prefer companies that have stronger balance sheets, and that could be in any sector. We're not anti-technology. I talk on your show a lot about liking old tech companies that have good, dependable earning streams. Some of those FANG names were very expensive. They've come in a lot. Some haven't yet. So the primary criticism I have is of the real shiny object stuff that was just purely speculative, way ahead of its skis, and now has gotten slaughtered. We have no appetite to go into those types of names. We want to focus on quality throughout this year.
Yeah.
And for us, that means dividend growing names.
Quick final word. It's been a rough month for the financials, which should be a big beneficiary. Yeah. You still like JPM, you like Truist. What would you say here about the prospect for financials to perform well and for rates to, I mean, you tell me what you think they're going to do then.
Yeah, I mean, I think it's interesting, the narrative that a wider yield curve and having the long end go higher is supposed to help financials. JP and Truist, more so JP, are down on the month. We would absolutely be buying there. And the two names that have really gotten cheap in financials are not the big banks, but asset managers. Blackstone and Apollo have gotten very cheap as well. So we really like those financial names, but we would have liked them even apart from the sell-off. Now they've just gotten more appetizing.
Very interesting. David, great to have you here today. Thanks for your perspective.
Thanks, Kelly.
David Bahnsen with the Bahnsen Group. Speaking of bond yields, 2 years went up for auction at the top of the hour. Rick Santelli is here with the results and the way it has affected yields. Rick?
You know, this is a very strange auction. First of all, I'm going to give it an A-, which is a pretty good grade, and you'll hear why in a moment. 54 billion 2-year notes. The auction yield, 0.99%. It was a bit lower than the market was trading in one issue market, lower yield, higher price. That helps the grade tremendously. Let's go through the highlights, shall we? 2.81 bid to cover. That's a biggie. That's the best since April of 2020. But here's the metric that really caught my eye. Indirect bidders, okay? Foreign entities, the ones we really should be paying very close attention to, 66%. That's the best since the summer of 2009. The one fly in the ointment were direct bidders at 9.4%. That's the weakest since March of 2020, but it's well below 10 auction average. If you look at 24.6% for dealers, that's pretty solid. So one bad metric, several extraordinarily good metrics, A-. And what is it telling us? It's telling us Wednesday last week, the 20-year, aggressive bidders. The 2-year, you talk about the biggest dagger falling from the sky, short maturities, most likely tied to the Fed. And everybody's talking about the Fed. Oh, my God, they haven't really done anything yet. So investors really stepping up, thinking the current activity may somehow affect the way the markets are trading, maybe this week's Fed meeting. But in the end, the two topics that I'm hearing the most of today is geopolitics and the balance sheet. If you really want to do something, quit buying more treasuries now. Kelly, back to you.
We will have more on geopolitics in just a minute, Rick. In fact, let me ask you, though, because what David Bahnsen just said was very interesting. The main market narrative right now is the Fed has sparked this sell-off because of its tightening, and so everyone's speculating if they're going to have to back off because the market's down so much. Bahnsen said that's not what's happening at all. These stocks just collapsed under their own weight. They ran up too much, in which case it would have no implications for the Fed backing off. And if anything, maybe they maintain or stay aggressive and hawkish.
That all sounds very easy to say, and I don't necessarily disagree with the logic. But the Fed and the free put with equities, that goes back to Alan Greenspan. I'm not so sure how much nerve they have, but I completely agree that somewhere along the line since 2007 and 2008, and all the sins committed against the free market where people actually have price discovery, there has to be a cost, there has to be pain, and we are experiencing that right now.
All right, Rick, thank you. It's good to see you. We appreciate it. Rick Santelli. As people try to make sense of global growth, China has all of a sudden become a spot of concern. As they continue to battle COVID, health officials in Beijing are in full emergency mode, especially with the Olympics approaching. Eunice Yoon is there with the latest on the ground. Eunice?
Thanks, Kelly. Well, COVID testing tents like the one behind me are springing into action all over Beijing. More districts in the city of 21 million people are requiring that residents get tested. In fact, 2 million people were tested on Sunday alone. Now, that testing was conducted in a part of the capital that had the heaviest concentration of cases, which is only at about 24 at this stage. Now, authorities are also tracking down anyone in the city who has recently purchased, and just in the past couple of weeks, any type of medication that treats fever or other symptoms. So it could be as simple as ibuprofen, and then those people are getting text messages to alert them to get COVID tests. Officials are especially concerned about two big events that are coming up in the next couple of days. First, there's a Lunar New Year holiday. That's going to start in about a week. It's a heavy travel period and a big shopping period as well. And then, of course, a few days later, it's the Beijing Olympics. That's going to begin. And already, Kelly, 72 cases have been reported inside what is supposed to be a closed-loop bubble among the staff. Kelly?
Well, everyone watching to see what happens there, not just for that event, obviously, but the implications for growth in the markets as well. Eunice, we appreciate it. It's great to see you. Eunice Yoon reporting. And pandemic-related lockdowns have been slowing growth in China, leading the central bank to cut rates. And it's not just China that's more dovish on tightening than the Fed. Others are also happy to watch the U.S. take the lead. Steve Leisman joins us now with more. Steve?
Yeah, Kelly, this is fascinating. While the Fed is expected to affirm market expectations this week for faster rate hikes and even balance sheet reduction this year, Fed Chair Powell's counterparts in Europe and Japan happy to hold the door open and watch the Fed walk through it. Speaking last week, European Central Bank President Christine Lagarde and Japanese Bank Governor Haruhiko Kuroda signaled no intent to join the tightening party anytime soon. Carl Weinberg, a global economist at High Frequency Economics, tells me the key word is divergence. Central bank moves are not going to be synchronized. We have divergence amongst economies and divergence among central banks and inflation and labor market conditions. All right, let's look around the world now. What you see there is the blue. Japan and Europe not expected to tighten anytime soon. The U.S. Central Bank could move as soon as March. Canada, as soon as this week. Mexico tightened already in December. The Bank of England looks likely to hike in early February, along with Russia, Brazil, and Chile, according to Refinitiv, that is. Meanwhile, China cut recently, as Kelly said, and India expected to cut. Bruce Kasman from J.P. Morgan tells me that he expects Europe to follow the Fed 6 to 9 months from now, and that most central banks, except for, of course, Japan, will have to respond to labor tightening eventually. But for the moment, the U.S., with higher inflation and lower unemployment than most other developed nations, is going to lead the way. That could explain, Kelly, the interest we had from foreign buyers in our auction today.
That is a great point. And I wonder what it means for the dollar, most importantly. Haven't seen, I should have asked Rick about this, but if we strengthen because we're ahead of the pack, that's going to be another headwind for stocks, in the short term at least.
Yeah, it could well be for some stocks, obviously, Kelly. As you know, some stocks are going to do better with a stronger dollar, some with a weaker dollar. Be a little careful about what actually moves the dollar. But overall, theoretically, this should be better for the U.S. dollar with the U.S. strengthening. And if it gets inflation under control, and that also looks to be, by the way, bad for something else you're probably talking about this show, which is crypto.
Yes, we will definitely get to that. All right, Steve, we appreciate it. Steve Leisman. Still ahead, Russian stocks are falling over increased tensions with Ukraine. The RSX Russia ETF down 8% today. It's down 20% so far this year. We'll have all the latest next. Plus, we're tracking this market sell-off with a closer look at the slump in semis. The SMH ETF well off its high of 318. We're trading in the 260s right now. Keeping an eye on Bitcoin, which has gone green. This may be the tell for how the rest of the afternoon goes for the markets. It's up 2%. Netflix still lower by 7%. Big declines there and in tech across the board. As we head to break, take a look at the biggest decliners in the NASDAQ 100. Airbnb, Moderna, and that Netflix trade I mentioned. We're back in a moment. Welcome back to the exchange. Plenty of nervousness in this market already. Before we even get to a possible Russian invasion of Ukraine, President Biden having a call with European leaders in just about 2 hours' time to discuss the situation. The State Department has ordered families of U.S. diplomats stationed there to leave the country, has issued a travel warning as well. Russian stocks are down nearly 20% since the start of the year. Here to talk market strategy, Conrad Saldana is Senior Portfolio Manager of the Neuberger Berman Emerging Markets Equity Fund. And for more analysis, we are also joined by Admiral James Stavridis, former Supreme Allied Commander at NATO and MSNBC Chief International Security and Diplomacy Analyst. Welcome to you both. Conrad, let's talk tactical first. This has been a really tough stretch for Russian stocks, obviously, from other parts of emerging markets. What are you telling investors right now?
I think we're staying the course on a fundamental basis. Obviously, what you've seen right now that's transpired has been geopolitics just overwhelming any of the benefit that you're seeing on fundamentals. This should have been the perfect opportunity for Russia, its stocks, where you look at Russia Inc. on a macro basis, current account, fiscal surplus, but more importantly, from a stock standpoint, you're looking at these companies that are trading low, mid-single digit Ps and generating 20% free cash flow yields. So you're probably going to get back the market capitalization in dividends over the next 2 years. But obviously, all of it is right now sidetracked with the geopolitical tension issue that we're currently seeing.
Yeah.
Creates the opportunity for emerging markets and creates the opportunity where fundamentals will finally come through. But obviously, in all of this volatility, it definitely is getting lost on a day like today.
That's interesting what you said. You think the yield will compensate for some of the declines. I know you guys have, I think, about double the exposure to Russia as is typical for emerging markets, so certainly heavily invested there. Admiral, let me turn to you as an investor. This is very hard risk for markets to price. What would your advice to investors be here? Do they just kind of ignore the situation unless it completely escalates, or do you have any guess what's about to happen?
I'd put it this way, 25% chance we see an all-out blitzkrieg by Vladimir Putin. He goes to Kiev, he changes the regime, the whole thing really dramatically upends European security, 25%. I think there's a 50% chance that he will conduct some kind of invasion, carve out a chunk. That one may settle back down, but even there, that's a 75% chance of massive sanctions going into place on the Russian oil and gas sector, on Russian oligarchs, and there ain't going to be nothing but air whistling through Nord Stream 2 for a long time if that happens. 25% chance, Kelly, we may be able to work through this diplomatically. That's how I'd score it right now.
Conrad, does that kind of, jive with how you guys see the situation? And what does this mean for energy prices? Does it leave them fundamentally higher than they should be?
Kelly, to your point, I think it is going to be structurally much higher. If you think of countries in Europe, obviously coming from a U.S. perspective, obviously I'll leave it to Admiral to talk about the geopolitics, but I think that's a big blow for Europe, right? In terms of into the winter months, it's obviously timing-wise, you look at whether it's opportunistic or not, seems like it, but for Europe and for massive sanctions like that, it's going to hurt Europe significantly more, in my mind, and obviously will push up oil and gas prices, especially you look at Europe is paying almost the highest they're paying for gas at this point. So I think fundamentally, I feel that some of the more independent producers like Lukoil we own. Kelly, to your point, we're double weight, but keep in mind Russia's only 3%, right?
Sure.
Of MSCI, and we had 6%. But I think that's where the opportunity is because they're low-cost producers, and I think it doesn't do anybody good. It's going to be a negative for the global economy, and especially much more of a negative to Europe, if you will.
Well, maybe also helps explain why energy is still higher on the year and what's been a terrible market, have some of these supports as well from that situation. Admiral, not that you're in the business of giving advice to investors here, but is it this afternoon's call? What are the main catalysts or dates on the calendar or main points that we should all be watching to understand which way this thing is going?
Well, first disclosure, I'm actually on the board of Neuberger Berman's mutual fund
That's right.
complex, so I know Conrad quite well, and it's great to see him. But there's no house view on this, but I'll give you 3 things to watch. Number 1 is cyber. Watch for cyber attack as the leading edge of what Putin may or may not decide to do because he may feel there's some deniability in going that route. Number 2, watch Putin's troop movements. If he's adding any more, and in particular, watch for medical support. So far, we haven't seen those field hospitals move forward. That would be a key in my mind that he's about to close the switch. And number three, watch alliance solidarity. So watch the statements coming out of NATO. Listen to the NATO Secretary General. He's got the best pulse on what's going on around the alliance. It's a very delicate moment. I would say probably a good one to hit pause, take a deep breath, and hope diplomacy prevails here.
All right, then, Conrad, I'll give you a final word on this. Since you do emerging markets, broadly speaking, do you have any advice you'd leave investors with here who are wondering, given all the moves that we've now seen in international equity markets over the past month, what are the best opportunities that you see?
Sure. And thanks for that, Kelly, because I know you were talking about China just before I dialed in. And I think when I look out longer term, fundamentally China, where people were in love with China and the internet stocks, and now it's kind of despondency. Typically in emerging markets, when you see those situations, those are the best opportunities, right? When there's kind of blood on the street, things look fairly dire. China for us at this moment looks like good idiosyncratic opportunities. The valuations are very supportive. And you're into an easing cycle, but keep in mind that China was very tight before this. So they have that room to now ease across a lot of emerging markets today. So I think that's where the fundamental difference would be. And India for us remains the structural best story, I think, globally, and especially with the financial sector in India. And I think Russia, it is obviously geopolitics today, but longer term, I think, and I'm hopeful that the fundamentals play out and offers that opportunity at the moment, despite significant volatility.
Yeah, it's a tough
Can
call.
I just, Kelly, add one point to my friend Conrad's excellent dissertation, which would be in terms of China, I think we're headed into a year of living quietly with China because President Xi has the 20th Party Congress coming up in November. He's not looking for a big operation. Some have said, oh, watch Russia go into Ukraine and China will follow in Taiwan. I don't see that at all. I think China remains pretty stable bet.
Very, very interesting. Maybe some consolation to investors in that K-Web down another 4% today. Gentlemen, thank you both. We really appreciate your time. Admiral James Stavridis and Conrad Saldana with Neuberger Berman. All right. Let's talk with a little bit more about Russia and how the U.S. does plan to respond to troop escalation. Elon Moy spoke with the Deputy Treasury Secretary and is here with some details on what exactly is being considered. Hi, Elon.
Hi, Kelly. Well, the Treasury Department has already started working on a package of potential sanctions against Russia if it were to further invade Ukraine. As you mentioned, I spoke with Treasury Deputy Secretary Wally Adeyemo before the sell-off this morning, and I asked him directly if markets had been adequately pricing in the risk from Russia. Here's what he told me.
I won't speak to where the markets are and what they're pricing in, but what I can say is that we're prepared in collaboration and coordination with our European allies to meet a significant cost to Russia if they were to invade Ukraine. But the choice really belongs to the Kremlin. They can choose diplomacy, which is our preferred route, or they can choose the route that leads to economic consequences.
Now, Adeyemo last spoke with the Ukrainian finance minister on Friday. He was at the Treasury Department during the run-up in tensions in 2014. Treasury also imposed sanctions on Russia back then, but clearly they haven't stopped President Putin.
And what I can tell you is that the sanctions package that we're considering now is far broader and more significant than what we did then, and would have a far more significant impact on the Russian economy, both in the short term and over the long term.
I also asked Adeyemo about the possibility of blocking access to the SWIFT system or of even banning exports of American-made products.
Every option is on the table, and we're considering those options not just here in the United States and not taking actions just here, but our European counterparts and our allies in Europe are willing to take actions with us.
Kelly, ultimately, he believes that sanctions remain a powerful tool, but clearly some critics believe that they haven't served their deterrence purpose. Back to you.
Well, Elon, a very important detail to bring us today. We appreciate it. Elon Moy reporting in Washington. All right, let's get a quick check on the markets. At the session lows today, the Dow was down 1,115 points. So we're 300 points off the lows. We're down 790 for the moment. That's a 2.3% drop. NASDAQ still the hardest hit. And look at the NASDAQ decline from the year highs. We're down 17.5%. The S&P's down 11% from the highs. The Dow's down just shy of 10%. And every sector is in the red today, with the biggest drops in tech, healthcare, and utilities. Energy is the only sector still positive on a year-to-date basis, like we've been saying. The oil and gas names are holding up, relatively speaking, in today's action. Exxon, Chevron, ConocoPhillips, they're seeing declines of 1 to 2%, and they're down less or up to 10% from their recent highs. But again, Exxon's down less than 5%. Meme stocks, unfortunately, different story. GameStop down about 10%. It's below 100. At one point, it was in the 80s. I think I saw it hit about 89, currently up there at 96. AMC is down about 11%, and I believe went below $15 a share earlier. It's back above 16, but both of these names are 80% off their recent highs. And this is a 52-week chart, so it might not even capture the tippy top. Robinhood also hitting a new all-time low, threatening to break below $10 a share earlier. We're back to about $12.50. It's 85% below its high of $85 a share from back in August. And still ahead, as mentioned, the Dow off its lows, which were more than 1,100 points. We're going to take a closer look at the sectors helping spur the turnaround. Bet you didn't realize Bitcoin is in the green. Well, no, not anymore. We're back in a moment. Welcome back, everybody. Let's drill down into some of the sectors making big moves this afternoon. The Dow down 700 and change. We were down 1,100 at the lows. Christina Partsinevelos looking at the slide in semis for us. Kate Rooney has a closer look at the crypto volatility. Julia Borston on the sell-off in streaming. And Deirdre Bosa is tracking the tech names getting hit the hardest. And we'll go reverse order here. Deirdre, let's start with you.
Well, Kelly, the Nasdaq was down more than 4% earlier today, so we are currently off of those lows, but still it is that high growth complex that continues to bleed. Some of the big names, AMD, Airbnb, Tesla, among the biggest decliners this morning on the Nasdaq. Kathy Woods, ARK ETF, a good indicator of this trade. It is down. It was down more than 4%, more than 6% today. And as Wall Street Bets notes, Berkshire Hathaway now outperforming on a year-to-date and 12-month basis. Classic growth versus value, Wood versus Buffett. Mega cap tech not providing support for the sector today either. Amazon was down more than 3%, firmly in bear market territory, off more than 20% from its 52-week high. Microsoft, Alphabet, not that far from that technical level either. Earnings this week, of course, will be crucial. You've got IBM tonight, classic legacy tech value play that has been better shielded from recent volatility. Microsoft, Apple, Tesla later on in the week. Over the last 30 minutes or so, Kelly, we have seen the Nasdaq continue to pair some of those earlier losses. So some of the names in the black now include software and the hardest hit stay-at-home names. Zoom was briefly in positive territory. Datadog, last I looked a few moments ago, was up nearly 3%. Adobe slightly higher as well. Back to you.
I have to keep checking as I'm saying because it's fast moving.
Quick.
But those are some places to watch maybe for a turn. Here to help us sift through for some trades is Mark Tepper. He's founder and CEO of Strategic Wealth Partners. Mark, it's good to see you. It's been a while. So let's go through as we hit each of these areas of the market today. Love to know, let's start with tech, some of the names Deirdre mentioned. Which are you buying and which are you selling today?
Yeah, so it's obvious that we are officially now in a correction, and it's all about risk off right now. And tech, if you think about it, is really ground zero when it comes to risk in investors' portfolios. Nobody wants to own any of the high multiple, high valuation, high growth stocks right now. But I mean, this is when smart people who make smart decisions make money. And we're waiting right now for the opportunity to pounce on some names. I think there's a lot of good names out there on sale. The question is, when do you pull that trigger? And my take, Kelly, is the sell-off isn't going to stop until Apple hits its 200-day moving average in that 147 to 148 range. The market's just not washed out yet. But you take a look at a name like Microsoft. It's down almost 20% from its peak. Hybrid cloud is a thing of the future. It's trading below its 200-day moving average. I would buy more right now. Could it go lower? Absolutely, but I wouldn't be mad at myself if I bought some today.
No, you'd be insane to try to bottom tick any of this. It's just once it gets to a good price, there you go, if you think that's where it is. And it's real quickly as a follow-up, Mark, people have been talking about Apple as a tell. I remember, you know, even we were talking about with Mike Novogratz, he said, like, this is we hit $3 trillion. For whatever reason, Apple is becoming the stock to watch. Do you think we're about $10 above the level where you'd want to buy it?
I think so. I mean, I'd probably buy more at around 150, but I think the sell-off kind of starts to come to a conclusion right around that 147, 148 level. It is. It's kind of like the bellwether of the market right now.
It's fascinating. All right, stay right there. As we talk tech, let's get specific about the semiconductors. The SMH is down 3% today, 15% for January now. Christina Partsinevelos here with the latest. This one peaked back in November, Christina.
Yeah, it did, but we're still, if we're talking about the components, you're seeing carnage across the board today, especially in chips, Applied Materials, Micron, Qualcomm, Lam Research, all down between about 0 or 1% and 3%. But NVIDIA is one of the biggest losers, having the third largest impact on the NASDAQ right now. It's tracking for its worst month since July 2008. And overall, it's it's coming off those lows over 6% higher. And then you've got AMD, Advanced Micro Devices. This is one of the NASDAQ's 100 biggest decliners to start the year, already 32% off its 52-week high and about 7% lower today, or 6.5% lower today. Keep in mind, just last week, Piper Sandler analysts downgraded AMD, warning of a slowdown in the PC market for 2022. And of course, the semis wouldn't be spared by the rising treasury yields environment. AMD's biggest competitor, though, Intel, faring a little bit better. And the CEO, Pat Gensler, is boastful. Earlier this month, he posted a video on LinkedIn stating his company's PC processors will never be beaten by AMD and that AMD is, quote, in the rear view mirror. If you compare both companies year to date, he might feel vindicated. Intel is only about, 2% lower this month, and then you've got AMD down about 22%. And given the drop in its constituents, we're going to come full circle. The VanEck Semis ETF is also trending lower today. Kelly?
Christina, thank you. Mark, what would you do with the chips?
Look, I mean, chips are outperforming software. That's not saying a lot, though. But when it comes to chips, I'm a long-term bull. We don't have enough chips in this world. We need better, more advanced, more efficient chips so that we can do pretty much everything we want to do as a society. I own NVIDIA. I own AMD. I'm sticking with them. I'm not selling them. I'm not saying I would be buying more right here. NVIDIA is still a bit extended, but it's back around its 200-day moving average. And they're in all those highest growth end markets, autonomous driving, AI, data center, gaming. AMD obviously probably had quite a bit of pull forward during the pandemic in regards to their notebooks unit, but they're light years ahead of Intel technology-wise. So look, those are both great companies. And I think as an investor, if you're confident that 3 to 5 years from today, they're going to be higher, Kelly, as we already mentioned, you really can't pick the bottom.
Right.
You just got to know they're good names and be willing to buy them or hold them.
Yeah, exactly. Mark, we appreciate it as we watch that sector struggle a little bit. Same with crypto today. And by the way, all weekend, this one was really setting the tone. It doesn't stop trading, so we all watched that slide happen and then the market kind of catching up to it. Kate Rooney, maybe now the market's catching up to the fact that Bitcoin's positive by 2%.
That's right. Yeah, Bitcoin never sleeps. Markets are open on the weekend. It makes it busy for all of us finance and tech reporters. But it's bouncing. It was just back above 36,000. So keep an eye on that. But this morning, Bitcoin and Ethereum hit a 6-month low. The sell-off really is the effect of cryptocurrencies becoming more mainstream recently. As macro funds have bought Bitcoin in the past couple of years, they're now turning to cryptocurrencies as one of the first places they sell to get liquidity. Analysts are also pointing to retail investors losing some conviction. Glassnode saying this morning that the lion's share of losses are coming from newer buyers. They call those short-term holders who appear to be taking any opportunity to get their money back. Right now, Glassnode estimates only 32% of Bitcoin's market cap is held at a profit. So there's a lot of investors right now underwater. And one way to measure investor sentiment is something called the Fear and Greed Index. That is now at a 13 out of 100. Last month, for example, it was around a 39, to put it in perspective. And leverage, that is another big theme we've talked about in recent weeks. Kelly, Noel Atchison at Genesis is telling me there was a big spike in bearish sentiment in the options market this morning, so something to keep an eye on as well. And a lot of liquidations. In the past 24 hours alone, there's been more than $470 million in leveraged positions unwound. That's only in the past day or so. Kelly.
Wow, I love the Fear and Greed Index. Didn't know Bitcoin had one. So now I'm looking at the one for the market. We're only at 37, so we're not into the extreme fear zone yet, according to CNN's gauge anyway. Kate, thank you very much. Mark Tepper, how would you trade crypto?
Anyone who said crypto was an inflation hedge is probably hurting quite a bit right now. It's obviously a risk asset. And it's okay to hold it as an asset class for diversification purposes, but you need to understand the risks. I mean, crypto benefited substantially throughout the pandemic from all that additional liquidity. I mean, there was trillions in fiscal stimulus, and they either went into your Coinbase account or your Robinhood account. But that tailwind is now gone. So you need to size it appropriately in your portfolio. I always recommend to my clients, own as much as you're comfortable losing. Maybe that's 5%, maybe it's 10%. If you're 22 years old, maybe it's 80% of your portfolio, but own as much as you're comfortable losing. And if it 10X's for you, great.
You think the 22-year-old can lose 80% of their money?
I'll tell you, I read an article in the Wall Street Journal last week that said millennials are now shunning financial advisors. And there was a story about some guy who was 25 years old. He had 90% of his money in crypto and said, who needs a financial advisor when I can buy crypto and 10X my money every year?
Right, but I think even he would probably say, I don't want to lose. That's not all money that I would, you know what I'm saying?
I would agree with you.
Yeah,
I would agree with you.
Still.
Yeah, he's probably rethinking that strategy.
Yeah. Point taken. Point taken. Let's move along finally and get a check on the streaming stocks, which are not escaping some of the damage today, especially Netflix. At one point, it was down about 10% towards the 350 zone. Julia Borson is here with more. What's going on here, Julia?
Well, what we're really seeing here is that the streaming stocks have been plummeting on growing concerns about slowing subscriber growth. And this, of course, follows Netflix's disappointing outlook last week. Netflix, those shares are down about 6.5% today after Jefferies downgraded the stock to hold from buy, saying the company may need to shift to focus more on video games. And this follows a number of downgrades and price cuts on Friday. Roku shares are also down about 1%. And then you see Roku down about nearly 1%. Disney shares off nearly 3% on those concerns that Netflix's performance could mean that their subscriber growth will also be lower than anticipated when they report. And CNBC's parent Comcast, it is, of course, exposed to streaming trends through Peacock as well as its broadband business. That stock down about 1% today, but getting an upgrade from RBC to sector perform to outperform. The analysts saying they think concerns about broadband subscriber trends are overblown. Guys, back over to you.
Julia, thank you very much. And Mark, wrap things up for us. Any of these names jump out to you as a good buy here?
Yeah, so let's pump the brakes and put a few things in perspective. So the first things first, Netflix right now is trading at its pre-COVID high. So you can get all that COVID-related subscriber growth for free. You're getting a company that is now positive earnings-wise. They can flip cash flow positive if they want. Operating margins are in the high teens, low 20s. It's a much better company today than in 2019, yet it's priced the same. Could it go lower? Sure. Could it likely be much higher in 3 to 5 years? I think yes. And then you look at Disney at around $130. Back in, I don't know if it was 2018 or 2019, whenever they announced Disney Plus, the stock went from just under 120 to over 130 overnight. If that thing falls to 120, and I can buy the parks and the cruises and all that stuff and be patient with them and get Disney Plus for free, why wouldn't I do that? So at around $120, Disney looks very attractive too.
All right, Mark, thank you very much for the specifics, the trades. We really appreciate it today. Mark Tepper with Strategic Wealth Partners. Up next, we'll have a lot more on the sell-off, including some bright spots. As we head to break, here's two of them in the Dow. Travelers and Home Depot are in the green right now. We're back in a moment. Welcome back to the exchange. Let's get right to Dom Chu for a market flash. Dom.
All right, we mentioned before the sea of red, but we continue to monitor the sell-off here. We do see some relative outperformance, green on the screen, among some defensive sectors like consumer staples and utilities. But as you can see behind me here, we are seeing some resistance to the sell-off from the home builder stocks. That includes names like Pulte Group, Toll Brothers, Lennar. Some of those names you can see they're green, 1.5% gains for Pulte Group and 1.25% for Lennar. Today's moves come as we see 10-year U.S. Treasury yields slip lower after a strong start to the year. On a year-to-date basis, that move higher in yields has had the home builders, though, under pressure, you can see. two of the ETFs that track some of those names, the Spider Home Builders, XHB is the ticker, also the ITB, are both down around 15% or so far this year. So as we continue to watch the moves in Treasury yields, interest rates overall, keep an eye on some of those home builder names, Kelly, standing out as green in a sea of red. I'll send things back over to you.
Very interesting, Dom. Thanks. Meantime, the activists are out in force. Kohl's receiving competing takeover offers from private equity firms Sycamore and Acacia, how do you say it, Research, backed by Starboard. And then Unilever, where Trion's Nelson Peltz has amassed a large stake, although according to David Faber, he's not yet approached Unilever with any requests. And now Peloton, Blackwell's partners, an activist shareholder, going after Peloton in a blistering letter, urging them to fire CEO John Foley and put itself up for sale. Now, all three companies mostly higher today. Peloton now up 7%. Joining me to discuss is Wall Street Journal M&A reporter Kara Lombardo. She broke the Peloton story over the weekend. And Dan Primack, who is business editor at Axios. Welcome to you both. Kara, I'll just start. Peloton, this one would seem to be, I hate to say it, but kind of an obvious play at this point, right?
It's very true. I mean, Kelly, if you look at the shares, they've been on a downward trend now for about a year, down from their high 80%. So I think a lot of activists and a lot of potential buyers have probably already been eyeing this one. It'll be interesting to see now that the first activist is out of the gate calling for some pretty extreme measures, you know, getting a new CEO and putting the company up for sale. It'll be interesting to see how the company responds.
Yeah, I guess Kohl's maybe a little bit less obvious to me, Dan, as a candidate, but retail always seems to garner these kinds of pressures.
Yeah, they do. And in part because the way to unlock value, or at least the theoretical way to unlock value, is often so obvious, right? You've got the brands, but you've also got the real estate, right? It's the old Eddie Lampert Sears argument. Right. That didn't work. But we're seeing it with others. We always see it with others because remember, Kohl's is really an off-mall department store. They're not sitting inside of Simon properties. They're generally in parking lots elsewhere. So there's a belief, at least, that there's always this value to unlock in it by kind of splitting up the assets.
The shares are up 33% today. Kara, do we call it a trend? I mean, is it just random if this is all kind of percolating at the same time?
It's interesting. I mean, what's interesting to me is that they're both at very different stages. Kohl's, of course, has had activists on its case for 2 years now. This is the second year in a row it's being targeted by multiple activists at once. And is this finally enough pressure to force some major changes there, whether it's, like Dan said, some transaction involving the real estate or a full sale or something else? You know, Peloton, we're just at the beginning of the story. I feel like the company still has a chance in their earnings, which are weeks away here, to come up with some new strategy that's going to get the shareholder trust back. But you know, they've been through that before, so we'll see how that goes.
And now I can't resist, Dan, asking, what do you think Peloton could or should or will do here?
Okay, and in full disclosure, I'm a user of Peloton as a customer, and like
You're biased.
The product. Bias. I admit my bias up front. It's pretty public bias. That said, look, I don't think John Foley is going to step down. There's a dual class share structure, so I don't think they're going to take a fire sale price. You know, if some private equity firm or strategic comes and, you know, offers a 10 or 20%, maybe even 30, 40% premium, I think that earnings is going to be really important. I will say in the interim, though, because that's about a week and a half away, I am very surprised that they are not coming out somehow and telling their story a little bit more, not just in a letter, but in an interview, whether it be on CNBC or with me or somewhere else. February 8th is a lifetime away, and they're kind of letting other people define them in the interim.
Very interesting. We'll take that as a pitch. We welcome Peloton on anytime, talk about the story and the company. And Kara, finally, as we just kind of look through the narrative here and everything that's happened with it, should we expect Peloton itself to be a takeover target?
I mean, I think, like I said, the pressures on that stock, I think, have put it in focus for acquirers already. But what is really going to matter is, does the company have an alternative plan that will be just as compelling for shareholders as a sale? And we haven't yet heard from them. I think that's the important thing. But, you know, one example last week, Activision selling to Microsoft, that came in a similar situation. Activision shares were under pressure. They got a soft approach from Microsoft saying, hey, we're here if you want to talk. I'm sure Peloton is getting similar approaches, or already has been for several months.
That's a great point. All right, we'll leave it there. Thank you both very much for joining me today. Kara Lombardo with the Wall Street Journal, and Axios' Dan Primack. And up next, the Dow falling for the 7th straight session for the first time in nearly 2 years. Whether there's more pain ahead and how to trade it next. Welcome back, everybody. The NASDAQ is still having one of its worst months ever and is down almost 17% from the high. So what do you do here? Joining me now is Steve Grasso, Grasso Global CEO. Steve, it's a lot better look this afternoon than it was just a couple hours ago. I don't know what changed.
Yeah, probably nothing, Kelly. So when you have to think about this, everyone is panicking, and they always ask you as a trader, does it feel panicky? It hasn't felt panicky up until when Netflix really fell off the cliff. That was the next leg. So people are starting to look at the economy and saying, how is the underlying economy? That's all that an investor should care about. The underlying economy is sound. Manufacturing PMIs are good. Europe has been beating. Asia has been beating. The only weakness that we saw in the U.S. was on the service component, and that was caused from the Omicron virus. So I don't know why people are panicking over the economy, because now if you have the Fed, who Goldman is tripping over themselves to increase how many times they think the FOMC is going to raise rates. What happens if the FOMC only rates half of what the market has already digested? We rally.
Right.
What happens if they raise? So my point is, if they raise less, then what happens to the dollar? The dollar comes in, so that decreases the pressure on the front end of the curve, which will increase the steepening of the yield curve, so value outperforms in that scenario.
But I so agree with you. And if someone asked me, I'd probably give them basically the same explanation of how this is all likely to play out. But what if this year is different because they have to keep tightening?
Why would they have to keep tightening? If they have to keep tightening, then they're robotic. They have to react to whatever the pressures are on the economy. So if inflation, they said transitory, everyone says they were wrong. It depends on what you call transitory. If you would agree with me, and they would agree, that a tremendous amount of this pressure was caused to the supply chain due to the pandemic. In every metric that we can look at, the pandemic is subsiding. Everyone would agree on that. What does that mean? Inflation should be coming in. So if they want to get robotic and just raise rates in the face of an abyss, then they can do that. But I don't think they're going to do that.
Well, let's boil this down to where you're positioning. So are you positioning then kind of the value trades? What are some examples of what this all should look like? What should people do right now with maybe some of the opportunities this market is giving them?
Yeah, so I think value is going to, we're not looking at 2020 when people thought that the pandemic was going to ruin the economy. We're looking at an economy that has recovered or will recover. So you want to be invested into the value names, the paper names, the chemical names. But let me tell you, Kelly, very hard to convince someone not to buy Apple. Very hard to convince somebody not to buy Facebook. I own Apple. So Apple for me is a lifelong event, not a cyclical event, not a buy the dip event. So yes, you can buy large cap tech if it's your fear mechanism to do so. You could hold large cap tech, but you should be invested in value plays right now, and that's where you should be looking for bargains.
Quick name or two.
You know my names: Trinseo, Dow, WRK, which is WestRock. Those are the names that you want to be invested in. And I'll give you the other one that I talk about constantly, and it's doubled and tripled: Capri, CPRI. That gets thrown out with all of retail.
All right.
That's high-end retail.
You like Coors? You like, what is it, Kate Spade?
Versace.
Yeah,
Jimmy Choo and Versace.
That's right. Steve, thank you very much today. Steve Grasso. That does it for the exchange, everybody. We are well off the lows. Power Lunch starts right now.
Good afternoon, everybody. Welcome to Power Lunch. I'm Tyler Matheson. We are watching another, I think the word for it is lousy day for the markets. The Dow down for the 7th day in a row. The S&P 500 joining the NASDAQ in correction territory, off 10% from recent highs. And there's carnage in crypto. Bitcoin now at its lowest level since July. $130 billion in crypto market cap wiped out in one day. And Bitcoin just didn't working as an inflation hit. Neither are the small caps. The Russell 2000 is down more than 20% from its recent high. That is the definition, technically, of a bear market And for the small caps, at least, it's certainly beginning to feel like one. Kelly?
All right. Thank you, Tyler. Hi, everybody. So many numbers and stats to share. Let's start with the Dow. Dow headed for its biggest monthly loss since March of 2020. We were down nearly 1,100 points at the lows today, but we've more than cut that in half. It's almost a garden variety 1.3% drop right now, down 463. But remember, the last hour of trading this month has been the worst for any last hour of trading since October of 1987. So keep all of this in mind. It's only 2 p.m. We still have a ways to go. You have to go back for the NASDAQ to October 2008 for the last month that was this bad. The height of the pandemic, the housing crisis, these are the kinds of analogies we're talking about for the NASDAQ's 15% drop this month. And Tyler mentioned the crypto carnage. Bitcoin is down 5%, Ether even worse. But we've staged a comeback here. Bitcoin has now gone positive by almost 3%. Ether's only down 1%. There's Solana down 6%. Technology is the worst performing group in the market. The chips are getting especially hammered, not just today, but so far this year. SMH was at 318 at the highs. We were down to 258 at one point today. NVIDIA down 25% from the highs, down 4.5% at the moment, Ty.
All right, thank you, Kelly. And, of course, so many worries for the markets right now. Chief among them, the Fed fears that the Fed will go too fast with rate hikes and removing stimulus. We're also in the middle of earnings season. Worries that those results won't live up to the hype. And a lot of the earnings reports have not been exactly interpreted favorably. And speaking of not interpreted favorably, there is, of course, Vladimir Putin and what he may or may not do in Ukraine to affect the mood. Stephanie Link of Hightower Advisors is here to calm our nerves or stoke our fears, or a little of both. We got reporters on all these issues. Let's begin with Steve Leisman on the Fed meeting and interest rates. Steve?
Yeah, Tyler, for right now, the stock market sell-off is having an impact on the bond market, depressing yields and the market pricing for the outlook for Fed rate hikes, but not that much. First, let's look at the two-year yield. It leads the way on the outlook for Fed rates, fell sharply midday and is down about 10 basis points, 9 basis points since reaching pandemic highs of 105 on Thursday. It now trades around 95. Prices benefited from an excellent bond auction earlier this afternoon. The effect, though, has been lower by, call it 5 to 10 percentage points, the outlook for Fed rate hikes this year. But 4 hikes are still priced in. Markets place a 92% chance of a hike in March, 80% of a second hike in June, 66% for a third hike in September. And the real impact has been on a little less certainty there for a fourth hike in December, but it's still trading at a 56% probability. Fed watchers also expect the central bank to talk further about balance sheet reduction this year and likely begin it sometime this summer. While the Fed watches and is concerned about the stock market, the Fed has an inflation problem, as you know, and that will likely keep the Fed on a tightening track, with the sell-off not sufficient at this point, I think, to deter it, Tyler.
All right, Steve, hang on. We're going to bring in Stephanie here. You said the Fed does need to fight inflation, but how much is too much? And might Chair Powell have been more right than wrong a year ago when he was using the word transitory on inflation?
No, I think he's totally wrong, Tyler, on transitory, right? I mean, we know that wages are going up huge. We know rents are going up big. Not to mention PPI at 9.8%, CPI at 7%. Maybe some of it comes back and down a little bit as we fix supply chains, but that's the reason that they have to actually raise rates. But I do think he's not an extreme person. He's data dependent. And I think he's watching all of this, including Ukraine as well, and they'll act accordingly. Everyone's saying, well, the market's going to do the job for them. I disagree. The market was up 27% last year. That's the S&P. The NASDAQ was up 21%. Okay, so fine. We're down a lot this year to date, but nowhere near as what we were up last year. So you've got to smooth average it through, and I think you have to look at the economic data. And post-Omicron, I believe you're going to see pent-up demand and a little bit better growth than what we're seeing now. Right now, we're getting distortions in the economic data because of Omicron. So let's see. And I think with higher inflation, a little higher inflation, a little higher growth, they can, in fact, raise rates and normalize policy.
Steve, react. Obviously, Stephanie's not buying my thought out there that maybe transitory is the word that might work here. If the Fed is so intent on raising interest rates, why don't they get about it and do it tomorrow?
It's a good question. I think the Fed is behind the curve. The reason why the Fed delayed is they didn't want to have a big reaction, certainly in the bond market or in the stock market. And I don't know if this is too much of a reaction for it. I suspect it's not. Look, what the story is that Stephanie had it right. The Fed is data dependent. And you could be right, Tyler, and I don't mean that to be too astonished by that fact, but you could be right, Tyler, that inflation ends up being at least more transitory than is built in. There are people out there who think that in the next 3 or 4 months we could see some decline as we get some of the supply chain problems. And also, by the way, as we make a shift from services to goods, we've spent an extra $1 trillion in this economy on goods purchases, and that has been a big part of the inflation issue we've had out there. People start going out and spending more on services, take some of the pressure off the goods inflation. That will help. But then the Fed can react. The Fed has only penciled in 3 rate hikes and talked about balance sheet reduction. None of that has to happen. If you, for example, have inflation crater, the Fed can back off that in a heartbeat.
All right. Stephanie, stay right there. Steve, thank you. And we'll talk some earnings now. As stocks sell off on rate hikes, the real fear is those hikes would slow the economy, and in turn, that could hurt corporate earnings, which already have been showing some disappointment. Let's bring in Bob Pisani for more now. Bob?
And Kelly, the important thing is stocks are facing 2 headwinds. One is multiple compression, and the second is some potential earnings headwinds. Now, multiple compression is very important. The PE ratio, the multiple, is basically what investors are willing to pay for a future stream of earnings. And that's been going down. It's now below 20. It was as high as the mid-20s and even in the upper 20s a year ago and has been coming down. People are less willing to pay more for a future stream of earnings as the Fed has been raising interest rates. Number 2, earnings headwinds are out there. 2022 earnings are going to be not bad, up 8%, but that's closer in line to the historic norm of 6 to 8%, way down from 47% in 2021. And more importantly, Q1 and Q2 estimates, which is what we care about, aren't really rising anymore. So today, for example, for the first quarter, estimates are ranging from around up 7%. Now, just a few weeks ago, they were closer to the 8% overall return for the market expected. So the numbers aren't going up. Every month last year, those estimates were actually rising. So this is a change we haven't seen in a while. Why aren't the estimates rising? Well, there's a lot of confusion about exactly how much the Fed is going to raise rates at this point, and even about the course of the overall virus. There's another sign here that things are getting cautious. This earnings season is not quite as full of the upside surprises as we saw in the prior year. So, for example, right now, look at the number here, 65 companies reporting, 80% are beating. That's less than before, and the average beat is only 8.5%. Still not bad, but it's half of what it was last year when we had very aggressive earnings beats. The other thing that's happening is there's more negative pre-announcements than usual. The big example, of course, there was Netflix. Kelly, I think the big thing here is the Fed action here now creating a secular change in the stock market. Just like the Fed created a secular change in 2009 and 2010 when they started pumping vast amounts of money into the economy. Now that they are withdrawing that, are they creating another secular change? And should we start expecting subpar returns from the stock market going forward? Kelly?
All right. And Stephanie, on that note, why have we had so many poor earnings, I would say, reports? It's really the stock responses so far.
Yeah, I think it's early on, though. I think we've only had about 10% of the S&P 500 companies report earnings. And quite frankly, I've been actually positive on the banks as well as the energy stocks. And in fact, I think that the energy stocks has been surprising because they actually are talking about super cycle, and this is oil services companies, because they have solid top line growth. They've been restructuring, so the margins are staying firm, and now they have pricing power. On the banks, they've actually done quite well. Not all of them, but I would be buying Bank of America, Wells Fargo, and Morgan Stanley today, right here, given the valuations and the reports that they put in. But we do have some issues to deal with. Bob's spot on in terms of not getting multiple expansion. I don't expect it, but I go back to who has pricing power, who's done a good job at restructuring and cost cutting and that sort of thing, and we'll see decent top line growth. So I actually am a little bit more optimistic. I think you're going to see 11 or 12% earnings growth. And I think that's good enough, especially since you've seen some of these stocks come down quite substantially. But those two sectors, so far, so good.
Yeah.
All right, Steph, we're going to veer in a different direction right now. Stick around. If that didn't give us enough to worry about, we've got Russia amassing troops near the border with Ukraine, U.S. dependents being ordered to leave Kyiv. And joining us now is Kayla Tausche with the latest. Kayla.
Tyler, today President Biden will hold a call with European leaders to discuss the escalating security situation in Ukraine. As you mentioned, the State Department urging diplomats and American civilians to evacuate, citing the threat of significant military action by Russia. With little notice, the UK has warned of a Kremlin plot to install a pro-Russia leader in Kyiv. The U.S. has sent 90 tons of weaponry to Ukraine, and officials say President Biden is still weighing bolstering NATO countries with additional troops and military aid. Last week, the president suggested that NATO allies were not completely aligned on how to respond to Russia, but Secretary of State Antony Blinken said anything short of a ground offensive would still see steep consequences.
We've also been clear that there are other things, we were just talking about this, that Russia could do, short of sending forces into Ukraine again, to try to destabilize or topple the government, cyber attacks, hybrid means, etc. And there, we've also been clear, there'll be a swift response, there'll be a calibrated response, there'll be a united response.
Meanwhile, lawmakers in Washington have yet to vote on a wide-ranging sanctions package Democrats unveiled earlier this month. Republicans, meanwhile, have backed preemptive sanctions as a stronger deterrent. Unclear, Tyler, which path will move forward and when at this point.
All right, Kayla, thanks very much. Kayla Tausche in Washington. Stephanie, as I think back, we've now gone 6 or 7 days in a row, Steph, with the Dow and NASDAQ down. The last time that happened was February, as I recall, of 2020. Back in February of 2020, we could all see that something, a big wave, was out at sea about to crash. That was the COVID virus. Now we have the Ukraine. That feels to me like a big wave that the markets are afraid of, and that's a major contributor to this sell-off today and the sell-off we've been seeing over the past couple of weeks.
Yeah, it's just adding to the list of uncertainties. Tyler, you know, there's always something to worry about. Market always worries. It's when we don't worry is when I worry, because that means that we're all complacent. So we all kind of know these things. What we don't know is to the extent of Ukraine and what's going to happen. Nobody knows, right? So that's why you've seen part of the reason why you've seen a pullback in the market. But I think part of it also is the uncertainty about the Fed and what that's going to do to the economy. And are we going to be able to see continued growth in the economy, or are we going to really contract substantially? I'm in the camp that you're going to continue to see above average growth. Yes, we have to watch interest rates in the Fed. Yes, we have to watch Ukraine, and we have to watch what oil prices do, clearly, because supplies are so tight even now before we would get some sort of an incident in the Ukraine. So watch that. But I think a lot of these things are starting to get priced in. I mean, the NASDAQ's down 15%, but we know so many companies are down way more, 20, 30, 40, 50%. So I stick with good quality companies, good balance sheets, number one or number two in their industry, down 5, 10, 15, 20%. I've been buying today. I bought some Facebook, I bought some Schlumberger, NXPI, McDonald's. So pick your spots.
Yeah. All right. Kayla, back to you for a quickie. We know the White House is watching the recent sell-off in stocks. Have they been saying anything?
Well, the press secretary, Tyler, was just asked about the market sell-off today in a press briefing that is still ongoing. She responded, Jen Psaki, by saying that the White House does not watch the stock market as closely as the prior administration does, that it does not see the stock market as the barometer of economic health in this country, though at the same time noting that the market has been up roughly 15% since President Biden took office. But the press secretary saying that what the White House, at least publicly, watches most closely is the health of the average American and whether they are feeling like they are better off. Tyler.
I wonder how they'll feel about that if over the course of the next few months, the average American's 401k gets cut by 20, 30%, and they feel less wealthy, less propensity to spend. That could change their minds a little bit on that. I take the point, Kayla, but it's an interesting thing to watch. When people are feeling healthy and wealthy, generally the view of the incumbent in the White House is favorable. When it's different, it's not. Folks, thank you very much. Stephanie, Kayla, appreciate it.
And coming up, we're all over this market. We're sliding back a little bit now, about 100 points lower in just the past 15 minutes. Dow's down 550 and change. Around 70% of the S&P is 10% or more below their 52-week highs. That's led by a lot of communication services and consumer discretionary names like Viacom, CBS, Twitter, and Penn National Gaming. Plus crypto, Bitcoin now around 36,000 after dipping all the way to 33. How long will the volatility continue? A top crypto trader joins us next. Welcome back, everybody. We're keeping a close eye on crypto. It's been a little bit of a tell for this market. It was down all weekend, then it's gone green, as you can see here in the afternoon, as stocks have moved off of their lows. This was after touching a 7-month low of $32,000 a little bit earlier on. Bitcoin has rebounded back up to about 35, almost 36,000. Crypto exposed stocks also getting caught up. Coinbase, MicroStrategy pairing losses. Marathon Digital is trying to go positive. They had been down almost 15% at the lows today. Marathon Digital briefly was positive a moment ago. Now, what can be made of all of this volatility? Joining us now is Mike Buchella. He's a Block Tower partner. Mike, what do you say to, so now, like, people ask me, why, like, what happened? Why is Bitcoin down so much? How much more is this going to go? I don't have an answer for them, but maybe you do.
Yeah, thank you for having me back. I mean, the last time I was on, I talked about for the retail friends dollar cost averaging. It's for this type of environment. So broadly speaking, this has been a macro move. I mean, nothing's really changed in the innovation level in crypto. It's really just a market digestion of interest rate policy and financial conditions. And those have come in significantly. And so what you've got is a sell down in broad risk assets. Crypto is still very much in the risk asset side of the equation. Growth equity, SPACs, everything's gotten decimated. Crypto, given its vol and given the nascency of the asset class, has actually held in relatively well. I do think you're really riding a macro wave at the moment. So Wednesday will be an important date for crypto, but in the interim, it's kind of cautious optimism. I think the nice part is it's sort of beta one on the way down, and on the way back up, there's a lot of dispersion. You can actually pick out some babies from the bathwater, and it's a really interesting environment for an active hedge fund manager.
Yeah, I can imagine Wednesday, of course, being a reference to the Fed meeting. You think the Fed is the reason why, basically the tightening of liquidity has pulled the rug out from under crypto? How much longer do we have to go here?
Yeah, I mean, it's broad-based deleveraging, right? So you have people kind of taking down exposure to risk assets broadly. You see that in the public markets of crypto and things like the GBTC discount. You see that in basically all of the high growth names. The most recent 12 months of IPOs have all gotten absolutely crushed. So anything in that risk asset class is just being taken down from an exposure standpoint. On the crypto side, there's been some kind of small microstructure nuance. So we'll see after the equity markets close on Friday, for example, or Thursday. We had this low liquidity window for crypto. There was no liquidity in equities, and I'm sure people got margin calls, and those margin calls triggered sell downs and things that were liquid. Crypto's liquid, and we saw these kind of wicks lower in those small windows. But the reality is, it's much more a macro story now. And so everyone talked about the institutions coming, the institutions coming. The institutions give it, and the institutions give it, take it away. So you've got Bitcoin alongside other asset classes in systematic strategies. Bitcoin gets sold down in these types of environments just as much as growth equities do.
Yeah, I love the idea of calling crypto or Bitcoin, which is sort of, I guess, the Kleenex word for those assets, a risk asset, because that's what I think it is. I don't think you can think of it. What does the sell-off, which is 50% in Bitcoin from the highs, what does the sell-off do to the argument that cryptocurrencies are a store of value? Maybe not so much. Number two, a medium of exchange. Well, if it can't hold value, how reliable is it as a medium of exchange? Third, is it an inflation hedge? Seems not.
So I guess it all depends on your denominator, right? So as a U.S. dollar holder, as an American citizen, U.S. financial system, relative to the U.S. dollar, it's been a pretty poor store of value on a stability basis. If you are in other parts of the world where your currency, your base level currency is much more volatile and it highly fluctuates, it's probably a better store of value. So it's all kind of the perspective from which you're looking at it. Again, Bitcoin in being adopted as a store of value is still super early. I mean, the technology, the idea of encrypted value, the idea of proof of work mining, the idea of Bitcoin as an asset class is still very young. I mean, I think this is a very stark reminder, which is needed to remind people that crypto on the whole is still very new, and we're at the earliest stages of adoption, innovation. And the fact that the volatility of a very liquid public asset like crypto has only moved 50% from its highs is actually pretty, I would say, pretty powerful from my perspective.
So I got a call last night, third quarter of the greatest football game I ever saw. I really wasn't paying attention to this. A person I'll describe as a life coach to my older son said that my older son is very eager. This was last night. He wants to spend $50 or $100 and buy some Bitcoin. He says, "You said it was a good idea," says the counselor. I said, "No, I did not say this is a good idea. I said," this was months ago, I did have a conversation. I said, "Well, maybe I'd put some money into crypto if I were ready to take a flyer." I told this to the counselor coach last night. What would you have said to him? Is it a good time to put $50 or $100 in Bitcoin?
I will tell you what I told you last time. I think, and the same thing I say to all my family members and friends, dollar cost average, markets are volatile, blend in your entry point, don't get in over your heels. All that to be said, there's an enormous amount of capital earmarked for crypto. I mean, we see it. There's a large allocator conference in Miami this week. We are overwhelmed with interest in people looking at the space. The long-term cycle is still very much intact. The short-term market volatility is something to be taken advantage of by professional money managers like us. But for the everyday person, tell your life coach's son to average in on a weekly, monthly basis for as much capital as he is worth, as he would be willing to lose.
He's saying, give Mike the money, and he'll find where to put
Mike Pacella, thanks, man. Appreciate it.
Thank you.
All righty, still ahead. We got more on this big sell-off. The Dow well off the lows of 1,100 points or so. And we'll take a look through some of the key names in the red, as well as some stocks that are holding on by their fingernails, specifically some brick and mortar retail.
Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. A new revelation today about Boris Johnson reportedly ignoring more COVID protocols. ITV reports that in June 2020, up to 30 people attended what it's calling a birthday party for the British Prime Minister in the Cabinet Room. At the time, the UK was in a lockdown that prohibited social gatherings indoors. Johnson's office tells ITV that the staff gathered briefly after a meeting to wish Johnson a happy birthday, and that he was there for less than 10 minutes. Johnson continues to face calls to resign, including from his own party. One woman is dead, 3 others wounded after an 18-year-old German student opened fire in a university lecture hall. The gunman is dead, with local reports saying that he killed himself after the attack. The Supreme Court will hear arguments in a case that could end affirmative action admissions at colleges and universities. Harvard and the University of North Carolina are accused of discriminating against Asian American students. Several conservative justices have joined the court since it narrowly rejected a similar challenge back in 2016. And a World Health Organization official says that immunity from Omicron infections offers what he calls plausible hope for stabilization and normalization. Tyler, I'll send it back to you.
Well, we can all hope for that.
We sure can.
Rahel, thank you. Let's get a check on the market, shall we, if you dare? Send the children away to another room for right now. All 3 indexes are down about 2%, but that's not the half of it. Like, it really is kind of the half of it, if you really think about it, because at one point the industrials were down more than 1,100 points. Now just down 666. That's not a good number, is it? 666. S&P 500 down 98 or 2.25%, and the Nasdaq, which has been the one taking the big whomps today, down 2%. EV and solar names getting torched. Tesla down 6%, Rivian 3%. Solar following the alternative energy trade in suit. One bright spot, though, brick and mortar retail. Kohl's up 30% as it is attracting hedge fund interest. Macy's, Dillard's, Nordstrom also sort of moving along in that way. The e-commerce platform Shopify staging a turnaround, now higher after it said it'll make changes to its fulfillment network to help merchants compete with big box retailers, including offering 2-day shipping at affordable prices. There you see it.
That is a big deal. A lot of people pointing to that one for the market's turnaround, not as a cause, but again, another factor in the change in sentiment. But it is 2:30 p.m. It is the witching hour, we might call it. 90 minutes to the close, and it's been really tricky sledding here in January for this period of time. Ahead on Power Lunch, investors have been fleeing growth stocks. The Nasdaq down nearly 5% just at the lows today. The spokes, Paul Hickey, will tell us what exactly we do need to watch going into the final hour. Stay with us.
We've got about 90 minutes left in the trading day. We want to get you caught up on everything that's going on with today's sell-off. Stocks, bonds, commodities, the whole bag. Let's begin with Bob Pisani on stocks. They are still down, but well off, sir, the lows of the day.
Yeah, we were down 170 points on the S&P 500, Tyler. We cut that almost in half. The problem here is there's not a lot of conviction that this represents a sudden selling climax. People are really waiting to see what the Fed has to say on Wednesday. I think that'll be the important event for the week. Let me just show you Shopify. Now, I know Tyler mentioned it a little bit. Now, there you see the S&P off of the lows here, but Shopify was really quite extraordinary. Down $100 at one point in the middle of the day. We're talking about a 12% decline before it turned around here, and now was up slightly. So Shopify was now 920 or so, right around there. Elsewhere, Zoom, for example, 148 on Friday, and dropping dramatically, went all the way down to 139 in the middle of the day today, and now it's back to 150. So that was a 6% decline. So Shopify down 12% is a lot, but a lot of other stuff was down 6-7%, like Zoom. Meta, another good example, super big cap name, 303 on Friday, went to 289. That was down 4.5%. It too made a comeback essentially in positive. A lot of big names that are in the consumer space, like Starbucks, were at 52-week lows at the open. So Starbucks was $96. It went to 94 and below that in the middle of the day. And it too eventually went positive, as you can see here, $96.76. That's a pretty violent move for Starbucks. That's a big cap name. Other big cap names were sitting at 52-week lows at the open in the consumer space. Best Buy, for example, was $96. It went to $92. And then back to $98, as you can see. These are very, very large moves. And what it says here, Tyler, is nobody is quite sure how to read the market right now. The volume has been very strong in all of these names right across the board. So there's a lot of people moving a lot of money around. The problem is there's still not a lot of conviction about whether this big move today represented some kind of selling climax. Tyler?
All right, Robert, thank you very much. Now to the bond market, where we are seeing some buying that is sending the 10-year yield a little bit lower. Rick Santelli has it covered. Hi, Rick.
Yes, we are seeing some buying, and the catalyst of that buying, most of which is in short maturities, was a very successful two-year note auction. If you look at an 8 a.m. Eastern start for two-year note yields, you'll see what I'm talking about. Right around 1 Eastern, boy, those yields really dropped markedly, and that changed the entire course of the yield curve. The psyche of the trade for the day may even have reversed the stock market like that good 20-year auction did last Wednesday. Now, if you go further down the curve, look at it, the same time increment for a 10-year. You don't see that on the right side. There is no drop. And if you move toward a 30-year bond, we're actually looking at yields move up. It's the maturity that's closest to unchanged because all maturities are higher priced, lower yield than they were on Friday. But the short maturities moves up until that two-year note auction were bigger. Now, if we look at what's going on with regard to the yield curve, you can see 10s minus 2s have really had a nice reversal. That chart starts at 3 a.m. They've steepened a bit. And finally, remember that when Fed fund futures price moves up, it means the market's looking for less Fed. To that end, look at this year-to-date chart of December of this year Fed fund futures. The fact that they've rallied over 10 basis points, whether you believe this metric or not, the markets are making a difference in how it prices from a market perspective. Tyler, back to you.
All right, good point, Rick Santelli. Thank you. Oil pulling back sharply from those multi-year highs, down about 2.5%. Energy, one of the best performing sectors today, after being one of the worst. Pippa Stevens following it all at the commodity desk. Pippa.
Hey, Tyler, that's right. Oil is in the red today amid this broad-based selling. WTI is down 2.6% at $82.88. Between the contract's high and low today, it swung 5%. Brent crude is down at 2.3% at $85.89. Natural gas, though, up 0.33%, just over $4 per million BTUs. A stronger dollar is also pressuring oil since it makes it more expensive for foreign buyers. And then we've got the geopolitical tensions with the possible Russian invasion of Ukraine. Mizuho's Bob Yeager noting that in addition to injecting uncertainty into the market, This could also lead to demand destruction that would outweigh any lost supply. Energy stocks are not escaping the selling, with the group down more than 1%, although off the worst levels of the day. Williams companies Pioneer Natural Resources and Baker Hughes are among the biggest decliners. One stock, though, that's bucking the trend is Devon Energy. It's the only component in the green, and the energy sector is the only S&P group still positive on the year, up about 10%. Guys, back to you.
All right, Pippa, thanks very much. So with the markets on the decline across the board, how should you be positioned? Goldman Sachs CEO Lloyd Blankfein had some comments on that this morning.
You know, we're kind of in risk management mode here. We really don't know. The fact that we don't know is a bearish factor in and of itself. And so in risk management mode, you kind of reduce risk, and that's what people are doing. Somebody alluded to the fact that more puts have been being bought. People are getting out of positions, but there'll be, an end of it. And some of the best purchases here of securities in the long run will be done, at a moment like this when people are probably the most fearful.
All right, joining us now, Paul Hickey, Bespoke Investments co-founder. Paul, welcome. Good to have you with us. Remember, in 2020, I think the lows for the market were March 23. Are we at or near a March 23 kind of moment in this sell-off? What's your thought?
Listen, nobody knows what the low is when it's happening. And as Bob was saying earlier, there's not a lot of consensus as to whether today is the washout bottom. That's probably a good thing, if anything, because if you have a lot of people convinced that, this is the low, then it's not the low. I mean, we'll tell you that. But what was great about that Lloyd Blankfein interview that you just showed is he also talked about the fact that market corrections always seem a lot easier in retrospect than in the present moment. And if you look back historically at corrections in the market over the last, couple of decades, you could probably look at most of them and you would have no idea what the cause of them was. But some of them do stand out. Right now, the S&P 500, the NASDAQ, and the Russell 2000 are all on pace for 10% declines this month. That's only happened while those indices have been in existence in 4 other months. It was in October 87. It was in August of 98. It was in October of 08. And it was in March of 2020. And those are 4 months that everybody who was around at the time can remember, and they probably remember where they were on certain days of those declines. So those are 4 months that stick out. And when you look at those periods, though, is in the short term, you tended to see continued volatility where returns were all over the map. But a year later, all 3 indices were higher all 4 times. So in the short term here, there's a lot of uncertainty, and there's likely to be uncertainty going forward. You talk about the possible escalation of military conflict with Russia not being appreciated enough. And I think you're exactly right. There's not nearly enough attention being focused on that, I think. But over the longer term, those things will eventually get themselves sorted out.
I guess my feeling on that is that we've known certainly since December what the Fed was going to do, and when we discussed the minutes a couple of weeks ago, we know what the Fed is going to do. So I'm figuring that that's largely priced in. But what is new here is the earnings news and what's going on, and the possibility of war in Europe, an invasion in Europe. Let me turn back to something here, and I think I know I can anticipate what your answer is. We're not there yet. We're in sort of correction territory, which is rather routine. We seem to have forgotten that. But if you had to guess and put a percent chance on it, what is your percent chance that the great bull market is over?
Well, that the great bull market is over, I would say I would put a low probability odds of that. I think always betting against the U.S. economy and the U.S. stock market is a fool's errand. That's just been, people have been tried over the years, time and time again, and they've been mowed over. You just look, even if we were to see a prolonged bear market here, let's look back to October 2007, right? The worst time to buy would have been in early October 2007, right before the S&P peaked. The S&P lost half of its value over the next year or so, and in one of the worst bear markets of all. The annualized return, if you bought right at that peak through and held through today, would have been 6.7% annualized, including dividends. I think a lot of investors, if you they could sign up for 6.7% annualized returns going forward, they'd be pretty happy. You go back to the dot-com peak right before that, 7.7% annualized returns from right at the peak until if you held through now. So I think in that respect, a long-term approach is what you have to have here and keep perspective on if you're an investor.
And let the record show, we have to leave it there, Paul, but you do like small caps. Russell 2000 is down in sort of bear market territory, off its highs 20% from its all-time high back in November, and you like them. Paul, we appreciate it. Paul Hickey.
Thank you, Tyler. Have a good one.
You too.
The casino and leisure stocks had been getting crushed earlier in the session, but it's now a mixed bag. We'll dig into the big moves in the space right after this. Welcome back, everybody. Here's the latest on the S&P. It's down about 2.6%. We're down 10% from the all-time high, so call that correction territory. Penn National is the worst performer on the index in the past year, still down 63%. And this is as mobile betting is picking up. Why are all these stocks lagging? It's not just them. You should see DraftKings. Let's bring in Contessa Brewer for more. Contessa.
Yeah, Kelly, but we are seeing a bit of a bounce back this afternoon in the sports betting stocks, the laggards well off their lows. DraftKings right now, I can see that it's, it's still in the negative, off by more than 3%. And over the last year, you can see off 64% for the past 12 months, matching Penn's 12-month decline. DraftKings expected to close a deal this quarter, perhaps within the next few weeks, with Golden Nugget Online in an all-stock deal. A set number of shares awarded when the stock was trading in the 50s. Imagine how frustrated these GNOG shareholders are with DraftKings plummet. But Tillman Fertitta will have more than 13 million DraftKings shares, and he just told me If you own these names, you should be a long-term holder, not trying to get out of it short-term. Rush Street Interactive, among those with first mover advantage in New York State. We've seen how this state is killing it. Down now, you can see 2% on the day, and over the last year, down 62%. Big news for Caesars in New York. The first 8 days of mobile sports gaming, it was the clear market leader, and there you can see it's down over the last 12 months, 9%. These stocks are, of course, uncertain and volatile, pretty much as volatile as NFL playoffs have been this past weekend, Tyler.
Well,
you gotta have the stomach
they certainly
for it.
were volatile, and I gotta say I agree with you on Caesars. The amount of advertising that they're putting into the New York market on sports events, a lot of which I've watched, is truly astonishing. Contessa, thanks. All right, the Russell now nearly flat on the session. Where are you? You're over here now. It's still lower by nearly 12% in 2022, but are investors missing a big inflation hedge? That's the argument we'll put in front of you next.
Welcome back. Take a look at the Russell 2000, falling more than 20% from its all-time closing high in November. That makes it the worst performer of all the major averages. My next guest says small caps are still the best hedge against inflation. Francis Gannon is co-chief investment officer of Royce Investment Partners. Very tough time to be a small cap manager, but then it often, isn't this normal for small caps to be higher beta?
It definitely is. And I think what you're seeing in the market today is a mixture of what the Fed might do later in the week, but also fears about liquidity. And liquidity changing, and that's causing the market, I think, to shift and be very short-term oriented. So as an active manager in the small cap space, being able to pick your head up and look over the next 3 to 5 years, I think is really exciting.
So next 3 to 5 years is basically what you would tell people right now who are wondering about, what toe to dip in here. What are your, I don't know if you can give a couple of names, like some stocks you used to say, hey, these would be kind of the best bets if you're looking for things to pick up right now.
Well, I think you have to think about small caps in the, if you're down 20% and you're in a bear market, there are going to be stocks that are going to be down not just 20%, but 30, 40, or 50%. And therein lies, I think, great opportunity for long-term investors. A couple of ideas that we think will benefit from inflationary pressure will be names like BOK Financial, one of the largest banks in Oklahoma and in attractive growth markets like Colorado and Texas. Last time we saw rates go up, obviously we're at the beginning of a rate tightening cycle here. Last time we saw rates go up, we saw their earnings double. They'll also benefit from higher energy pressure costs, given the fact that they're one of the largest lenders into the energy complex. Another idea would be Element Solutions. Element Solutions is a specialty chemical company with, I think, great pricing power because their products are embedded in certain products. For example, the electric vehicle market, and will be benefiting from that pricing power there. Another last but not least would be Barrett Business Solutions. Here's a microcap company with a nice dividend yield that provides HR and strategic outlook for a lot of companies that will benefit from wage pressure with a lot of their underlying businesses.
All right. Well, you've basically given us everything you can in the time that we have. You want to tell us if we've called the bottom here?
I don't know if we've called the bottom, but what I do know is that for the past 3 years, we've had double-digit returns in the small cap space. We've never achieved a fourth year of double-digit returns, so I think returns will be more muted this year for small caps. Focus on earnings. Earnings, I think, will be better than people anticipate. At least early indications from many management teams say that the economy is strong and demand remains robust.
That's very interesting. So in a way, sort of saying, yeah, you should pull in your expectations. I think people are starting to, but very interesting nevertheless. Francis, thanks so much today. We appreciate it.
Thank you very much.
Francis Gannon.
All righty, up next, wild swings for the markets today. We'll examine trading volumes under the microscope next. With this intense volatility, what can ETF trade volumes tell us about the market? Dom Chu has been studying it and has the details. Hey, Dom.
So, Tyler, we've been talking so much about many of the stocks that are driving the downside. And to that end, many of these stocks are part of these exchange-traded funds and index instruments that oftentimes go towards taking views on the overall market or certain specific sectors. But one of the things we have been kind of talking, maybe not as much about, is the trading volume aspect. I get asked often on Twitter and social media about why we don't highlight some of these things and what it could mean. Some traders say it could be a change in direction for the overall market, a change in trend. Some people say it could be validation about current trading kind of directional moves and whatnot. So let's take a look at the trading volumes in the context of today's move with regard to over time as well. So 3 of the most active ETFs out there are the ones that track the S&P 500, the SPYs, the QQQ, which tracks the NASDAQ 100, and the IWN, which tracks the Russell 2000. Just today so far, the spiders have traded around 171 or so million shares on average for the last 10 days, very elevated, around 99 million shares compared to the last quarter, which is closer to 80. So you can see that trend, a lot more volumes today. Same thing for the Qs, a lot more trading volume there, and as well as the IWM, which tracks the Russell 2000 index. So if you use that, Kelly, Tyler, what it could at least tell you is that there is a lot more participation, a lot more activity with this market as it heads lower, something that some traders are paying attention to, guys.
This very issue, Brian Reynolds, one of my faves, market strategist earlier today, was saying he likes the high volume and we need that bounce. And this morning we didn't have it yet, but this afternoon we've got the start of one.
And we know that the last hour and the first hour typically have a lot of those surges, so we'll have to wait and see what happens in the closing bell.
We shall see.
Buckle up.
Closing bell? Did someone say closing bell?
Thanks for watching Power Lunch, everybody. Closing bell starts right now.
It certainly does. Thank you. Welcome to Closing Bell, everyone. I'm Wilfred Frost. More agony for the bulls following the worst week for stocks since 2020. But the major averages, as Kelly and Tyler were saying, off their lows as investors weigh geopolitical tensions, earnings, and the Fed.
Welcome, everyone. I'm Sarah Eisen. Let's look at what is driving the action in this final hour. Technology, once again, seeing heavy selling pressure, even as Treasury yields dip today. The NASDAQ is now down 14% on the year, with names like Airbnb, Netflix, and Tesla among the hardest hit today. Crypto's having a wild session. Bitcoin making a turnaround after touching its lowest level since July, though many crypto-related equities remain in the red. And energy losing a chunk of its big gains this year as oil pulls back. We've got every sector lower right now. As Jim Cramer noted this morning, the final minutes of the session have been quite a roller coaster lately.
Anytime you buy anything in the last half hour, you're obliterated. And I don't know, I would tell people, look, if you really want to know where to buy, keep your powder dry the last half hour, because the last half hour has been a nightmare.
Here we go. We'll see what happens in this final 59 minutes left of trading. Wilfred.
We have a great lineup of experts to help make sense of the market turbulence, including Oakmark's Bill Nygren, Bridgewater's Karen Carniel-Tambor, Lindsay Bell from Ally Invest, Ali McCartney from UBS, and Joshua Friedman from Canyon Partners.
Let's get straight to the action, though. Mike Santoli tracking it as always for us. And Mike, what are you watching in this big sell-off where we've seen the losses get cut in half as volumes explode?
Yeah, the key, Sarah, is looking for that urgent, indiscriminate wave of panic selling that maybe does alleviate itself and you get a little bit of a bounce. It's sort of a crescendo of selling. Tactically, that's one of the things that traders would be looking for. In fact, we're looking for coming into today. In a sense, it's so far been kind of textbook. You have not recouped all the losses, but definitely a lot of concentrated liquidations were happening at the lows today. And at the lows today, we were all the way back to levels seen in May. So you kind of wiped away 7 months worth, down 10% from the recent highs, also down 10% year-to-date and month-to-date. Keep that in mind because a lot of kind of systematic, disciplined funds and things like that are going to take that kind of monthly pullback and say, we're going to cut back on risk. I think a lot of the last couple of percent has been that type of activity as opposed to people kind of discerning specific fundamental changes that they were reacting to. Now, sometimes when the market does have one of these downturns, it kind of operates on the first in, first out principle. So take a look at both the small caps, or in fact, micro cap stocks, as well as the equal weight of Russell 1000. So they've also, this is a 2-year chart, right? So this basically shows you that they've both gone back to a year ago. They've sort of wiped away whatever upside they built up in 2021. Now, still certainly above the panic lows in 2020, but it does show you that they're actually outperforming on the day. In fact, the Russell 2000 was also positive for a little while. So maybe a little bit of a short covering, which is always the way the snapback rallies start. It doesn't always turn into a great recovery, but that's always how they start. So you have some short covering and the idea that they've already taken their punishment, whereas a lot of the big stocks, for example, Microsoft at its lows today was down 21% from its highs, but it barely even made a dent in its 2021 gains. Now take a look too at a 2-year look at Netflix versus Disney. This is a great little parallel. Remember, 2-year charts are taking you right to the market peak before COVID hit. Now Disney had been struggling and rolling over for a while, but now basically both of them more or less flat for 2 years. In fact, Disney might be that kind of name where you say it's been so distressed for a little while, you wonder if the contrarian move is to say we build positions in big quality companies when they are on the outs like this. So I think there's a lot of this activity going on right now, whether it was wanting to buy one of the secular winners or just looking at the wreckage in small caps to say maybe the risk reward is improved because of all the relatively kind of blind selling that's gone on, guys.
Mike, let's talk about the why. So we did get some economic data today that was pretty disappointing. Some manufacturing numbers that, if you look inside, showed new orders are slowing. The employment component of the manufacturing index contracted. Services was a big miss. Is this about a slowing economy into a Fed tightening, the Russia geopolitics angle? I noticed gold was up. What are you hearing?
Keep listing things, because it's about everything. When you get into one of these episodes, all of a sudden it seems as if every direction you look, it's a plausible reason why we have been selling off. Even though all last year, what did the market do? It ignored every potential negative on the way up. So I'm a little more in favor of the idea that we tend to retrofit the reasoning to the market action. But yes, absolutely, if you wanted to name the fundamental fear, it is that we are getting a Fed that is tightening and is more determined to tighten because of the inflation picture than they would otherwise be at this level of growth and at this level of perhaps pullback in the equity market. So I do think that's where the anxiety sits. And then the rest of it, you can just fold in and say, oh, and then here's another reason I shouldn't buy the dip, because Russia and Ukraine and all the rest of it. So I think all of that stuff gets into the mix, but it's almost a good thing when it seems as if we are beset by so many challenges on every front, because that does tell you a little more of the bad news is already in the market.
Mike, thanks so much. We're currently down 1.8% on the S&P 500. For more on what he's watching amid today's sell-off, let's bring in Bill Nygren, portfolio manager at Oakmark Funds and CIO for U.S. equities at Harris Associates. Great to see you, Bill. Thanks so much for joining us. What ultimately do you make of the sell-off that we've seen year to date so far?
Well, thanks for having me on. We've been saying for some time that we think this has been a bimodal market, that there are parts of the market that are very, very cheap and parts that are very expensive. And we've expected somewhat of a reversion to the mean. And I think we've started to see that. There are definitely stocks out there that are trading at prices that are hard to justify on fundamentals. But we think the Oakmark Fund portfolio is invested in a very different part of the market. With its largest holding being Ally Financial. They reported great numbers last week. Company's expected to earn a little more than $8 a share this year. It's trading at 46. They'll be buying back more than 10% of their stock. They pay a 3% dividend yield, barely sell at a premium to book value. A number of other banks we could say the same thing about. Capital One is selling between 7 and 8 times expected earnings.
So does it worry you, Bill, when you do see those banks, which I totally get the buy case for, particularly following pretty good earnings for most of the names, does it worry you to see them all selling off with the rest of the market and wonder whether we're just in a bit of a downdraft that's going to affect everything, no matter what, for a period of time at least?
Well, certainly we don't enjoy seeing the stocks we own go down. But at Oakmark, we try to look about 5 to 7 years in the future. And we're highly confident that these companies will have larger book values, larger dividend yields, or larger dividends, hopefully not higher dividend yields, higher earnings, because they're serving growing markets with growing needs, and they're going to have a declining share base. So we invest based on thinking we're going to get a very good 5-year return from these levels. And when the prices go down like they have been recently, to the extent investors give us more capital, we'll put that to work in these same ideas.
What about Netflix, Bill? I wanted to ask you, I think you had Netflix in the fund, which was always a little curious for a value investor. And now what we saw happen after earnings, I'm wondering if you're adding to that position because it looks even cheaper.
Obviously, we can't tell you what we are doing or have been doing in the stock, but I couldn't talk positively about it here if we'd sold it after last week. We think Netflix is a very, very cheap stock. If you look at traditional metrics like PE, it's at less than 25 times expected earnings, about 5 times revenues, under $800 a subscriber for the first time in the modern streaming era. We think it's just a very cheap stock. It's still the clear market leader. It's cost advantaged. Customers consider the prices to be a bargain. So we think it's a great opportunity today.
I mean, interesting that it's cheap relative to where it was, both 5 years ago before it grew into its multiple and 2 weeks ago before it pulled back. But it's not cheap relative to the market.
Well, at 25 times earnings, it's a very small premium to the market for a company that we think is still in its early to mid-cycle growth. The company is growing much more rapidly than any other sector in media. Subscribers are still growing. The amount of programming that they're providing is growing substantially. So we think this is a very good company that deserves to sell at a significant premium to the market.
Do you think that value stocks in general can shine in this environment, Bill? Because that was the great hope of this year. But what you need for that to happen is the economy to stay resilient in the face of rate hikes. And there are now questions about that, given some of the data and some of the market action we're reading into. What's your assessment?
Well, I don't think the banks or the energy companies need an incredibly strong economy to justify selling at the mid to high single-digit PEs that they're currently selling at. Most of the energy stocks look cheap if oil prices fall back to $60 a barrel. Oil, after a decline today, is still above 80. At this price, free cash flow ratios are into the mid to high teens, some at over 20%. These companies are going to be returning a lot of capital to shareholders, and I think that's going to happen regardless of whether we have a real strong economy or an economy that is more at trend levels. Now, obviously, if we go back to the way things were at the end of the first quarter 2 years ago, at the beginning of the COVID fears, that's a different ballgame, but we certainly don't see that in store for the economy.
What's your expectation on the Fed in the year ahead, and whether it's this week or in the months ahead? If they significantly alter market expectations of 4 rate hikes, does that make a difference to what equities do?
I'm probably the worst interview you could have for Fed policy. It's just something we don't focus on at all. But we do think about fixed income in a value framework. And in the Oakmark Bond Fund, we've had very low duration in the portfolio because we think investors deserve a positive real interest rate. We value all our stocks based on a positive real interest rate, and the Fed needs to raise rates over the course of this year to get rates back to a positive level.
You said that energy stocks would still look good to you even if oil falls to the 70s. We're down 2%, still at 83 on WTI. Which energy names do you like best? Because we have seen a pretty strong run-up now over the last year.
We have seen a strong run-up in the last year, but that came at the end of an awful decade for energy names. We have positions in EOG, ConocoPhillips, Apache. I think EOG is the highest quality E&P company in the United States. They'll be profitable at prices down to about $40 a barrel. They've got a lot of low-cost opportunities still ahead of them. Stock sells at a single-digit PE based on earnings expectations for this year. At the other end of the spectrum, you've got a smaller company like Apache. It's got a little more debt. It's a little more speculative, but they're selling at about a 25% free cash flow yield based on oil being at $80 a barrel. We think this area has been oversold. We think ESG investors have kind of mindlessly avoided this area because of it being hydrocarbons, rather than saying that the U.S. is a worldwide leader in its hydrocarbon efficiency, in its carbon efficiency for producing hydrocarbons. So we're very happy with this industry, and we love the fact that they're returning capital to shareholders.
Bill Nygren, thanks so much for joining us. Good to see you.
Thanks for having me.
We will be all over the market moves throughout the show with more ideas and strategies to help you navigate the volatility. And after the break, a select few names seeing strength today after a busy weekend of activist news. We'll dig into the big pop in coals with an analyst who just upped his price target on the stock. You're watching Closing Bell on CNBC. The Nasdaq falling today, but well off its lows, now down less than 1%. Here's a look at the Nasdaq 100 heat map. As you can see, currently down about 1%, trading at 14,285. Was well below 14,000 at the low of the session. It was, in fact, down 4.8% at one point. So a significant rally off the lows. The likes of Peloton towards the top of the list there, as you can see. Those that have been beaten up the most of late, whereas Moderna, Baidu, Tesla, Netflix remain towards the bottom there, Sarah.
It's incredible recovery. The Dow now down almost 400 points. It was down 1,100 earlier. Kohl's is one of the bright spots amid today's sell-off. That stock rallying following reports of 2 takeover bids from activist investors, Sycamore and Acacia Research. Sycamore offering to pay at least $65 per share for the retailer. Acacia Research offering to pay $64 a share. Kohl's did confirm in a statement earlier today it received the letters of interest in acquiring the company, saying in part, quote, the board of directors will now determine the course of action that it believes is in the best interest of the company and its shareholders. Joining us now is Oliver Chen, senior retail analyst from Cowen. So what's it worth, Oliver, in a takeover?
Sarah, it's great to be here. We think it's worth $75 or more, as much as $80 per share. There's a few things happening here. One, real estate. Real estate could be valued at $3 to $7 billion. $3 billion of that could be achieved in a sale leaseback. So monetization of real estate, unlocking value here. Two, Kohl's has very healthy free cash flow, about $1 billion a year. That's 15% free cash flow yields. And third and finally, Kohl's is trading at a very modest PE, about 9 times versus an 11 times 3-year average. So these are all factors that really give us optimism, as well as the base business, thinking about Sephora, Active, the brands they're developing, and the off-mall exposure. And don't forget about the Amazon partnership as well.
Right. So do you think that management and the board is going to go for it? You think this is ultimately how this saga ends?
Our take is that there's a high degree of likelihood, 60 to 70% or more. That being said, the risk factor and the hurdles to look at include monetization of this real estate through a sale leaseback, achievement of the financing, and if that can't be done, can a bidder raise the right amount of debt and equity to complete the deal? So those are all factors to watch. That all being said, this company's in play. You know, the Kohl's cash event is happening, and the board of directors needs to evaluate all potential outcomes and act in the best responsibility of shareholders, Sarah.
So Oliver, it sounds, if you're talking a lot about a sale and leaseback of the property, that there's a bit of financial engineering that a buyer can do. That's a slightly unfair description, but it's more a few one-off big moves like that will create the value to justify this price, as opposed to this being strategically attractive medium to long term. Is that fair or not? Or are there lots of other kind of strategic levers they can pull?
Yeah, I would say that certainly that's a big part of the value creation. Kohl's owns about half the stores, and they're off-mall. Those have become increasingly valuable properties, and there's as much as $7.8 billion of real estate in terms of what this company owns. That being said, if a sale leaseback is not able to occur, the leverage ratio on the LBO would move to about 4 times or higher. That would require a bigger check and the financing needs around that. That's possible too. We'll just have to see. But the name of the game in retail is real estate does have tangible value, and rethinking retail in terms of unlocking that, that's another avenue that we're seeing across a lot of department stores. You know, we like Macy's as well. There's about $2 billion of real estate value there, $7 per share. So we're watching that as well.
Kohl's up 33%. Oliver says it's worth $75 at least per share. Thank you for joining us on The Move. Oliver Chen from Cowen. We've got less than 40 minutes to go, and the recovery continues. This final hour feels a lot different than what we have been accustomed to in the last few sessions. Check out the recovery. The Russell 2000 index of small caps, it's positive. It was beat up the hardest, down 20% off the highs. It's up 1.3%. The Dow only down 1%. The S&P only down 1.25%. The NASDAQ down 1%. So a lot of these beaten down names are getting picked up. We might have seen the washout earlier when we saw tremendous declines, with the NASDAQ down more than 600 and the Dow down more than 1,100. After the break, the crypto market wiping out $130 billion in value in 24 hours. But Bitcoin making a mid-session comeback as well. In fact, it happened first. We'll take a closer look at what is behind the wild action next. And as we head to break, a look at the tickers people are searching for on CNBC.com. Amid all this volatility, there's a decidedly macro focus today. The 10-year note yield right on top, 174. Yields are actually moving a little bit south today, followed by the NASDAQ, Tesla, which was hardest hit, down almost 5%, the S&P 500, and the Dow, which all continue to be lower, but very well off those session lows. We'll keep watching it for you with about 38 minutes left to go in the session.
Welcome back. Check out the S&P 500 sector heat map. Every sector still in the red, but of course far from the worst levels of the session. S&P's down just over 1%. Energy, which was really suffering, it was towards the bottom of the pile, in fact, earlier in the session, is now the best performing sector, albeit still down 0.5%. Utilities at the bottom. So there's been some rotation there. Earlier in the session, when we were at the lows, consumer discretionary, tech, and oil were the worst performing sectors, but discretionary and energy in particular have led the rebound, Sarah.
ARK Innovation ETF about to go positive. It's, of course, down 55% from the highs. Crypto also getting caught up in the volatility as well, with Bitcoin touching its lowest level since July before turning higher a little bit earlier this afternoon. Kate Rooney with more on the moves that, Kate, we're kind of a leader for the overall market.
That's right, Sarah. Yeah, Bitcoin bouncing back above $36,000 after a pretty choppy day of trading. We also had Ether recovering a bit from that 6-month low. The big crypto-related stocks also following suit. You had Coinbase, Block lower as well. They are off those lower levels, though. Robinhood, meanwhile, hitting a 52-week low today. It's been a tough year so far for fintech. And Bitcoin has really been trading in line with a lot of those tech names. And as macro funds have bought crypto in the past couple of years, it's one of the first things they look to sell when taking some risk off the table, as they've been doing lately. And analysts are also citing retail investors losing conviction lately. Glassnode, for example, says they're seeing most of the selling coming from short-term holders who appear to be taking any opportunity to get their money back. One way to measure investor sentiment is called the Fear and Greed Index. That is now measuring at a 13 out of 100. Last month, for some perspective, it was around 39. So retail investors backing off about here lately. They say that Fear and Greed Index is now at extreme fear levels. Sarah.
Okay, Rooney, thanks so much. I mean, we're well off the session lows, though. Ethereum still down 5 or 6%, of course, following a tough weekend for crypto as a whole. The final half hour of trading has seen significant selling pressure over the last week or so. We'll keep you up to speed, of course, on that as we approach the close. 32 minutes left. We are well off those lows, down only 400 on the Dow. After the close, will IBM's earnings help turn things around for tech, or will they add to the pain? We'll break down those numbers as soon as they cross at the top of the hour. And as we head to break, here's a check-in on bonds. Yields have been lower all day, but the 10-year just inched a little bit higher. We're back to, what, 175. In fact, it's fractionally lower again now. But either way, 175 the level on the 10-year.
The Nasdaq falling to its lowest level in months, but it is making a comeback right now along with the rest of the market. Let's get straight to Christina Partsenevelos for a look at how tech and chip companies in particular are performing, seeing some buying.
Yeah,
Christina.
we are right into 28 minutes left, and we got the Nasdaq coming off those earlier lows, like you mentioned. But we were teetering at that 8-month low, which got a lot of people worried because you had some of the major tech players, Apple, Tesla, lower, Microsoft, and they were some of the biggest drags on the Nasdaq 100. You got mega cap tech player Microsoft as well, trading lower today. Well, it's hovering. It's not as bad now, just about 1% lower, but still a heavyweight when it comes to the Dow and the Nasdaq. And then you've got semiconductors also not spared. Micron, Qualcomm, Lam Research, all selling. Well, look at that reversal right before going live. This wasn't the moments before. It wasn't like this. You're seeing Qualcomm now up 2%. Lam Research, the same thing. Micron teetering in the positive territory. And let's check Nvidia right now. It was one of the biggest losers. It was the third largest point impact on the Nasdaq and tracking for its worst month since July 2008. You can see that it's a little bit of an uptick now, but still trending in negative territory. And last but not least, AMD, one of the Nasdaq's biggest decliners to start the year, already off of roughly about 19% year to date, 30% from its 52-week high. Its competitor Intel, though, outperforming AMD on a year to date basis. Lots of volatility, especially right before coming on set. You can see the movements continuing into the close. Back over to you.
Thank you very much, Christina. As you said, some serious bounce backs going on. The Dow's now down less than 200 points, just half of 1%. It's erased, what, 4/5 or so, a bit more than that of its losses. Let's look into some other individual market movers. Now, Netflix continues, well, let's have a look at the share price before I say this. Continues its weakness from last week. It was down 20% plus on Friday. It then was down 10% at the lows today, now only down 3%. Jefferies did downgrade the stock, though, from buy to hold, excuse me. The firm says there's a lot of uncertainty around the streaming service and expects to see slower growth this year, but well off the lows. As I said, it was down about 10% today earlier in the session. Wedbush downgrading Snap to neutral from outperform. The firm cites increasing competition from TikTok as one of the reasons. The stock is only down 1.5% itself, well off the lows. Jim Cramer spoke about Snap in his Investing Club newsletter earlier today. To sign up, head to cnbc.com/investing club or just point your phone at the screen and capture that QR code there.
Down only 183 on the Dow. It's wild because we were down 1,115 points earlier. Consumer discretionary just turning green in the S&P. Let's go to Rahel Solomon for a CNBC News update. Rahel.
Hi, Sarah. And here's what's happening at this hour in other news today. 8,500 U.S. troops have been put on standby for deployment to Europe to help NATO forces. The move brings the U.S. closer to military involvement as Russian troops gather near the border with Ukraine. Prosecutors say that 3 former Minneapolis police officers stood by while Derek Chauvin killed George Floyd in front of them. During opening statements, defense lawyers countered that Chauvin called all the shots during the encounter. Sarah Palin's defamation suit against the New York Times has been delayed after she tested positive for COVID. Palin claims an editorial piece damaged her reputation. Palin is unvaccinated and previously contracted COVID in March. And in Burkina Faso, military officers say that they have taken control of the country and arrested the democratically elected president. The new military regime says that it has suspended the country's constitution and dissolved the National Assembly following a day of gun battles in the capital there. You're now up to date. Sarah, I'll send it back to you.
Rahel, thank you very much. Just want to show you what's happening with the Dow, which is only down 173 points right now, a major recovery from what we saw earlier today from the session lows down more than 1,000 points. What's leading us higher? Home Depot, biggest contributor to the Dow gains right now. Travelers, Nike, and Salesforce are also higher right now. The buying is done in a lot of these software names and some of the retail names as well, with consumer discretionary going positive in the S&P. Biggest drag on the Dow continues to be Visa, J&J, Merck, and Apple. But we are seeing this recovery with all the major averages. The Nasdaq is only down now 1/3 of 1%. It was down today almost 5% at the lows of the session. For more on this crazy volatility and how to play it, let's bring in Karen Carnial-Tambor. She's Bridgewater co-CIO of sustainability. Karen, it's great to see you. Do you see all of these wild moves as tied to what the Fed is going to do?
Hi, Sarah. Yeah, I think we're entering a phase that's a really interesting phase and a tricky one because the economy is likely to do fine. Inflation is likely to remain high, But the Fed is withdrawing liquidity, is going to continue to withdraw liquidity. And we're really experiencing that sort of suck. When the Fed withdraws liquidity, it brings down asset prices. I don't think the Fed is likely to tighten enough to actually stop the self-sustaining momentum in the economy and get ahead of the inflationary pressures. It doesn't want to. It doesn't really want to cut off the expansion and cause a downturn. But it's been printing money for so long. There's been so many dollars floating around that removing liquidity, even if you're tightening sort of behind the curve, it really hurts assets. And we're experiencing that. And it hurts most, whatever's most liquidity sensitive, wherever you saw money go during COVID is what's reeling the most now.
Exactly how it's been playing out. So would you be buying on the dip then, Karen, some of these hard-hit equities if you don't think the expansion is in danger and the Fed won't go so far as to kill it off?
No, I think you really could get a case where the economy outperforms financial assets, and financial assets just don't look nearly as good as they did, 6 months, a year ago, where the Fed had a lot of room to stay easy because they're going to stay in this, between rock and a hard place situation where they don't want to cut off the expansion all the way, but they really do have an inflationary set of circumstances to deal with. And the easiest way for that to play out is that financial assets just do worse than the economy. So they're less attractive than they were. In some sense, the most attractive assets are the ones most exposed to either inflationary pressures or the real economy. The best is exposure to kind of nominal spending. So things that are commodity exposed. But when you get real spending, when they're not cutting off the expansion, you're still getting people going in, buying things in stores, buying houses, you're getting inflation, but less exposed to the sort of financial excesses where that's where you see bubbles popping.
What commodities do you like, and what's the best way to get exposure? I mean, oil obviously has already had a very strong run. Maybe there's further to go, but it's pulling back today, I guess, showing a glimpse of the fact that it's probably not got as much upside as maybe some other commodities.
I think a broad basket is really most appealing. And for most investors that look at commodities, they end up overly concentrated in oil because that's the biggest piece of, say, the GSCI index. But oil has a lot of idiosyncratic risks. There are only a few big producers. Obviously, you have everything around climate change, which makes pressures sometimes to the upside, sometimes to the downside as regulations change and whatnot. I really like metals. I think they're somewhat ignored by investors because you need them in so much of what we need to use in the real economy. And you have these big structural pressures to say that even in a somewhat slowing economy, if we want to make any progress on climate change, we need more electric vehicles, more solar, all the things that require more physical inputs from the metals, which makes them particularly attractive in an inflationary backdrop that also needs to deal with all these environmental issues.
NASDAQ just went positive, Karen, which is just amazing to see because we were down, as I said, 4.9% at the low of the session. So clearly volatility. So do you guys expect this to continue as the Fed? We haven't even started in terms of tightening or removal of liquidity. The Fed is still buying assets and keeping rates low, but we are expecting that tone to change very much on Wednesday at the Fed meeting. You expect this kind of action to continue?
I mean, look, you can never predict intraday volatility at this level, but what I would say is that it is a different market today than it was pre-COVID in terms of who the participants are. The fact that you've created these kind of platforms for retail investors to really get engaged, to invest in stocks in a very gamified way, off their phone, looking at prices minute to minute. There's just a lot more retail participation than there was previously, and that can cause more extreme volatility. Now, obviously, these retail players, a lot of them had literally received checks from the Fed that in many cases funded, this new interest in investing when everything else was closed. And those checks aren't coming anymore, but those pipelines are still there. You have a lot more people that are engaged in the stock market, and it can cause a different type of price moves. And at the end of the day, it's always buyers and sellers, so you need to know who the players are.
What about the bounce back we've seen in crypto today? What do you make of that, Karen?
I think crypto is a really interesting asset to look at in this case because there's so little institutional investor participation. Our rough estimate is Bitcoin is probably 5% held by institutions. And so there you really are getting a lot of high net worth, a lot of retail, a lot of excess liquidity that went into this asset from a very wide swath of, kind of more retail participants. And so on one hand, when you get the liquidity sucked out, that is one of the first places that's going to get hit. Even if an asset like Bitcoin, you imagine one day might become something like a storehold of wealth, short term, that is a high risk asset with a lot of risk premium that was affected by all of this money printing going to people that were then able to buy it. So you're seeing it act as, an early life cycle, early stage, risky asset that has a lot less institutional participation. The second piece is that, a lot of the bet institutions have taken is this is going to stay a volatile market with a lot of opportunities for arbitrage and market making. So seeing volatility there, I think, is no surprise and what you'd expect at this stage of development.
Up 3.5%. Rebounding here with the market. Karen Carniel-Tambor, it's great to have you here, especially through these dramatic swings. Thank you. Straight ahead, the final minutes of this wild comeback session on Wall Street. Plus, what to watch in IBM's earnings report after the bell. Those stories and more when we take you inside the market zone. We've got 18 minutes, about 17 minutes left of trade. Dow down 221. NASDAQ briefly went positive, wiping out a nearly 5% decline. The S&P 500 down only 0.7%. We'll be right back. Remarkable turnaround here for the market. Welcome back. Here's a look at what is ahead in the second hour of Closing Bell. We will get earnings results from IBM, which will be closely watched amid the volatility in technology. Hedge funder Joshua Friedman from Canyon Partners will join us to weigh in on the market swings. We'll talk about how this week's Fed meeting is impacting investor sentiment and what Fed watchers think will happen on Wednesday. And we will discuss the rising tensions on the Russia-Ukraine border and how geopolitical concerns are affecting this market. But first, we have got just about 13 minutes to go in the trading day, and we are now in the Closing Bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. And today we've got Lindsay Bell from Ally Invest back as well. Welcome, Lindsay. We'll kick it off with the broader market. What a dramatic day for the markets. Major averages are in the red, but significantly off their worst levels. The Dow is down 1,115 points at session lows. It is currently down 47 points and looks like, Mike, it wants to go positive. You've got a number of sectors in the S&P turning greens: consumer discretionary, energy, communication services. Bitcoin led the charge a little bit earlier in the session. Did we get that sort of washout that you needed to bring the buyers back?
I think we got what would qualify as one. You never know if it was enough until you're looking back in retrospect. But without a doubt, I think this rebound, more than 3% rally in the S&P from the lows this morning, were mostly a measure of just exactly how overdone we got on the downside. Right, Nasdaq most oversold in 22 months. Friday saw the most downside put option buying in history on a single day. So yeah, we were all geared for something like this. In some respects, it's also kind of textbook. You come in bad down open, you get a lot of heavy volume selling near the lows, and some of the most beaten up stuff started to have a glimmer of light first. So all that stuff fits together. I also think we have a Fed meeting or decision on Wednesday. Nobody wants to be leaning too far in either direction ahead of it. And the market's been going down in an almost straight line for 3 weeks. So if you're going to come back towards some kind of a neutral footing, it means doing some buying, covering some shorts. So that's where we are right now. We'll see if it's decisive. We'll never know for a while, though.
Lindsay, which sectors deserve to bounce most? If we have seen the bottom, which sectors from here do you think will have the best rest of this year?
I think it's going to be the sectors that really got hit the hardest. And I think that's what you saw today in the action, especially in the rebound. You saw the Russell 2000 was what turned positive first today, and it had been hit the hardest, right? It was down 20%, basically in bear market territory, and we saw that bounce. Crypto assets, they were down. They hit hard. Bitcoin down 50% and, in the green today. So the risk assets have been hit hard. They're starting to come back. Maybe tech is next. NASDAQ, like you guys said, looking to maybe make some upside move here today. We don't know. It seems like we don't know where we'll land today, but it seems like the buyers are coming in to buy the dip here. Maybe we did get that washout that you guys were talking about here. Certainly things looked a little bit overstretched to the oversold side, so it's not surprising, but that doesn't mean that we're going to be in the clear. If tomorrow we get an update, Wednesday is certainly at risk with the Fed commentary from Jay Powell. So there's a lot that we have going on this week. We're finally getting into earnings season, so maybe we'll have a little clarity by the end of the week, but I still think there's room for volatility over the course of the next several weeks until we get that first Fed rate hike.
We now have the Dow and Nasdaq in positive territory, the S&P nearly there. EV stocks had a volatile day like everything else. Let's get to Phil LeBeau for a breakdown. Hi, Phil.
Wilf, they were down anywhere between 5 and 10%, but like the rest of the market, they have come back a bit. Let's start first off with Tesla. Remember, this was a stock that was trading under $900 a share briefly today. I believe it's back up over $900 a share. We get the Q4 numbers from Tesla after the bell on Wednesday. Rivian, Fisker, and Lucid. And we're going to show you these stocks going back to November 15th. That was really the near high shortly after the Rivian IPO. If you look at those stocks, while they have come back today, they're down anywhere between 35 and 65% since that mid-November date. And finally, we want to leave you with Workhorse and Lordstown Motors. And we're going to show you these two. Now, Lordstown did go back positive late this afternoon. These stocks are down more than 90% over the last year. More than 90%, guys. But overall, the EV stocks coming back a little bit after being down 5 to 10% earlier today.
Certainly coming back a lot, as has the broader market. Thanks so much, Phil LeBeau. Mike Santoli, all three of the major averages are now higher. Astonishing, really, when you think about where we were in the middle of the session. But just to link the broader markets to Phil's report there, we mentioned the importance of the Fed later this week. Also, some hugely important tech-related earnings reports, if you put Tesla in that tech camp, coming during the course of this week, too.
Well, yeah, I mean, the actual big earnings contributors to the NASDAQ, we're going to hear from a lot of those. I think it serves often as just a reminder for people to, that they do have a lot of ballast in terms of their cash flows. If you're talking about Microsoft and Apple, I mentioned Microsoft hit a negative down 20% threshold this morning. That's of some significance. When it comes to Tesla, though, I think this is more, exactly how are the risk appetites flowing at the moment. Tesla's still 25% off its highs. It's never been about next quarter's numbers for them, really. Obviously, deliveries have to cooperate, but it's pretty much just about exactly how much adrenaline we have kind of flowing through a handful of tickers.
Most sectors in the S&P 500 are actually higher right now, Lindsay. Consumer discretionary led us, but now it's energy, industrials, communication services, financials, real estate, materials, technology. If this is a bounce from things that just got way oversold and way stretched and washed out, what does that tell us about where we go from here?
Well, I think you have to think about where you think the economy is going from here, right? And while Q1 seems like it's going to be a little bit softer because of the COVID impact that we saw coming into the start of the year, the rest of the economic environment seems like there is opportunity for things to continue to chug along, especially once we get past Q1. I think that you're going to see earnings expectations. They have remained solid. We're not expecting anything outrageous as far as numbers go. Just over 7% for 2021 on an EPS expectation. That's where we're at right now, which is about average for the S&P 500. The big question mark there is margins as inflation and the Fed begins to take hold. The Fed, I think, while they may move faster, more aggressive than what many had anticipated coming into the start of the year, they're not going to be able to get interest rates significantly higher than from where they are. And at the end of the year could still be 1%. We've seen the PE multiple contract just under 20 times from where we're at today. And so I think that there is opportunity here, potentially in the sectors that, got hit the hardest, or even some of the more cyclical sectors that could lead as we rebalance and regenerate growth from these lower levels that we're going to see in the first quarter.
Mike, we've talked so much about the importance of the Fed and whether that would change the kind of the discussion point this week. Are we seeing today that that's not the key factor for markets in the short term, given that we've done such a roundabout term without any real Fed developments?
Well, I think it was a key pressure point for weeks right now. And it's all a matter of, whether the market just kind of overshot the likely reality when it comes to what the Fed might ultimately do and say on Wednesday. So, I think when you're down 10% in a month or less than a month, it shows you've gone a long way toward pricing in whatever you were afraid of when it came to the Fed. So, yeah, a lot of those things, I think it's more about what's been on people's minds as opposed to what's been in the observable numbers. As we keep saying, the Fed's done nothing but talk so far. So we're front running it, and the market's tightening ahead of anything that the Fed is prepared to do.
Down 8.6% from the highs. Earlier today, Lindsay, we were at a point where if the market closed at those levels, it would be in correction, 10% off the highs. It feels like it's this guessing game of how hawkish the Fed is going to be and how much tightening they're willing to do if the markets continue to throw a tantrum and we start to see the impact in the real economy with the economic data already starting to weaken. Can they tolerate a 10% correction? What about 20% in 4 weeks? These are the kind of questions that you're hearing, which does relate to financial stability and the economic outlook.
Yeah, no, I think it's certainly something that they're weighing on their minds, just as the market is. And I think the market's grappling with exactly what the Fed is going to do. Jay Powell's been very transparent throughout this process. The question is, though, is he late to the game in the tightening process? Does he need to use all of his rate hikes that he can possibly get, given the fact that we are loaded down with debt? Are we going to can he get to where he needs to be quick enough to make a difference in the inflation spectrum? But then on the other side, is the supply chain going to be able to self-correct as we cycle some of those higher inflationary numbers in the spring of this year? So I think there's still a lot of questions that need to be ironed out over the next couple weeks. I don't think that even if we get a bounce over the next couple days, it means that we're out of the woods yet here. There's still a lot of question marks and a lot of uncertainty. And you see investors really having anxiety and experience stress about that, which is why I think you've seen such a sharp sell-off in such a short period of time. But then I would remind investors at the same time that after you have such a great performance in 1 year, up more than 20%, in the following year, it's not unusual for there to be a dramatic pullback in the first quarter. And by the way, we're going on 2 years without a proper correction and really great performance. So I think if investors can hold tight and remain patient and keep their eye on the prize at the end of the year, where the economy is going to continue to chug along, earnings are going to continue to move, and hopefully we'll see some fiscal side of stimulus support and corporate spending support what the Fed and monetary policy is taking away.
Unbelievable. NASDAQ up 0.5%. The Russell 2000 index of small caps, which got hit the hardest, led us out, up 2.3%. It was the first to turn green. The S&P up 0.25%. The Dow up 0.25%. Almost 100 points. That's a 1,200-point swing today as we head into the close. IBM gearing up to report results right after the bell. Deirdre Bosa here with a look at what to watch there. Deirdre.
Yeah, so Sarah, this is Big Blue's first quarterly report since spinning off Kyndryl. That's its legacy business. So the results, they could be pretty messy in terms of comparing it to earlier periods and their revised segments. What we are certainly going to look out for is that guidance, which analysts say will be key. But even sorting through that is going to be difficult. Remember that this is sort of a classic legacy play. So it has been outperforming the S&P over the last few months, which is a change from, of course, the last 10 years where it hasn't really done anything. But this is, of course, part of Arvind Krishna's turnaround plan. We'll see if this shows early promise after the bell when it reports. Back to you.
Got it, Deirdre. Thank you. 2 minutes to go here in the trading day. Mike, what do you see in the market internals as we witness this incredible recovery in the market?
It started out today, Sarah, as an absolute bloodbath. 95% of all volume was to the downside in the first half hour. So we've really come back. Now, still more downside volume than upside. That's not uncommon when you've had a big intraday turnaround, but there's much more evenly balanced. We were talking about Fed expectations. 2-year note yield has finally kind of curled lower. It's below 1%. Not a dramatic move from recent highs of 105, but it does show you that maybe the market is rethinking just exactly how many hikes we have to price in at this stage. That coincided with a 2-year note auction that went pretty well as well. And the volatility index is putting in a pretty good spike. We got up toward 40 today and now have come back in. That was a perfect